Welcome. You're watching India Market Open midweek. There is some calm that's returned back to global markets. Asia looks okay. Wall Street had it a little rough, but it seems like comments from the Bank of Japan are helping sentiments at least this morning globally and locally. Of course, if you're a real estate owner, if you're looking to buy or have held or looking to sell, there's good news on the indexation front.
Yeah, there's options.
Big relief.
Options for people. So you can choose what you want depending on how you calculate your gains or how your CA tells you or taxman tells you how your gain should be calculated. But you know, Asia is important because when we started off, Asia started weak. And I think there is a surge or change that has happened, which is actually a big positive.
So if I were to sum up what has happened in the last 24 hours or overnight, I would call it softening the blow. Whether it's from the Bank of Japan or whether it's on long-term capital gains tax impact because of the removal of indexation for real estate. In both cases, the blow has been softened. But let's start with the Bank of Japan because, the statements which have come in from the Bank of Japan Deputy Governor are very, very important. And let's just pull up some of those statements. He says, we won't raise rates when the market is unstable. They have stepped in to control the market turmoil, of course. They say we're watching the market impact on the economy with a sense of urgency. He says we need to keep easing firmly for the time being. Recent volatile stocks and forex moves have effects. Rate path to shift if market moves affect outlook. The US economy is likely to have a soft landing, not at risk of being behind the curve on rates. So effectively, it's an attempt to talk down the kind of concerns that we have seen. And it comes at an opportune time because I think the whole trading cycle of volatility has calmed down, which was going on for the last 48 hours. So let's tell you what's happened in US markets overnight. A rebound after three week trading sessions. Look at how the Dow, NASDAQ and S&P 500 have closed up. Dow futures also up about 0.5%, and the NASDAQ up nearly 1%. So 11 sectors, all 11 sectors of the S&P 500 were in the green. So that's giving you the sense of the breadth of the kind of pullback. Treasury yields also rebounded, so it's a rebound story all across. Treasury yields rebounded after hitting lows, the US 10-year at 3.89%. Oil prices have also rebounded, not necessarily positive because all recoveries are not a positive sign. Oil prices have rebounded because of the fears of an escalation between Israel and Iran. As one analyst described it, markets are waiting for the other shoe to drop. Will there be a retaliation from Iran after the Hamas leader was killed in Iran by Israel? And Israel is preparing for that kind of a reaction. So we'll have to see what happens there. Brent has neared the $76 mark. Asia, meanwhile, is a different story in the last 20 minutes or so. The Nikkei recovering sharply, all of Asia green because of those very calming statements from the Bank of Japan Deputy Governor, which we told you about. And as a result, let's look at what's happening with the implied open for the Indian markets. The GIFT Nifty will also be looking pretty positive. So you're looking at a 243 point increase possibly on opening on the GIFT Nifty as well. Just looking at the fund flows from yesterday, and this is an interesting pattern. Just a complete balance between foreign investors and domestic investors. Foreign investors have been selling and domestic investors coming in and buying almost the same amount and sort of cancelling that effect out. So 3,531 crores of sales by foreign investors and domestic investors have bought 3,357 crores. All in all, I would say a pretty good setup for the morning, which has gotten only sweeter from the comments of Bank of Japan. And, this is something that we spoke about how regulators and what they say is not necessarily a line carved in stone, patthar ki lakir. Sometimes they have to come back and soften the blow a little bit.
Yeah, some bit of that has happened across the board. In fact, it'll be great to get an comment from Koon Go. He's head of Asia Research at ANZ Research. He joins us right now to talk about that and more. Koon, thanks so much for joining in. Good morning to you as well. BOJ spurred some bit of appetite in the bulls this morning across the Asian landscape, though US markets didn't end too badly either. What's your sense of what happens to risk assets in the near term until the Fed meeting is out of the way?
Good morning to you. I think the Bank of Japan has clearly come out to try and calm markets. It has worked so far, but I think the Bank of Japan still has a lot of work to do because, in my mind, they are behind the curve. I mean, Japan has finally defeated deflation after 3 or 4 decades. Policy rates, even after the recent move at 25 basis points, is still well below where it should be, given that inflation in Japan is over 2.5%. But they have to tread very carefully, and we've seen the carnage in markets that occurred when they outlined their path to normalization. Of course, they have to tread carefully, but I think it will be a mistake for them to completely abandon their normalization path just because we got some turmoil in markets.
Koon, hi, it's also Samina joining in. Do you feel like it might be a good time to invest in risk-off assets for the near to medium term? I'm talking about gold, I'm talking about silver, I'm talking about debt.
I think you have to distinguish between what's happening with the unwinding of the yen carry trade with what's happening on the real economy, particularly in the US. Because there are several factors that have intertwined together which triggered this sell-off. The unwinding of the yen carry trade is tied to the BOJ normalization, the recession concerns after last Friday's payrolls number, and the geopolitical concerns, as you mentioned earlier, about the potential retaliation. Now, in terms of the US economy, I think that's still really important in terms of whether or not we're going to see a risk appetite continue to be sustained. Now, my view is that the US economy is not going to go into recession. I think one data point is not indicative of that. And I'm still on the camp of a soft landing in the US. So if that starts to play out, then we could start to see risk appetite return. I think we'll see markets pare back the aggressive rate cut expectations from the Fed. And I think, we'll see, an ongoing calmness return to markets. I think for the geopolitical front, I think we'll just have to wait and see what happens. But I think as of now, it looks like the worst concerns have been allayed. There might be some retaliation, but nothing major that will trigger an all-out war in the region.
Right. Koon, also one question, taking a cue from what you said. There were some reports that I came across which said that the Fed will now have to tread carefully and not come down too heavily with aggressive rate cuts, because that would make the unwinding of the Japanese carry trade far worse. Do you feel like while the economy may need aggressive rate cuts, the equity markets may not be too pleased in context of what's happening on the Japanese currency carry trade unwind, potentially meaning that there could be delay or lesser or fewer rate cuts over the course of the next 6 to 8 months, which stock markets may or may not like?
Yeah, so for the Fed, they definitely have to tread carefully. But ultimately, the Fed's decision will be based on where they see the trajectory for inflation and the real economy in the US. They will take into account what's happening in financial markets, but they're not going to be, bullied into adjusting policy rates just because we see some financial market turmoil. Now, my view is the US economy is still in reasonable shape. And if indeed we are heading for only a soft landing and no recession, then the Fed can take measured easings, nothing aggressive, 25 basis point steps starting from September. And ultimately for markets, I think that should be taken as a positive step, because if there are no recession fears, then I think we'll see calmness return and so investors starting to dip their toes back into risk assets.
Hi, Tamanna here. Just to get a sense of how all of this plays out for emerging markets. And also at the end of the day, the biggest question I think our viewers right now want to know is whether the worst of the impact we saw because of Bank of Japan's actions is over. Are these statements enough to calm the storm for now?
Look, I believe that the carry trade unwind is not completely over.
Okay.
But I would say that the worst of the turmoil as a result of the yen carry trade unwind is probably past us. I think we've moved past the panic and liquidation mode of it. But there's further unwinding to go because the yen carry trade built up over a long period of time. So you can't expect a complete unwind in just a few trading sessions. Having said that, I think the further unwinding should be a lot more orderly. And this will, as long as markets are calm, that will allow investors to continue to pare back their positions and unwind leverage without causing excessive volatility. I think the other thing we have to also bear in mind, particularly for emerging markets and in this particular case for India, the yen carry trade involves two parties. One is using yen as a funding currency. The question is, what do they use the leverage to invest in? And in this case, in terms of the yen carry trade, and INR has actually been a favorite longs amongst investors. I think that's why you've seen the Indian rupee significantly underperform. That's why the rupee had been hitting all-time lows, because part of the yen carry trade unwind actually has hit the rupee as well, because funds that were long Indian assets, particularly long the rupee for the carry, were being forced to unwind those positions, which is why you've seen the rupee pretty much among the only Asian currency to weaken amidst the turmoil that we've seen so far this week.
Okay, wait, let me just, I don't know if I got that correctly. You're saying that India is relatively more stable among the Asian markets in terms of the turmoil we saw this week. Did I get that correctly, Koon?
Now, I'm saying that the rupee had been hit because of the unwinding of the yen carry trade. That's why the rupee had weakened to all-time lows.
Yeah.
So the rupee had not been immune to it. In fact, it had been, I would say, partly a casualty to the yen carry trade unwind.
Thank you so much for speaking with us today, Koon Goh, there, Head of Asia Research at ANZ, and giving us a sense of what's next. I thought the big takeaway here that the entire turmoil of the yen carry trade factor is not done yet, but the worst perhaps is over. And from the Indian market's perspective, it definitely seems we've moved on fairly comfortably.
Yeah, though, I mean, just the way we came off yesterday might make people believe that is this still a sell the rise market as opposed to buy the dip? I mean, we were talking about buy the dip being tested 2 days of turmoil, and is the market thinking sell the rise? Because if you look at the trade setup and what technical traders have cited all through yesterday, post-market hours, is that a zone of 24,200 to 24,300 now becomes that zone where day traders might be tempted to come out and short the market. Since the fears are not out of the way, we've seen the template yesterday. Could that get repeated today, or could today be different now that BOJ action has happened? So that's the one part. Remember, viewers, if you are trading and if you're not on the front of a screen and don't follow stop losses on your shorts, even that might be in for a rough ride. So be careful if you're doing that. I somehow just feel that ahead of the MPC meet decision, and there may not be a decision per se, but ahead of the MPC decision, we might not see a very sparkling rally in Bank Nifty. And might be wrong, who knows, but really difficult to see that happening. So be careful on the Bank Nifty trades in particular. Yesterday the Bank Nifty didn't necessarily have the best of outings. And just looking at the landscape, save for a Gland Pharma today, but otherwise pharmaceuticals and chemicals seem to be the two pockets wherein the delivery of numbers relative to expectations and the commentary from companies seems to be strong. So do watch out for that bucket in particular, because unlike defense, wherein the commentary is strong but the valuations are expensive, these boys don't necessarily have the most expensive valuations coupled with strong commentary. So maybe that's a bucket you want to keep an eye out for.
And it does seem like the markets are spending some time consolidating as well. Remember, we made record highs very recently. 25,000 was hit on the index. There's not too much change in the put and call data as well. So activity, maximum call OI remains at levels of 25,000 on the Nifty as well. So there are factors, of course. It could be a sell on rally, buy the dip, anybody's guess. But what we do know is that the texture of the market may be that we may spend some time consolidating. Sector rotation, stock-specific trade could continue to drive intraday traders and market activity. Lots of earnings and a whole bunch of good earnings from the pharmaceutical pack that I have this morning. I will start with a few that are catching my attention, then we'll go into the other ones as well. But let's start with how well Fortis has done. Their revenues were up 12.2% at 1,858 crores. EBITDA was up 26%. Margins have expanded nearly 2% to come in at 18.4 versus 16.4. Net profit was up a significant 40% at 173 crores versus 123.95. Let's tell you what stood out for Fortis in this quarter. The revenue growth in hospital business was led by increase in average revenue per occupied bed. So the amount of money that they make on the beds that are occupied by their patients has seen an increase this quarter. It's up about 9.7%, and that, of course, is a positive, coming in at 2.41 crores. That's the number you're watching out for. Occupancy also for the quarter has improved for Fortis. They've also talked about adding more capacity. They're looking to add 700 new beds going ahead. In terms of the diagnostic business, the performance was okay. It was rather muted. So quarter on quarter, there's no significant growth. Year on year as well, in terms of the diagnostic business, remains largely flat. That's because they've undertaken a rebranding exercise in 2023. So that's got to do with Fortis. Good numbers. Markets will be pleased. The stock should be getting a positive reaction in early trade. The other one that's done well is Lupin. All in all, good numbers. Revenues were up 16%. EBITDA was up 50%. Margins have also improved to 23% from 17.8. So another 6% jump in margins. That's a significant jump coming in on margins for Lupin. So that could be a big figure. Even though Bloomberg had estimated that, that number would be 20%. So it's a beat in terms of expectations and a big jump when you look at it year on year as well. Net profit also up 78% for the year. Let's tell you what the key highlights was. Their businesses across the world have grown. India has done well. That's grown 18% YOY. The US business has grown a significant 25% YOY and 8% quarter on quarter. So growth was led by new launches and was offset by single-digit price erosion in base products. So while some products went through a price correction, the fact remains that they've managed to sell more generally on back of new launches. Share of their complex portfolio to sales, which is a higher profit or higher margin business, has increased to 35%. So good earnings from Lupin and Fortis is what we have. The other one that stood out for me this morning was Cummins India. Largely, numbers were above what the street was expecting. Revenue was up, EBITDA was up 38%. Margins again have improved significantly at 20.4 versus 15.4. So 5% improvement in margins, and net profits are up 30%. Domestic business has done really well. What has suffered for them is exports. So exports of Cummins India was slightly muted, and their power gen revenue was muted considering the sunsetting of CPCB clause. On back of the clauses that are coming in terms of energy, power gen was slightly lower. But going ahead, management indicates that exports and power gen should both pick up. That, along with domestic business, should help support growth for the rest of FY25. So all three numbers I have this morning, guys. Good earnings and very good margins. I mean, you're seeing Lupin expanding, 6-7%, Cummins 5%. And Fortis also not too bad, 5% expansion on margins. So operational efficiency, selling more, it's looking good.
Yeah. Two of the three numbers I have are also looking pretty good. I'm going to start with Tata Power. Tata Power numbers are good. Strong quarter for the power player. The earnings have beaten Bloomberg estimates on all counts. So revenues were up 13.7%, EBITDA up 22%. Margins have also gone up, expanded from 19.3% to 20.7%, and net profit up 4%. So now, where are the drivers coming in from? The renewable business has been good, grown by about 14%. Transmission and distribution business has grown 55% year on year. So that's the big one. But business growth has also been has managed to offset the large fall in coal profits. And remember, coal prices have been an issue. The solar segment also caught my eye. I thought that was interesting. The solar utility contracts which they have got the order book is now at 13,018 crores. The third-party rooftop order book is for 567 crores. And this point I thought was important, that the company is gunning for about 20% market share in the residential solar rooftop segment. Now, put this in the context of the government scheme to, really encourage people to have solar rooftops and bring zero electricity bills. So Tata Power could be a big beneficiary of that. Positive quarter, and you could see a positive response on the stock as well. Chambal Fertilizers is another one. Pretty decent and good set of numbers. Profits up 32%. Revenues, though, have slipped by about 11.7%, so a bit of a slide there. But the EBITDA and the margins, that is earnings and margins, are pretty decent. Earnings are up 18%, margins have gone up from 11.3% to 15.2%, so that would be seen as a positive. Now, Bata India is one of those companies which have seen pain consistently quarter and quarter. So in that sense, this quarter is no different. You'll see a net profit positive number, but that's because of an exceptional gain due to a land sale that they did this quarter, and they got 134 crores for it. Otherwise, their earnings are down 23%. Their margins are down at 19.6, so dropped from 24.9%. Profits are looking good because of that land sale. Bata has been a difficult story, and that difficulty, I would say, continues, at least for this particular company in India. Yeah.
Yep. Okay. Quick three stocks from my end, and VIP is the first one because the sorry state of poor reportage continues for VIP. Revenues flat at 0.5. Up 0.5% at 639. The estimates were 688 crores. Margins at 7.7 versus 12.7%. Look at the drop in margins. The estimates were 11.6%. And profit after tax down a whopping 95%. 4 crores versus 77. They had a weak quarter, the previous one too. So watch out for VIP. Very likely could correct in the session today. So that's the first one to watch out for. Gland is the other one, which could actually see a bit of a corrective move in the session today. Revenues were up 16%, but lower than estimates. However, margins 18.9 versus 24.3. Estimates were 23.6%. And PAT down 26% at 144 crores versus 214 crores. Everybody has down, or most people have downgraded the stock or cut the target price, if you will. Citi has a sell with the target price of 1310, which is about a 30% downside, because they say there's a 26% EBITDA miss as the base business, which is injectable sales, has declined, and they are seeing competitive intensity. But lest you feel that I'm only bringing bad news, the last stock from my end today is PI Industries. We're speaking of margin expansion, this one too. And for that business to show the margin expansion, revenues up 8%, which is fine, but EBITDA margin at 28.2 versus 24.5. And PAT up 17% at 449 crores. Splendid numbers.
I think talking about margin expansion, and I think we've seen this significantly amongst the broader market names, maybe there is some merit to understand whether this is simply operational efficiency or companies being able to sell high margin products. Because if it is operational efficiency, you're going into the rest of the year with a very well-oiled company, and then you're going to be selling more. So you may be setting up yourself for actually better margins, better profits, and a better looking setup. But a couple of more, I'll quickly add 3 more companies that have EIH. Profits have declined, revenues have grown, the number not looking too great. Rain Industry has reported a loss. So this one could be on the sell side this morning. They've reported a loss versus a profit of 206. The loss this time was about 44 crores. Revenues have also fallen 11%. Another big company that we forgot to mention is Bosch. Profits have grown 14% and revenues are up 4%. So Bosch good numbers, Rain is a loss, and EIH is a mixed bag.
And I would think the big story this morning is what's going to happen in real estate. We already saw the run-up yesterday on expectations that there would be some softening on the indexation rule that came in the budget, which would impact long-term capital gains tax and how it is calculated. Now it's clear that amendments will be made to the finance bill. In fact, Ghulam Zia, Senior Executive Director at Knight Frank India, is joining us for more perspective on this. Ghulam, very good morning, and thank you so much for speaking to us this morning. I just want to understand whether this is really a big positive for the real estate sector and real estate companies. And I'm asking this because when the news first came that indexation will be removed, but the long-term capital gains tax brought down from 20 to 12.5%, everyone across the industry said it won't make too much of a difference. So, which is why I'm wondering if it's actually that big a relief.
Good morning, Tamanna. From investors' perspective, those who are looking at buying property today onwards, there is hardly any difference, because in any case, the grandfather clause that you're talking about is applicable for all the previous cases. From here onwards, the cases are different. And today, when you're buying a property, you are taking into account whatever is the new rule for LTCG calculation. It was only the cases which have happened earlier is where the problem was. So in any case, the industry or the sales number were not impacted because of the new changes, and neither would it have any material gain or impact on the situation going forward. The rule was only for the retrospective impact, which has been clear today.
Having said that, it will obviously be a sentimental boost, Ghulam, and I'm sure you've looked at all of the options. You can either go by the indexation benefit and pay a 20% tax if you have a property before July 23rd, or you can give up the indexation benefit and pay a 12.5% tax. Now, obviously, anyone who is selling such property will go to their accountant or their financial advisor and do the math. But broadly, what are the scenarios which could come about because of this?
See, the difference due to indexation, you would be actually benefited if your property gains are huge. Like assuming you have taken a property, say about 15, 20 years back, and the gain is at least about 3x or 2.5, 3x, etc. Then going for indexation, taking the benefit of depreciation, you would stand to gain. But if you are going for the new rule, the new regime that you're talking about, the new regime considers that you're making good gains year after year. And that was actually the bone of contention. When earlier also the finance secretary spoke about an average of about 14% gain per year in property prices, that was the biggest issue. Because when you consider that, you're not really taking into account the cyclic nature of real estate. And that is when it's actually not really advisable to pull out the indexation if the gains are not high. And going forward, of course, it normalizes. But then for the past cases, the retrospective impact cases, wherever there's a huge gap between what you bought and what you sell at, you're getting at least about 2.5 to 3x. I have come across cases where the difference between the indexation method and the new method was as much as 10x and more. So obviously it was a huge impact, and that change that was brought about now, recently, last night, is actually clarifying that during the movement from old case to new case, the transit period is where the new rules have come up, and it's a very welcome change.
Ghulam, just very quickly, and this is what we've been debating, and I think Tamanna also did try to ask you that question when he started this conversation. There are states like, in the south, for example, where the appreciation has been significant because a lot of the property there has been ancestral property. In a situation such as this, and I know you're no tax expert, and this would be best advised, and an individual should take that advice from their tax expert. Do you feel like if there's a significant jump in the value of the property, sticking with the old regime may be a better option than picking a lower tax regime without indexation?
Indeed. And that's exactly what I was trying to clarify a short while back. That if you're talking about those specific cases in South Mumbai, in Bangalore, etc., where the gains are huge, in the long-term capital gains that you are accruing are huge, in that case, indexation is required. What I was talking about is assuming that you have taken it, say, about 5-7 years back, and which is not possible because in 7 years, the property prices have remained stable if you don't look at last 2 years. So overall, the gains will be, when you're talking about last 15 to 18 years, where you would see 2x, 3x, 4x gains. And that is when the difference, if you're not taking indexation into account, you will end up paying more than 10x of what you would pay otherwise. So that's where it is, clarifying it, that only in the old cases, this was the situation. In the last 2-3 years, if you have bought anything, you are not be really impacted much.
This is we need to break this down further. But thank you right now for your time, Ghulam Zia. There, just breaking it down, saying that it is making no difference to anyone who is looking to buy property from here on. But remember, the concern was always for those who have property from before. A lot of Indian households invest in property, inherit property. There's ancestral property, so all of that was getting fairly complicated and frankly a bit controversial as well. So that has been put paid to right now, and that is the big takeaway. Thank you so much, Ghulam, for speaking with you. Always a pleasure. We'll take a very short break. On the other side, Agam Akil joins in and talks about the F&O setup for the day.
Hello and welcome. This is India Market Open. I'm Agam Vakil and we'll take you through all that's happened yesterday. We started off with some strength, but that was sold into, and eventually we saw the benchmark, the Nifty 50, close with declines of about 0.25%. Along with that, when it comes to what we're keeping an eye on, well, let's take a look at how things are faring as far as the space is concerned. So, well, we closed below 24,000, so just a matter of concern, but we still have a lot of puts there being written. A lot of unwinding as well. Moving on to the Bank Nifty, again, that's where we're seeing a little bit more traction coming through. Today, of course, is a Bank Nifty weekly options expiry, so there will be a little bit more volatility here as well. We saw shorts as far as the August futures are concerned. Speaking of the options market, now let's take a look at that. Of course, 24,000 becomes a little bit more important. But remember, yesterday we were suggesting that 24,000 will become the pivot point more than a support region. We've closed below that, and it remains that the area around which you continue to see the Nifty catapult upwards or downwards. Of course, as far as the Bank Nifty is concerned, today it does seem like 50,000 will be that important level to keep an eye on, and I reckon a lot of trade will be concentrated around that particular level. While there was weakness in the markets yesterday, there were more longs as compared to shorts as far as the futures and options space is concerned. So you did have Golden Consumers, Deepak Nitrite and Torrent Pharma advancing and making longs coming through. Among stocks which saw unwinding, again, about a short covering for UBL and Navin Fluorine. Shree Cement, Ashok Leyland and Hindustan Copper looking at long unwinding. But while we are traversing this volatile period, how are we looking at stocks and, what's the way forward here? Well, let's get in Aditya Arora of Athletic.in, who's joining us on the show right now. Aditya, good morning. Thank you so much for joining in. Let's start with your view on the benchmarks. How are things expected to pan out?
Very good morning to you and to everyone. Look, markets look good today on strong global cues. We are seeing Japanese market up about 6% today. So that is giving good, positive sentiment spillover to various markets across the globe. But technically, if we look, then today is the day to have positive bias initially. But going forward, I think around 51,000 on Bank Nifty and 51,500 on Bank Nifty futures, 51,000 to 51,500 is the zone to go a little light because over there, a lot of call writers are active. So one should watch out for, booking profit or also, look for opportunities to build short if market is getting dragged over there or, is drifting down around those mark 51,000, 51,500. So I think what we are seeing today is pullback within a medium-term downtrend which might have started. So I think the strategy would be to go short on the market on good bounces and to build short at resistance levels.
Okay, Aditya, so let's start with Cipla then. How are you trading Cipla and what are your observations here?
I think Cipla is a good candidate on the bullish side, and yesterday we saw good outperformance in Nifty Pharma space and Nifty FMCG space. So this is the space where institutions are getting aggressive and bullish, and it's also a good hiding space we have seen in the past. So one can go long in Cipla through a bullish strategy. They can buy 1540 call at 32.65 and sell 1560 call at 24.50. Maximum loss potential is 5298 and maximum profit potential is 7702. So it's basically a bullish strategy. If stock trends up, one makes money.
A bull call spread for Cipla and Aditya, a bull call spread for Britannia as well?
Correct. I think Britannia did very well yesterday, and that was the biggest gainer yesterday in FMCG basket. So one can go long over here as well. One can, buy 5900 call at 115.60 and sell 6,000 call at 75.50. Maximum loss potential is 8020 and maximum profit potential is 11,980.
Okay, so there you have it. That's a similar strategy on Britannia as well. Aditya, on that note, thank you for joining us and taking us through your view on the benchmarks. It's going to be a challenging period for the Nifty and the Bank Nifty, and also providing us with those calls on Cipla and Britannia. With that, it's back to you all.
Thank you. Thanks, Agam, for that. That's, of course, today's day of trade. It's going to be an important one. Volatile for sure. Clues from world markets are positive this morning, and they seem, of course, they were also positive yesterday. But the hope is that this gain will not get sold into in today's day of trade. The breadth of the market will be important to track as well in terms of F&O activity. Action continues to remain at levels of 25,000 on the upside and 23,800 on the downside. So that is the trading range that market participants will be tracking very closely. But there's been so much development last evening. We will, of course, talk about that in a minute. There is a proposal, in fact, that Sajid is joining us to talk to us about. But before I go into that, Aditya Arora, founder and okay, I believe
he was doing the F&O piece.
Okay. Oh, so my bad.
So he's
my
done.
bad. So Sajid, you want to quickly comment on tighter FPI norms. What is the proposal? We keep revisiting P notes and have done so in the recent past. What is the proposal right now? What does it mean for participants? Does it mean anything for the derivative market at whole?
So I think Sebi has been gradually chipping off the advantages a P note or offshore derivative instrument, has over a direct FPI which is coming into the market. now, for people to understand what does mean, it basically means that a foreign investor can directly come and register with Sebi and invest in the Indian markets, cash market, F&O markets, and others, or they can come into a jurisdiction and through a registered FPI. They can come into the market. So in that case, that the subscriber of the ODI, which is offshore derivative instrument, the issuer for that is a foreign portfolio investor, which is registered in India, but the subscriber doesn't need to register himself with Sebi. It's the responsibility of the FPI, which is to take care of the KYC, beneficial ownership, all those things which is there. Over a period of time, at some point in time, 44% of the total foreign investors or outstanding AUM was coming through P notes. Now it has fallen to 2.5%.
Okay.
So it's very minuscule in that sense. But what Sebi has now done, especially after the Hindenburg issue, is that they found that if there are certain loopholes which are there in the market, and that loopholes have been closed, gradually. For one, FPIs, are now supposed to disclose the beneficial ownership if their fund has more than 50% of AUM allocated to any Indian corporate group, or they have to disclose everything if their total asset under management in the entire FPI is more than 25,000 crores. If you are not going to disclose, then you have to redeem those investments and exit the market. And Sebi has given them 6 months to a year to do that, and many of them are following. But this regulation is exempted for ODIs. So what Sebi is now saying,
overseas derivative
instruments, or subscribers of those instruments, people who are coming to using those instruments into the Indian markets. Now Sebi is now proposing is that they are going to keep the same regulation for them as well, which basically means that the regulatory arbitrage which was there, the benefit which was there for investors without registration is now going to go away in that sense.
So if I was to put this in simple terms, is it fair to say that Sebi is finally shutting the tap fully of foreign inflows where the source cannot be clearly identified? Would that be one way to look at it?
No, the thing is that there are still investors who wouldn't want to go through the registration routes, and they would like to come via the ODI route. But what Sebi is saying that I am not giving you the incentive any longer.
That's what I'm saying. So Sebi is shutting the tap.
But you will still see the investors coming directly into the cash market. The bigger issue which is now coming in is with respect to the derivative market which is there now. If you look at the data which has been shared by the regulator, there's hardly any derivative exposure for those ODIs in India. But there was always that provision that if you're taking exposure to an Indian market, then you can do a hedge for that same in the Indian market, in the F&O market, basically. Now that hedge has been removed, so there is something which is now going to come in that you will not be allowed to do any derivative hedges. Your hedges have to be on cash market or in government debt or any other thing, but not derivative which is there. Plus, we recently saw a case where you had that Kingdom Capital coming through, coming into India and investing through the Kotak Fund, which is an FPI, which is there. Then that was a segregated fund, and it was acting like a prop book as well. So all those routes have been closed with this proposal. There is now you will have to provide beneficial ownership till the segregated fund level. Earlier it was only at the top level. Now it's gone down to the segregated pool, and you have to provide all those information, and then proprietary trades are not allowed to be done undertaken through that. So it's basically a tightening mechanism. See, FPI is a more a sentimental thing.
So and right now all things F&O have a huge scanner on them. Thank you so much for that. So a ton of big stories to unpack today before we get to specific stocks and of course levels for the day. And the next big one is the relief on the indexation announcement made in the budget. Now, quick recap. In the budget, the finance minister had announced that indexation benefits which you get when you sell certain asset classes, including real estate, would be removed. And the long-term capital gains tax that you pay would be reduced from 20% to 12.5%. When I say indexation benefit, I mean that if you have a property that you have bought a very long time ago and you're selling it more recently, then the value of the property is calculated accounting for the amount of time you've held it and adjusted for inflation. That is indexation. Now that this has been reversed in a sense, and anything before July 23rd can have an indexation benefit, you have two options. What does it really mean? Pranav Saita, National Leader, International Tax and Transaction Services, EY India, is with us. So is Baman Rustam Irani, Chairman and Managing Director at Keystone Realtors. Welcome to both of you and thank you so much for speaking with us today. Mr. Saita, I'm going to come to you first just to understand what is the extent of benefit. Now, quite like the new tax and old tax regime, sellers will have an option to go in for the indexation plus higher tax or no indexation plus a lower tax. Is there a sort of back of the envelope calculation on which scenario works for whom?
Yeah, very good question. So essentially where the appreciation in the value of the immovable property has been very large relative to the cost. So if the property has appreciated very quickly and significantly, then that's where one would go with the 12.5% because the indexation benefit will not be that great. Indexation applies on the base of the original cost. And therefore, where the appreciation has been swift and large, one would go with the 12.5% tax. But where there is a large tax original cost base, and therefore the indexation benefit is significant, one would normally prefer the 20% with indexation option, or rather it's not even an option, they say whichever is lower will apply, so to say. And therefore I think large appreciation in a short period, 12.5%, but low cost base, or rather low cost base and large appreciation, where one would go with 12.5%, but if there's a high cost base, then one would try indexation because on the high cost base, the indexation benefit would also be very significant. So 20% would be okay paying because the indexation benefit would be significant. That's how I would look at it.
And wouldn't it matter how old the property is or how much time since that property has been acquired? How would that come into play?
Yes, very much. That would. But again, wherever the cost has been very, very small. So, for example, if I had acquired a property at a very small cost and the appreciation over the years, because the more the period that goes, the more the appreciation as well. So, therefore, if the appreciation is significant, then on a small cost base, no matter how much you apply indexation, even if you make it 5 times, for example, if the cost was, 5 lakhs and you apply even an indexation of 5 times, it means 500%, it would still add up to only 25 lakhs. And if the property has appreciated over a longer period of time, it would have appreciated even more. And therefore, sometimes you might be better off with 12.5% when the cost base is very low. So essentially, I think it's an arithmetic for each property. You are absolutely right. The period will matter, but it depends on the cost base very much so.
Saita, hi. It's also Samina joining in. Just one quick question. While now this is left in the hands of the homeowner to decide which tax regime to pick, do you feel like adding an element of subjectivity to this could complicate the process going ahead? And also, more importantly, it may get tough for the government to determine what sort of inflows it's going to be working with. I want to understand, giving the option to a homeowner, could that have any downside?
Right. I think from a taxpayer standpoint, this particular proposed amendment to the bill is not a disadvantage because it's just whichever is lower. He doesn't even have to do something to exercise it, very strictly speaking. The law simply says that the excess tax will be ignored, which means the lower of the two will apply. So I don't think he has too much to do, but yes, it does complicate. Your point is right, and that I think was the government's original plea in trying to defend what it was proposing in the original budget. That in order to simplify, there is, this is what we've done. But now I think they have heard the demands of the taxpayers. I think it's a very good step. It does certainly, to some extent, reduce the simplification story that was there in the original finance bill. But they have heard the requests and demands of taxpayers. This sounds to be more fair, and it builds an element of trust, because when taxpayers have, properties which they are holding up to 22nd July 24, to suddenly change the rules for older properties which have been acquired and held by the taxpayers without notice would be inappropriate, I thought. So this is like a grandfathering for all long-term capital assets which are land buildings acquired before 23rd July. That means up to 22nd July they are grandfathering and saying that whenever the property is sold, whether now in this financial year or any year in the future, they would give the benefit of this option. As I said, it's whichever is lower of the tax will apply. And I think therefore it builds that element of trust. It also is fair, which is what the government here is trying to do. I would really welcome this, though it slightly complicates matters for sure.
Oh, well, it gives a lot of work to see, that's for sure. But thank you so much, Mr. Saita, for joining us and putting that into perspective. So that's the tax angle. What about what it means for real estate companies? Because remember, we saw quite a run-up in the real estate pack on the hopes of exactly this happening. Baman Rustam Irani is also with us. He's Chairman and Managing Director at Keystone. Very good morning to you, Baman. I'm wondering if this changes things in any real way for real estate companies on ground, because whatever you sell from here on after 23rd July, anyway, doesn't matter. Attracts 12.5% long-term capital gains tax.
Perfectly well put by my esteemed friend before me. I think he went and spelled out exactly the fairness of what has been done. I think the last night's announcement is a celebration that the government does listen to the common man, and the voice of the common man is heard. What is going to happen is, there's going to be a lot of comfort in those who have bought properties earlier. I don't think the impact going forward is going to be anything other than positive. Government has made this an investment ability, investment ready asset when you're purchasing real estate, and I've brought down the tax to 12.5%. I think that is a great move. And of course, grandfathering everything to 23rd of July really puts a lot of peace in the minds of the people who may have been getting unnecessarily, if I may add the word, riled only because something was being taken away from them. Going forward, the simplicity would attract a lot more investments in real estate, and especially for those who are shorter-term investors, let's say 3 to 5 years, this would be a huge welcome move of the 12.5% tax.
Right. So that's definitely a welcome move. Government is listening, etc., sentimentally positive. I'm just wondering, in terms of actual margins, business, sales, sentiment, revenue, does any of that change or become better for you, Mr. Irani? Because the kind of up move we've seen in real estate stocks, considering all realtors came and said that there's no difference when indexation was removed, is there any difference now?
No. I think just giving the best of both worlds to the consumer only adds to bolsters their confidence of investing more in real estate. As far as I'm concerned, July numbers have been excellent in terms of MMR sales as such, and the buying trend continues. This just adds more people to the buying side, because now properties can be treated as an investment and be treated at par with any other investment that an investor was going to make. And let us not forget that this is the one real asset which one can use, enjoy, at the same point of time, be able to treat as an investment and get away with the 12.5% tax on it. I think it's a great move for all realtors.
Right. Very lastly, Mr. Rani, and I know there was some talk about this when there was that whole grey area around taxation and in removal of indexation. There was a sense that sale in the secondary market could have got limited. Now, with complete clarity and a subjective opinion where you can choose how you want to pay for tax, will there be any meaningful impact on the Mumbai real estate market?
That is such a great question and such an awesome way of looking at it. But when you were asking the question, I was just thinking people who are buying into newer apartments aren't buying it only for the price. They're buying it for the amenities. They're buying it for the space. They're buying for what that new home really affords to them. On the secondary side, the most sales that I have seen taking place are in buildings which are going in for redevelopment, where the existing member does not want to wait out the 3 to 5 years that it takes for a new home and then encashes on what they have and then goes and buys into a newer development. So really not sure. I don't think it'll have a major impact, but your question is very relevant and, it gives me food for thought.
Well, thank you very much, Mr. Rani. Good luck. Good luck with work. Good luck with business. We'll hopefully catch you soon. But up until then, it's good news if you're a homeowner and you were disappointed with what the budget did in terms of removing indexation on property, resale or taxation. Now, of course, the ball is in your court. The decision is yours completely, whether you pick the old regime or the new regime. So this is being applauded by the sector, by tax experts and, of course, homeowners as well. We'll take a break. Implied Nifty is indicating to an exciting start this morning, and it seems like this rally could stay at least in the first few hours of trade. So all that and more on the other side. Stay tuned.
Back with India Market Open right here on NDTV Profit. Now, full tilt towards the trade. A clutch of stocks are going to react, but more importantly, the implied open tells you there's a bit of a change in sentiment. Our experts are here with us. Technical, derivative, fundamentals. Kush Bohra, Chandan Taparya, Mayuresh Joshi. All of them to take us through the next 20-25 minutes of this. What promises to be a great morning. Gentlemen, all of you, thanks so much for joining in. Chandan, I'll start off with you. Based on the positions that may have been existing on the indices as well as maybe single stock futures as well, and the fact that BOJ has just changed the narrative a little bit. Once we start off, what do you expect? Could it be a sell-on rise or could there be forced short covering as well?
Good morning. Thanks for having me. So we have seen a profit booking decline of around 1200 points in last 4 trading sessions as Nifty corrected all the way from 25,078 to below 24,000 marks. The good part is that even after the corrective move of 1100, 1200 points, the Nifty managed to hold its 50-day exponential moving average. We have noticed that volatility index, the India VIX, which is spiked to 23, again came back to 18-19 zone. And CBOE weeks at US, which is spiked to 65, again came back to 38-35 zone. So decline in the volatility from the recent peak indicate that some sort of recovery could be there, but immediate structure is negated, so that's why the upside could be kept. So we have to play the bounce, but I believe the bounce will be kept. As of now, the broader range which we are looking is likely to in between 23,750 to 24,400 zone. So if it manages to hold 24,400, then only the bullish setup could be big. Otherwise, bounce could be kept. So we need to play the range between 23,750 to 24,400 zone. In the morning tick, if it manages to hold 24,200, then we can play a bounce of 200 points. But beyond that, we need to look back. We need to look at the next set of rally or next set of data internal in the market.
Right, you're right, Chandan. This is an interesting market, and we live in interesting times. Well, we all, of course, got very wound up that the markets had corrected over the last 2 days. Just to put that in perspective, we were really just 4% off our record high. So the nervousness maybe was a little overdone. A quick check. That's the pre-open number on your screen. Not looking bad at all. It looks actually very, very good. 400 odd points on the Nifty 50. We'll come back and take a check of it, but 1.5% higher is what the street or pre-open trade is indicating too. Chandan, how would you trade Bank Nifty? Because we've seen very interesting trends emerging. June, the month belonged to Bank Nifty. Come July, Bank Nifty took a back seat, and just when they started participating, the Nifty made a record high and you had the global sell-off. As we look at Bank Nifty this morning, do you feel like there's an opportunity to construct a long trade on Bank Nifty for the August series?
So Bank Nifty already has been making lower top, lower bottom and forming the lower highs from last 5-6 weeks. The Bank Nifty has taken hurdle at the rising channel, which is working well from last 2.5-3 years. And clearly we have witnessed some underperformance here. And that is the reason that in the recent past, in last 4 days, we have not seen major reaction or major corrections, because already the profit booking was visible in this rate sensitive index. However, the concern is that it's drifted below is 50-day exponential moving average, forming lower highs, lower lows. So till it remains below 50,500 zone, I don't believe that any meaningful bounce could be there. Till it holds below 50,500, bounce could be sold, and major support for the banking index comes at 49,000 to 48,888. So for range as of now is likely to be in between 49,000 to 50,750 or 50,500. If it surpasses, then only the stability could be back in the banking index. If I look at the mechanical indicator, it is trading in the sloping channel or sloping trend line. So till that not surpass, I believe we need to look at the selective move. And I believe because of this setup, the focus should be shift towards selective heavyweights and counter from the pharma and the FMCG space.
Okay. 13 minutes to market open, and we have a clutch of stocks to discuss as well. Kush, can I request you to give a specific strategy on the Bank Nifty for this morning? We'll avoid the Nifty call with the paucity of time. The Bank Nifty you are trading, Kush, what would be the strategy today?
Sure, Niraj. We may have these rebounds given kind of, the sell-off that we've seen. Bank Nifty PCR, if you see, has actually gone into an oversold territory of 0.57. So there could be these rebounds. But yes, what could happen is that the rebound could be sold into. The near-term trade will be negated once 51,000 and on a slightly higher range, 51,500 is taken out. So if you have a short position, my suggestion is continue to hold that short position till the time the highs of the last 2 days, which is close to 50,700, is taken out. So continue holding short positions. We might look for intraday shorting opportunities as well, but that as the day progresses.
Mayuresh, very quickly, we've got a whole bunch of pretty solid earnings, and I'm going to start with my bunch because they were actually pretty good. Lupin, Fortis, and Cummins. All three companies have registered better than expected earnings. They've all shown improvement in margins and significant improvement in margins. I'm assuming it's not just operational efficiency, but they've managed to sell more higher margin products. How do you view Lupin, Fortis, and Cummins? Any of these stocks that you would strategically add to your portfolio today?
Morning, Samina. So as a clear disclaimer, we continue holding Lupin in our global portfolios. Solid set of numbers. But obviously, I think the price action over the past few months is indicating what the earnings is expected to come through. And therefore, I think it is gestated by the markets, in my opinion, that earnings will continue to remain tactically strong. What happens in terms of the product profile and introduction of new products, specifically for pharma companies, is going to be a game changer in terms of their earnings trajectory. So I think Lupin has the right ingredients which they're probably having in play. So we continue with our old recommendations on that. For humans, I think the numbers were decent, but again, I think the run-up and valuations are a bit too expensive at this juncture. Obviously, I think any decline, specifically in these capital good stocks, would be a welcome opportunity. Whether that comes or not is a different story.
Okay, so those were a few names. Cummins was interesting simply because the power gen segment, contrary to what the parent had guided to, which will be a decline, actually showed an uptick, which is very impressive. And let's see. But remember, Cummins, ABB, and I think Siemens were the three stocks that I think UBS downgraded in trade yesterday on expensive valuations. So it'll be interesting to see what they do in the session today. And sorry, you were saying?
I think, Niraj, if it's about valuations, 3/4 of our market should be downgraded. Right? I mean, given how expensive everything is
That's
today.
True. That's true. Well, it'll be interesting to see also because ABB numbers come out, I think, tomorrow or day after. So then we will have the whole bucket of names, Honeywell, Cummins, and ABB out. Siemens left maybe. It'll be interesting to see what happens. But speaking of upsides, guys, because we're talking about great margins otherwise, there is this very optimistic note that Nuvama has come out today on JTL Industries. And Harsh Johnson to talk about that. Harsh, what's the upside? 20%, 30%, 40%? Or more?
It's 48%, Niraj, to be frank. So it's very strong upside. 303 being the target price. The stock in pre-market is up 6%. Now, just to try and break this down a little bit, capacity expansion, both organic as well as inorganic, likely to aid the numbers going forward. This one has been a solid compounder over the last 5 years already. We've seen 40% plus on all three, volumes, EBITDA, as well as PAT, CAGR, compounded annual, for all of these three absolute numbers. So we've seen very strong growth already. And the expectation is that will continue to be the case. What does the company do? It's the fastest growing steel tube manufacturer in India, both on volumes as well as margins. Nuvama expects it to continue to deliver very strong numbers. Profits are expected to continue to compound. 38% is what Nuvama is projecting in terms of profit compounding over FY24 to 27. Also, they are expecting value-added products to likely aid all the numbers across the board, including the margin number. And that should take the EBITDA per ton to 7,000 rupees by FY28. That's management guidance. So basis that, Nuvama is quite constructive on the company itself. They are ascribing a valuation of 25 times Q1 FY27 earnings, and they are suggesting that this is a 35% discount to the industry leader, and therefore they believe that there's margin of safety as well as comfort on this one. And despite that, a 48% upside, of course, basis yesterday's close on this one.
Right, thank you for that, Harsh. Quite an astonishing upside over there. Let me ask Chandan if he tracks this company at all, JTL. Is it looking interesting to you today, Chandan?
So, yeah, I think some sort of recovery could be there, but we need to look at the key important setup here. If I look at the price behavior, we witnessed some sort of recovery from the lower levels after the weak structure of last 15 days. But the good part is it has seen a bullish crossover from its oversold territory. So because of that, some recovery could be there. I believe with support of 205, the stock has potential to spike towards 225 to 230 zone.
And what about your top picks for this morning, Chandan? Let's come to that.
Yeah, so again, I'll focus on defensive name with the view of market volatility. I believe selective pharma and FMCG counter need to be on radar. And the first pick will be buy on Hindustan Unilever. Major trend of the counter is positive. It has given a consolidation breakout of last 10-12 days with a decisive hold above 2750 marks. So I believe with support of 2680, one can buy for an upside target towards 2900 level. Apart from Hindustan Unilever, one need to focus on selective pharma name. I'll focus on Syngene. One can buy in delivery with support of around 805. It can rally towards 850 to 860 levels. So Hindustan Unilever and Syngene will be two preferred idea from FMCG and the pharma pick, looking at the market volatility.
Okay, interesting strategy, a defensive play. Considering that markets are fairly volatile, looking like they will open up though. Kush, morning. What are your topics for today?
Well, Tamanna, if you found that interesting, I'll add a couple more to that list. Some more defensives. Ipca Labs. This stock's actually been doing well for a while now, and we've seen a very smart recovery. It's once again in that congestion zone, but I think the kind of momentum we've seen yesterday could take it higher to 1345, 1370 kind of levels. 1295 being your stop loss. The other one is Strides Pharma. Vertical rise, practically a vertical rally. If you see, from a little, if you could, dial the clock back a little, around 2023, the stocks actually gained about 3 times. Despite that, the momentum is intact. The volumes are intact. I think it's a very good positional bet also. But from a near-term perspective, if someone wants to consider as a trading bet, then 1095, 1110 are the targets that you look at, and 1035 is where you place your stop loss.
Right. That's the call coming in on some of those trading strategies coming in from Chandan and Kush. Well, a couple of stocks that may take it to the chin is going to be Gland Pharma, Bata India. Both those counters reported earnings that were slightly disappointing. You want to come on then, Chandan? How does Gland look in Bata India and EIH? If you do get a gap down on these stocks, would you initiate a trading strategy? Maybe an intraday, maybe a short-term trade. I'll leave it to you, either on the short side or the long side.
So Bata India looks weak. The stock has fell to continuous momentum in this week and corrected from 1632 all the way to 1450, 1500 zone. It has broken its key moving averages, and because of that, some profit booking could be there as major trend has shifted lower. So I believe with hurdle at 1520, one can look for a downside move towards 1420 to 1400 levels in Bata. Talking about Gland, I believe let it find some support near 1970, 1980 zone to go for buy on decline or bargain hunting in the counter.
Well, Gland, the downsides are from some brokerages to the tune of 30%. So bear that in mind. I also want to see what VIP is up to now that the pre-open rates have settled, because this is a set of bad numbers. VIP, though not correcting as much, because remember, the stock has had a bit of a fall already. Now, Mayuresh, it was interesting because at a point of time when the people are holidaying left, right, center, some of the other peers are doing well. VIP, due to problems of its own, is not quite able to deliver. If you had it in your portfolio, would you boot it out and replace it with something else?
So we don't have it as a disclaimer, Niraj, but yes, it has problems of its own. You're absolutely right. Numbers are just not showing the traction that one really expects. Obviously, there is a lot of competition as far as soft luggage is concerned, specifically from the unorganized market. And therefore, I think the key triggers that VIP had embarked upon a few quarters back in terms of increasing its product suite as far as soft luggage is concerned, more trendy styles, on that part of the segment as well. I think it is facing some element of competition to that extent, and therefore the numbers not shaping up. What we really kept on the watch list, just to add to what Kush and Chandan were adding, FMCG does come to the foray, and therefore Jyoti Labs is something that we have on our watch list. Capacite Infra Projects is something that we also believe can be a good real estate proxy.
Are you bullish on real estate, Mayuresh? A bit of good news, sentimentally at least this morning, and you're already seeing some of those real estate names buzzing in pre-open, your Shobha, Macrotechs of the world. Are you bullish on this space?
Morning, Tamanna. I think the positive momentum will continue. So yeah, we remain optimistic, but developers have done their part. So anybody holding the core developers can continue holding. I think the ancillary space is something within the real estate cycle. We're at the fag end, around 2.5 years, with the assumption of a 6-7 year cycle. The ancillary stocks should now start showing some element of traction. And therefore, I think the kind of pain that these ancillary stocks have gone through, either in terms of volumes not picking up, input cost inflation, which hit their gross and operating margins. There is some element of respite on both these counts. And therefore, real estate ancillaries, stocks like Greenply as an example, Sarah, I just mentioned briefly, Capacite Infra, seems to be a good proxy for these real estate tips.
A view, if you have, Mayuresh, on TVS, numbers came in yesterday during trading hours, but very positive notes this morning. It's up in the pre-open session as well. Jefferies has a target price of 3,000 rupees. In terms of valuations, do you think there is still an upside there? Are you liking TVS?
No, so valuations, as Samina pointed out, I think 3/4 of the market, the valuations are through the roof, whether it's two-wheelers or four-wheelers. So TVS, Bajaj, Hero, the valuations are right up to the neck. So to that extent, yes, a decent set of numbers. So the expectations in terms of their EV portfolio for all these two-wheelers is something that the market is probably looking at over the next few quarters. New launches, expectations in terms of volumes picking up as these launches and product deliveries start taking place will probably mean some element of earnings that can still continue to remain strong. However, I think one must remember, Tamanna, that for a lot of these auto companies, they will be working out on a very high base for the last 2 years. So I think outperforming this higher base for the third year in a row plausibly seems to be a little bit difficult. But yes, I think earnings will continue to remain reasonably good for us. So anybody can hold on.
Noted. Okay. Well, that was on TVS, but here's the markets, and let's see the flurry of activity on open. Courtesy BOJ, well, about 284 points, right in the middle of that zone wherein people are saying there could be resistance. Let's see if we perk up further from this 1% uptick. Banks, about 1% too. I think all indices, because this is not a specific index-led news flow. Everything will bounce back. Maybe metals, maybe real estate could bounce a bit more. Let's wait and watch. Bring up the mid-cap and the small caps. I think they would do well. Metals are definitely up higher. Mid-cap index 1.65% higher. Small caps, which had cooled off completely yesterday after the 2% uptick, 1.7% higher. Holding out in the first 1 minute. Get the heat map up on the screen and show you what's moving and what's not. All 50 in the green. It's after a long time that we're seeing this. This may change in a bit, but all 50 in the green. IT, interestingly, and Infosys in particular, is leading the charge. That's a very interesting move. ONGC has some brokerage upgrades plus oil price uptick. So that can be one reason. Mahindra was beaten down yesterday as well, up about 2.5%. But IT clearly perking up in trade. There is strength in autos, which had massive shorts on Monday. And I think that bucket is coming back. There is strength in Adani Enterprises, up about a couple of percentage points. LTI, Mindtree, Adani Ports, Hindalco are some of the others. But I must say, it's a great screen after a really long time. All 50 in the green. I don't think we saw that in any day in this current calendar. Splendid start.
Splendid start after a couple of tough days. A bruising Monday and a volatile Tuesday. So you've had a pretty good start for Wednesday and in the broader markets as well. Let's just once again review what's happening on the broader markets space, because remember, that's where the vulnerabilities showed up when we saw the hit on Monday morning after a whole cycle of global downturn. And yes, absolutely, 1.5% on the Nifty mid-cap 150, the small cap index also looking fairly strong. All right, specific stocks. We've been talking about real estate since this morning. Big relief coming in on the indexation benefits which were taken away during the budget. Those are back. So some of those players doing well this morning. Sobha, Macrotech, Godrej Property, DLF. If you look at, that lot of stocks, all of them up in the green. Though, having said that, this is a day when a lot of stocks are buzzing. Godrej Properties also doing well ahead of their numbers. Now, Nuvama had a huge upside on JTL. We talked about that in our top brokerage call today. Target of 303. That stock about 4.5% up on JTL. Some earnings impact. So on the downside, negatively, I would pull up Bata, Gland Pharma, and Indigo Paint. All of these not doing very well this morning. Gland Pharma, the worst hit of that lot, at least. On the positives, I would see a Lupin, a PB Fintech. These are some which are doing fairly well this morning. Lupin nearly 3% up. So it's a mix of earnings. It's a recovery in IT and auto, definitely. I suppose sectorally, those spaces doing well. Samina, with the real estate chugging along.
Yeah, it's a day when the breadth of the market's actually really good. And I think I'm getting excited simply looking at all the Nifty 50 stocks trading positive. And that is a sign of a little bit of strength retaining in the markets in today's day of trade. Mid-cap, small cap, and of course the micro-cap index are all trading with a very clear positive bias. In terms of movers and shakers, they come from the earnings pack, the big gainers and the big losers largely focus around that. But of course, there is an aberration to that. You've got Safari Industries. If you can pull that one up, we'll tell you why we're pulling this stock up. It's up 8%. Now, there's nothing that's happened for Safari. What has happened is its VIP Industries has reported numbers that the street has been disappointed with, and it seems like a weak set of earnings for VIP could potentially be a gain for Safari. Safari up 8%, VIP down 2%. You've got PCBL, that's up 5%. TVS Motors, I think we mentioned that, the stock is up 5%. Suzlon, there seems to be no stopping on this one. Post its earnings, it's had maybe a handful of bad days, but generally speaking, the last 2 to 3 weeks for Suzlon have actually been phenomenal. The stock is eking another 4% this morning. You've got Oil India, that's up 4%, so good going for that one. Zomato, which has been on the buy side now, post the last, in fact, all the way through July, it's been on the buy side for a few weeks now. Yesterday, we saw some profits being taken off the table on Zomato, but it's back up and running. You've got about 3.5% on Zomato, nearly 260 back on the counter. Auto Ants is doing well, so if I can look at Samardhan Motherson Wiring, the stock is up 3%. Take a look at a few other earnings reactions. So Lupin, Fortis, Bosch, Cummins. If I can get those four stocks up, it should be helpful to get a sense of what the market is doing with them. Lupin is up 4%. Cummins is down 1.5%. So I think the market is slightly disappointed that the exports are softer than expected. But maybe that was not the reason. The fact that UBS has downgraded the stock because it's expensive could be a reason why you're not seeing too many gains rolling in for Cummins despite good earnings. A quick check on Fortis Healthcare, if I can get that one up too. Earnings were good. Their average revenue per bed has also improved, but despite that, the stock is not doing too much. It's rather flat. Rain Industries, if I can pull that too. Bosch, Rain are some of the other ones, and EIH reported numbers. Rain is down. KPR Mill is up 4%. That's one of your top gainers in the broader markets. EIH numbers are weak. The stock gets a 5% downtake. And you've also got Bosch, if I can pull that one, and Chambal Fertilizers. I think Tamanna mentioned that. But Bosch could be pulled up. And Gokuldas Export, a 10% up move yesterday and another 5% up move today. There is no direct impact. We spoke to the management yesterday whether the Bangladesh crisis could mean, there are buyers buying more from India as opposed to Bangladesh. And no such thing is a given just yet. But the market wants to get excited. The stock is up 5% again this morning. All in all, it's a good-looking market. Defensive stocks are sadly on the sell side. So Garden Reach, Cochin Shipyard are all trading with cuts of 3 to 4% this morning.
And one stock, Suzlon. I mean, they've done this acquisition worth 600 crores for a company which is in the good O&M space, and maybe that's why that stock is spurring. But, good to get in initial thoughts before we thank our guests. Chandan, to you first. Opening thoughts, you had mentioned that the upsides would be capped. Would you take money off the table if you had gone long yesterday on the benchmarks?
Yeah, I think nothing can be better than this in this market when we are getting some swings. And I think we are getting something, then better to take and be in the wait and watch mode. If market moves about 24,400, then again you can jump and look for the next leg of rally. Otherwise, let it cool down and find support at lower zone. But still, I believe that selective stocks one can focus, especially from the pharma and selective FMCG name. I can mention few names including Ipca, Bikaji, Lal Patle, or selective counter like HU and all. So need to focus on that if you have really made money and looking to put more.
Okay, so Lal Patle, Bikaji are some additional names that Chandan has given. Kush, is your initial take on what we've seen so far and anything that you would buy into? Let's start with Zomato, if there is more there.
So, the overall view still remains the same that, if you've got any kind of profits, if you've been brave enough to venture a long trade, yesterday on closing, at least on Bank Nifty, take money off the table. In closing, rather, I would say a couple of updates. Strides Pharma and Ipca Labs, both the stocks we discussed in the morning have hit the first target, but the momentum suggests that you could be in both of them for the second target as well. Just an update on Himadri Speciality. We had discussed this a while ago. By while I mean like 4 days ago, for a second target of 480 that's been hit. It's seeing some sort of profit booking today, but then continue to hold on if you've got it in your portfolio and also look to add on declines. Now, as far as Zomato goes, I think we've seen a very sharp run up, a profit booking bout. After that there is a gap created at the 235 240 zone. So anywhere close to that should be a good buying opportunity. Had a stellar run. No reason why it should not continue. So any kind of dip towards 240 odd levels should be taken as a buying opportunity in Zomato.
And Mayuresh, your initial take on a completely green screen, at least on opening, on the Nifty?
No, very pleasant, Tamanna, but hearing Chandan and Kush, I think I will look at the screen time and again in the morning.
Well, two wise men, Mayuresh. I won't blame you if you do that, but it's interesting to see their takes too. But thank you, all three of you, for giving us your insights into what was a very interesting morning. Now, what to do from here on is the question. And between the time that Sunil Tirumalai wrote this note on 5th of August and now, some water has passed underneath the bridge, particularly because the BOJ has sounded a slightly more dovish tone today. He's the chief GEM strategist, general emerging market strategist, equity strategist at UBS, joins us right now on the show with his thoughts. Sunil, great having you. Thanks for taking the time out. Your note suggested and spoke about the August meltdown and beyond. Does that beyond change a little bit now that one of the central bankers has come out and sounded a bit more dovish or has tried to soothe some frayed nerves?
Hi, good morning, Niraj, and good morning to all the viewers. Yes, so I think when we saw the meltdown late last week or early this week, there were a bunch of global macro factors that were all colluding at the same time, right? And as you rightly pointed out, there was a out of turn surprise rate hike by the Bank of Japan, that kind of caught the market unawares, and then with that the whole story of the yen carry trade unwinding. We had the US recession fears come back after a poor jobs data. And we had a couple of weeks of fairly mixed big tech earnings in the US. And, as you know, a decent part of the global equities and the Asia equities rally has been driven by the AI theme. And of course, not yet fully resolved is the escalating, worries of conflict in the Middle East. Now, you're right. So this morning, the BOJ comments have been to soothe the nerves of the markets. But at the outset, our team, the economics team in Japan, still believes that the path is for slow and steady rate increases and normalization of the policy, of the monetary policy in Japan. They are still, talking about, a total of about 25 to 50 basis points increase by the end of this year. So I think what the comments this morning tried to do was to respond to very sharp market reactions both in Japan and elsewhere. Specific to the carry trade, some of the numbers done by our Japanese strategy team suggest that we're probably about 75% done with the unwinding, which means that 25% is still to go. And as long as the path for the rest of the world is towards lower rates, and the path for Japan is for higher rates, I think that should continue. So we still have probably a quarter of the unwind to happen, which probably means it does affect, assets globally, across US, emerging markets, etc.
Sunil, I'm going to come in on that because that was a very interesting point. 75% of the Japanese carry trade unwinding is now behind us, in your opinion. Do you feel, so part A, do you feel like the rest of the 25% will be almost immediate, maybe one-off, sharp, painful, but will be behind us? And secondly, of course, this is only a theory that I'm talking to you about. Do you feel like that the Fed now will take its time in cutting rates in order to ease the impact of this Japanese carry trade unwinding? Maybe the need of the hour, but it's not going to be good for risk assets. Is that something that could, be collateral damage, if I may say, of what happened to the Japanese carry trade?
Okay, so looking at the first question, so this unwind of 75% is something that's probably been happening for the last 2 to 3 weeks. right? And actually, it's about a month's of unwind that's been happening. And yeah, I mean, I think you could probably say it's another week to 10 days at the similar pace. As I said, I mean, we wouldn't read the BOJ's comments as moving away from a path of normalization drastically. It is probably saying, I mean, we'll wait and watch for some time, but our house view is that the normalization path is set. As far as the US Fed is concerned, I think their mandate doesn't necessarily look at Japanese economy or exchange rates or even asset prices to a large extent. I mean, they look at inflation and economy and the growth primarily through the jobs data, right? I think the chatter around a sharper Fed rate cut came up because of a poor jobs data last week. And I think that's something which is kind of an adulterated number because we had disruptions due to the hurricane, and there was some planned maintenance and shutdowns in some of the auto industries, etc. So overall, our economics team does not factor in. There is a slowdown coming, but it's probably not a hard recession. But the market seems to have gone to the other extreme and started pricing in even 100 basis points of Fed cut by end of this year. If you look at the OIS markets, I don't necessarily think the Japan yen carry trade is on top of mind for the Fed when they are looking at the rates decision. I mean, we have genuinely seen softening data in the US. We've been seeing mixed data for a long time. It was generally positively biased towards strength in the economy till about 3 to 4 months ago. But since then, we've actually been seeing reasonable weakish bias in the US economy data, including many of the companies, corporates coming out and saying they're missing their numbers. They're seeing weak and sagging sales growth, etc. And of course, you also had weaker ISM manufacturing. You had a weaker jobs data. So I think it all of that basically also led to the Fed basically saying that a cut is coming most likely in September. We still are in line with what the Fed's comments is. I think the market has gone slightly ahead of that. But just to answer your question, I don't think the carry trade is directly something that will play on Fed's minds.
Absolutely, Sunil. Just to take that forward, the carry trade may not be on the Fed's mind, but economic data definitely will. And now this entire question that the Fed may have been a little too late to look at rate cuts. We'll have to go deeper in September. I'm just wondering if you subscribe to it at all.
So UBS has been, kind of cautious and below the street as far as the US economy outlook has been concerned. And yes, I think, we do have some sympathy for the view that there is meaningful amount of rate cuts coming, but I doubt we are really looking at what the bond markets are telling us, what the rates markets are telling us, which is about 110 basis points by end of this year. It may not be as steep. So we are talking about a 25 basis points in September, and probably one more round by end of the year, and primarily because the latest jobs print was affected by various extraneous factors, and that could be seen as a one-off by the Fed as well. So yeah, I think that's how we would look at it.
Sunil, what's the view therefore on what emerging markets could do in the event of a rate cut cycle starting? The extent notwithstanding, let's assume the cycle starts. Whether you are right or the street is right is separate, and only the Fed can answer that. But what happens as a result of that to GMs?
So historically, there have been a few rate cut cycles that we can kind of look back upon and see, what could happen. And each of them had their own context in terms of what the macro setting was. Traditionally, what we see is that on an average, EM equities tend to go up by about 1-2.5% in the 6 months after the first rate cut of the Fed. But if that rate cut is also around a recession or is followed by a recession or it's because of an impending recession, then you actually see a deep, meaningful downside of about 3-4%, right? So that's not a very encouraging setup if we are actually talking about a slowdown coming up. I think on an absolute basis, this is true for most equity assets except for China, where we see very different set of parameters playing out. But it's true in the US, it's true in India, and it's true in most of larger emerging markets. The equities seem to be already priced. Equities valuations are already pricing in a meaningful support from the bond market. But the earnings are not factoring in any impact from a slowdown, from a global economic slowdown, right? So the earnings expectations are still fairly elevated. If I look at emerging markets, you're talking about 16-18% CAGR for the next 2 years. Heavily concentrated in tech and AI theme. They could deliver, right? And I think that's something which our tech team genuinely believes that those are numbers that can be delivered. But if there is any risk of slowdown in the US, those are downside risks that are probably not yet priced in. So the absolute story for EM is still kind of not fully clear, but the relative story, I think it's becoming pretty interesting, especially because EMs have underperformed a lot more than the DMs, and the earnings risk from a US slowdown is more for DMs than for EMs.
Right. Sunil, taking a cue from what you just said, we completely agree. We've borrowed returns from the future. The markets have had a phenomenal dream run in the last few years. What does an investor do? So in terms of actionables, if there is a downside risk from where we stand, should investors who've made money take profits off the table and do a little bit of portfolio rebalancing where you move away from equities into safe assets? Or would you continue running your portfolio? Or third, maybe incrementally keep adding, because the only way to create significant long-term wealth is to keep adding to the markets at every fall and at every rise.
Okay, so we normally work with a 12-month view when we give advice to our clients and investors. I'm assuming your question is specific to India. So we've had a fantastic run, and even YTD India is one of the best performing markets globally. And if you actually think about it, it's largely flows driven. I gave you the number of about 16-18% for whole of emerging markets growth for the next 2 to 3 years. The similar number for India is about 12-13%. I'm just talking about consensus. And even if I look at the historical 3 to 4 years, the growth delivered by India is not very different from other emerging markets, right? So the outperformance of India has primarily been, it's primarily been a function of valuations expansion. And as you know, this year, there hasn't been, very strong participation by foreign money. It's basically domestic money, right? So it's basically domestic equity flows that have been really strong and have supported the market. And, and taken through multiple, macro and political events all through this year. Going forward, for a foreign investor, this is something which is very clearly already visible in the numbers. Allocating money additionally to India in the portfolios is a bit of a challenge given where the valuations are. And as we see for an active investor, either an Asia investor or an EM investor, they're down to neutral on India from what was essentially a 4 to 5% overweight position 5 to 6 years ago. So they've consistently been reducing their active weight on India. And if the entire universe that we track is down to neutral, it's possible that many of them are become underweight too, right? So I think we completely sympathize with that view, because for the kind of growth that we're getting from Indian corporates, the valuations appear fairly rich, right? But when we're looking at a domestic investor base and and retail flows, I think there is, momentum. I think, all the numbers that we see in terms of SIP inflows, those are really, helpful in supporting the markets. But you do get a feeling when earnings yields are extremely low and, compared to bond yields at like a 25-year low, you are already pricing in enough of, benefits from the bond markets and if there are any rate cuts, etc. So in that context, at a time when the nominal GDP growth for the country, for the economy, is probably the slowest in the last 14, 15 years. You have bank credit growth, which is slowing. Some of the larger consumer stocks aren't giving you more than 8, 10% top line growth. It's primarily a lot of the excitement was around the government-driven infrastructure businesses, and that is still growing. But we know that the government capex spend is also, the growth is also off from its peak, right? So in that context, yes. So I mean, we would feel that. So we have currently India as an underweight in our emerging markets, ratings universe. And for investors within India, I think it probably makes sense to look at other asset classes, including fixed income, where you're actually getting probably better yields and better returns. And if in all likelihood, whenever there is a rally in bonds for whatever reason, whether it's because of global reasons or local reasons, we're not sure if that will immediately translate into equities, because a lot of that has already got priced in.
Sunil, what changes that? And very, I think, elaborate and clear explanation about why foreign investors may not look at India the same way. You're saying US is also underweight India because of valuations, corporate earnings are not keeping up. What changes that? Because we've seen this as a market, at least domestically, which has ignored the valuations problem for a while.
Yes. So there could be two things that could change, right? So one could be on the top or one could be at the bottom. So when I say from the bottom, companies suddenly start reporting very strong numbers. I'm not sure if those things change very quickly. And at least, even if we look at some of the commentary by companies, I don't think the capex plans are really, going up in a big way. And we aren't seeing many pockets of acceleration of growth. What we've always held is that if you look at the economics around the savings of how households have been behaving, we're going through probably one of the lowest levels of household financial savings in India today, right? And it's the lowest in about at least in our numbers, it is 25 years low. And some numbers that we've seen coming from RBI probably is even longer. So we are going through fairly low levels of savings, and when I say low levels of savings, the gross savings are lower and borrowings are more. So households are saving less, borrowing more, and they're either consuming or probably investing into the markets. But the savings, gross savings that's happening, it is low, and within that, the allocation towards risk assets like equities has been high, and it's been going up. This probably, means, I think this is a very important problem for the policymakers. I mean, for a country of India's level of, evolution, where investments are big investments, infrastructure, etc., are ahead of us, it's important we have domestic savings fairly high, which is what China went through when they were doing their investments. But if you're having very low savings, it is something that needs to be fixed, right? It's possible that one of the reasons behind low savings and an affinity for markets is that the population perceives the real rates to be too low, right? I mean, you won't get it by looking at a bank deposit rate and the CPI, because the CPI may not be representative of what is the real inflation for a saving household, which probably is at the top 20-25% of the income pyramid. So if the solution is to fix the real interest rates in the economy, that either has to come from a reasonable fall in inflation, or it has to be through higher nominal rates, right? I think the corollary of that is what is being faced by the problems by the banks in terms of lower LDR, very high LDR levels, and I think I think so the way I see the link playing out is that if the deposit rates for the banks continue to harden, they start becoming more attractive, and hence households find other forms of investments more attractive than markets.
Well, let's see. Let's see if that uptick in deposit rates indeed makes them more attractive than markets. The last 4 years, that hasn't been the case, Sunil. Let's see how it shapes up. But it's an important point. Thank you so much for laying it out all for us and for giving us your time today.
Thank you.
All right. But just before we take that break, though, we have a very interesting management on the other side of this break. But some reports about how the government is considering to cut the food weight in CPI, which is the consumer price inflation, by up to 8 percentage points. Now, remember, this is interesting. But remember, it's reports, by the way. We do not have confirmation of the same. But this could be interesting for multiple reasons. One, of course, food prices have kept CPI inflation elevated, and RBI's anchor for rates is no longer WPI but CPI. And therefore, long argued that even though there is deflation on the industrial side, the RBI is not able to cut rates per se because CPI has been higher. Does this do that? One question. What replaces it is the other question. It's a very interesting move if it happens to analyze.
So context, just want to add a little bit of context to this. A big bugbear and an issue for the Reserve Bank of India and for the government has been inflation. Food inflation is a problem because it is so seasonal, it is so volatile, and it has such a big weightage in the CPI. Having said that, so 50% nearly. So having said that, is this going to be a rejig to make the CPI more representative of what Indians actually spend? This has been a long-standing issue. So, for example, a lot of services that people spend on do not reflect in the CPI. The food basket has an outsized presence over there. So, is it going to be a more balanced change? Is definitely one question will have to be seen. And the other point that if you are going to make the CPI less dependent on food inflation, does that then change the way the Reserve Bank of India looks at all of that data and makes its decisions?
But 50% weightage,
and
so
let's
8%
not forget
gone,
that
42% food still remains the majority. So
and
that's
food
okay.
inflation continues to remain above 6% since October 2023. So while it may be to have a better representation, the problem with an inflation number is the fact that food inflation is not giving way, and reducing that weightage may potentially look that headline number actually look better. Yeah. So its presentation or its optics or its
basically you can't
a better
solve a problem
representation
by not looking at it.
You just reduce the allocation of it so the number looks better.
Well, we'll have to wait and
it
see.
It could well be justified as well. Let's see the reason, rationale behind it, and then
and it's still not a given. It is what is being recommended, and these are reports. But we'll take a break. The markets are holding up, and that's what we are excited about this Wednesday morning. It's been a rough few days, but there is calm locally and globally this morning. We'll take a break. We'll come back. We'll talk to Packa on the other side. The stock was buzzing in trade yesterday. They've got big fundraising plans. All that and more on the other side.
All right, quick conversation with the management of Packa. They have announced a fundraising exercise with some pretty interesting names subscribing to the shares and the warrants too. Ved Krishna, Vice Chairman and Group Lead at Packa Johnson, to just tell us about the fundraise, expansion plans and growth ahead. Ved, good having you. Thanks for joining in. What's the purpose of this fundraise?
Thank you so much for having me. So Packa is fundamentally rooted in the single idea, how do we leave the planet cleaner? And we do it through two kind of paths. How do we change the food services space? And how do we change the flexible packaging space? And, these are potato chips, chocolates, things like that, things we use every day. How do we make them compostable and recyclable in the paper stream? So these are some of the IPs that we have created in the past few years. And now we are trying to actualize it in the actual commercial space. So the biggest part of the fundraise is to establish the globe's first compostable flexible packaging facility in our India Ayodhya site. And the second part is to invest further in our R&D. So we have a large R&D outlay in Bangalore. We're trying to further accelerate that so that we can come out with better materials for the future of this planet.
Which is understandable. But so what does this fundraise do in terms of expansion? Are you using it for expansion? What does it take your capacities to? And when do these capacities come on stream?
Absolutely. It is an expansion. Like I said, for flexible packaging, it's an entirely new set of products. The capacities go from the current kind of 45,000 tons a year to about 80,000 tons a year. The plant comes on stream end of 25, early 26. And most of the investment goes into this new flexible packaging products. This is the part of equity that we have created, and of course, the rest comes from debt.
Right. Wait, hi, it's also Samina joining in. So this is interesting. You're working on new IP, new product offering for the market. Help me understand this. Is there already a ready client base that is asking for it? What I want to understand is, from where we stand right now, is it a push product, or was this an ask from your buyers, and hence you're working on it, and hence we already have a visible revenue stream ready to be picked up on?
A bit of both, Samina. Great question. So of course, the global companies that we work with today have got certain roadmaps in place. There's commitments for 2025, 2028, 2030 that have already been brought in place. So what we did was that we commercialized the product last year with a very interesting Indian brand called Brawny Bear. You'd see it in most of these Taj hotels and various supermarkets as well. And now we are working with huge brands to transform their products. So that's the pull part. The push part comes from our own kind of utopian, eclectic kind of spirit that, we are working towards a cleaner planet. So we also try and do a lot of push in the sense of that let's create a product that works as well, if not better, than the current petroleum-based substrates, and do not hurt the buyer's pockets in the sense of, can we create a product that is close enough to the current prices and performs as well? So that's the push part. The pull, of course, is there all over the world. The brands are looking for alternates.
Are these high margin businesses that you're venturing into? What are your current margins in the current product offering? And with this new product offering, where do we see margins move to over the next 1 year?
I hope so, because that's definitely the value creation part. So currently our company has been consistently performing at about 25% EBITDA margins. We are hoping that the new products will inch beyond 30%. That's definitely the direction we want to go, because if you look at a base commodity substrate where we come from, we come from specialized pulp and paper, which we create from sugarcane residue or sugarcane waste. That's what we've been doing. But within that, because we are specialized, we continue to gain we continue to work at about 25% EBITDA. As you create more value for the customer, you can inch towards that 30-32%. And that's the hope for the future.
Wait, hi, morning. This is Tamanna here, and very interesting products. One question that comes to mind is the price differential a pain point? One of the big challenges to move to greener options for packaging on a wider scale, not talking about Packa specifically, is that for companies it just costs more to go green, and then you have to pass it on to your consumers who might not be willing to shell out that price. So just explain to us how you are aiming to close that gap and where that price differential is right now.
Absolutely. Thank you, Tamanna. That's an absolutely right kind of thought that comes from every customer that we talk to. And the general perception we as humankind have, and that includes our own team. And when I talk to our product development team, we kind of start from that standpoint that since it's a sustainable product, it's going to perform poorer and be more costly. And that's a challenge even for us, because till we don't shift that mindset, we are not going to be able to shift the market. And that's what we are doing as Packa. We are trying to challenge that because we feel, that even the petroleum-based substrates were created by us humans, and so can other substrates be created. So that's more, again, on the utopian side. On the reality side, it takes time. So we find that the sweet spot for the customer is about 20%. If we are 20% higher, they're going to switch. But we have to perform at the same level, right? Their food cannot get spoiled, because if the food inside the packaging gets spoiled, then you're creating a bigger environmental damage, right? Imagine the whole chain that is be needed to create that food and to be packaged. So the first, our dharma as packaging people is to make sure that the food is kept safe. The second part is the pricing, and pricing is always in comparison. In isolation, it doesn't mean anything. So the comparison is with the current substrates. We find that till it's in the 20 to 25% kind of range, lots of people are ready to shift. Basically, because if you think about it, the packaging part is not more than about 5 to 6% of the total cost. Even if the packaging increases by, say, 20%, you're talking about 1 rupee or something as the max differential. And the brand value the customer creates by way of going to their consumers and saying, look, we've created a sustainable substrate that if you throw is not going to harm marine life, it's not going to harm terrestrial life, it's going to compost, it's going to recycle in the paper stream. That's a huge brand proposition. And people are seeing that. We're talking to big brands every day and they see that. So the sweet spot is 20 to 25%. Can we hit that is the big question. We feel we can.
Okay. Ved, we'll leave it at that. Thanks so much for taking the time out, and all the best with the plans ahead. That's Packa, SBI Mutual Fund and Carnelian Capital amongst investors in their equity issue and warrant issue. The stock was up 10% yesterday, up another 2.5% today. Has got decent gains behind it. Let's see if the numbers shape up. The management has said that the capacities go up from 45,000 tons to 80,000. So that's nearly doubling of the capacity. The markets in reasonable fettle, holding out, if you will, not quite buckling under pressure. Let's see if today's a repeat of tomorrow, or do we indeed hold out. It's a wrap on this leg of India Markets Open. Thanks so much for tuning in. Thanks for tuning into Talking Point. I'm your host, Niraj Shah. And the big question that we have for you today, or that we have for our guest today, is this. For some time now, the question mark has been that between consumption and capex, should there be a change in your investment decision, considering that there is a perceptible change or perceived change in where finances might flow into? So what to choose between consumption versus capex? And I think that's the question that we asked to somebody who runs a very successful fund management scheme, but is also very deeply entrenched in one of the two aspects for sure, which is consumption. But of course, Milind Karmarkar looks at all markets, has views on capex too. So it's a pleasure and absolute delight to have him. He's director and fund manager at Dalal and Brocha, joins us right now. Milind, great having you. Thanks for taking the time out. The smiling assassin, as I call you, Milind, though you're hardly an assassin. But Milind, coming on this question, really, I would have suspected that given a choice, your portfolios would be heavily skewed towards consumption. And I know in the past you've told me that even banking forms a part of consumption, some other sectors form a part of consumption. I'm trying to understand, did the portfolio have a larger share of capex exposure in the recent past, and is it changing now or not really?
So yes, what you're saying is right. We do have an increasing portion of capex also in our portfolio. Though consumption remains the major portion, roughly about anywhere between 15 to 22% is now focused on capex.
Okay, and
industrials, as I call it.
Industrial, and that hasn't gone down post the election, post the budget. It stayed steady.
It has stayed steady. In fact, a little bit over the 6 months, it's moved up. There is no change post budget.
There's no change post-budget. Okay. Do scares like what's happened on Monday, the follow-up on Tuesday, and sure, BOJ has come in today and sued and played some balm on frayed nerves. But do scares like that worry you? I know you've seen markets for a number of cycles. Or do you view this also as an opportunity?
So when it comes to these type of worries, actually this came out of the blue. Let me be very frank. But at the same time, just before the elections, we had created some cash. The idea was that if at all something goes wrong in the elections, then we would like to invest if the market comes down. Frankly, the market has not come down as much as we expected it to be. So market is down maybe 4-5%, nothing great. So, but at the same time, in our PMS scheme, when people had come in the last, say, 4-5 months, we are close to about 40% cash, or more than that slightly.
Sorry, did I hear 40% cash?
Yes, in the new accounts.
Okay, but is that still the case right now when you're waiting for a further dip?
So we are investing. As and when we see a particular stock falling, maybe because of, lower than expected results, like this quarter, I see most of the companies talking about, many companies have shown lower than expected results, and the answers which they have given is because of the heat wave and because of elections, whatever it may be. But if there is an opportunity to buy something, we go ahead and buy it.
And I mean, are you seeing these opportunities crop up in the capex end of the sectors, or are you seeing this crop up in the consumption end of the spectrum?
Both ends.
Both ends. Okay. Now, Milind, the reason why I was very excited to talk to you today is because the capex theme, for example, and the ones which have got this moat, the MNC companies, etc., are all trading at very high valuations.
Correct.
Okay, let me finish this question, then I'll come to consumption. So, if you are indeed still exposed to the capex and the industrials theme, are you invested into those expensive MNC businesses which have got a moat and exposure to the new energies theme? Or are you invested in some other spectrum? Would love to understand what do you like within this capex exposure.
So within the capex cycle or within the industrials, we are invested in companies which are to do with power, where we see whether it's a transformer company or HVDC companies and things like that. There are MNCs, of course, in that. We are also invested in a large gas company, industrial gas company. So these are the two MNCs which we have. But we also have PSUs. So our focus is predominantly power and railways. Though not the classic railway names, we don't have them as of now. But we have PSUs which are connected to railways as well. So these are as far as the larger companies are concerned. In the smaller companies, we have an exposure to predominantly power and power ancillaries. So that is the focus.
Okay. Power equipment as well, because I mean, some of the power equipment companies, yes, particularly the wind energy companies, the Suzlons, Inoxes of the world, have really rallied thick and fast. So where is it?
Yeah, please go ahead.
No, I was asking where within this power ancillary space?
So we are into meters, smart meters. So we are invested in smart meters. We are invested in Thermax, which is boilers as well as green energy. So these type of companies we are invested in.
Got it. Milind, here's a chart, and then I want to swap a little bit to consumption. But viewers, I just want to show this chart and the consumer sentiment index. And if you see this, the all Indian urban consumer sentiment relative to rural and relative to the combined has actually come off a little bit in the recent months versus what's happening in rural. And I think this is a very important change that has happened from all that we've seen in the recent past. Now, Milind, I would love to know this. Have you made a pivot in your consumption portfolio towards rural focus plays?
So let me just explain. So I was reading a book called Lilliput Land, very interesting book if you are looking at consumption. So one of the chapters it talks about the Indian consumer and how many MNCs have got it wrong. So in India, if you divide consumption into 5 quintiles, the top 2 quintiles take the most of it, which is the rich and the upper middle class, you can say. The bottom 3, which range from a household income of roughly about $3,500 and below, frankly not $3,000, $2,500 and below, don't have anything left after their day-to-day needs. So that is the problem. And because of that, I think those companies which focus on the bottom 3 quintiles along with the top 2 will be the significant beneficiaries. Interestingly, it also says that 17% of the rich in India surprisingly stay in rural India. So I think this rural-urban divide, frankly, I am not looking at it that way. What I am looking at is which are those companies which can service people who have a $5,000 per capita income as well as people who have $1,000 or a $2,000 per capita income.
Okay. And so therefore, would these be product companies? Would it be tech companies which show all kinds of products? How is this shaping up?
There will be retailing companies.
Okay, fair call. Well, Milind, here's the deal. I was looking at I was preparing for this interview. I was looking at some of the businesses. Whether or not they're in your portfolio is separate, but I'm using them as examples. A Trent, a Varun Beverages, a Zomato, and some others. They were trading at very expensive valuations even in January 2023. Yes. And in the subsequent 18 months, they have continued to trade at those expensive valuations. The stocks have given between 3x to 4x to 5x returns. So some of these stocks continue to stay expensive. I'm trying to understand, how do you wrap your head around that? And do you invest fresh money into some of these expensive businesses as well? Why or why not?
Okay. So let me take a classic example of Trent, and I have given this disclosure many times that I hold the stock, we hold it across all portfolios. And the reason for that is simple, that what I just now said, that it caters to all types of consumers. So whether it's a slightly higher end consumer, he can go to Zara, a middle income consumer can go to Westside, and you can lower than middle class can go to Zudio. And they have an offering for each and every customer, even if he's getting $1,000 dollars per capita or $1,500 per capita, there is something which he can buy in Zudio which costs maybe $2 or $3. So that is what it is. In the sense, if you convert it into rupees, it's 200 to say maybe 400 rupees when it comes to buying a T-shirt. So that is the kind of spread which they have. Looking at looking at Zomato. Zomato focuses predominantly on urban India as of now, and I think at least in the coming few years, it will continue to focus on urban India. We bought Zomato when it started making money, and we continue to hold. And the reason behind that is that besides the food delivery business, Blinkit probably has a huge opportunity, especially in urban India. I don't think that opportunity exists in the smaller towns or the grade A, grade 2 towns, but it definitely is an opportunity especially in a city like Bombay where people have less time. So that is the reason why they have continued to grow. So coming to price earning ratios or valuation, typically, Trent has been continuing to deliver a 40-45% return, and in all probability, it may deliver like this for a longer period of time because, frankly, it's as of now just a $1.5 billion company. And if you look at the other fashion brands, they're anywhere between 10 billion, 20 billion, the global fashion brands I'm talking about. So if you believe that India is going to have a sizable uptake in per capita income, I think these stocks could be interesting. Even the food grocery, grocery business, whether it's, so there are many grocery businesses, whether it's Avenue, whether it's Star Bazaar, and whether it's Reliance. So these businesses also have humongous opportunity despite someone like a Blinkit or many others being in existence, because these people can go deep under where the population density is lower than Bombay, where Blinkit may not work, but these guys will do well. So that is the reason why I continue to believe that this particular segment of retail, whether it's fashion, but in fashion you need to get your pricing right, need to get your vendor base right, and of course you need to probably get your balance sheet also right. So if these three things are there, fashion will do well. As far as grocery is concerned, again the same thing. You should have a value proposition, and if you have a value proposition, I don't see any reason why these businesses cannot be long-term compounders.
Okay, so So Milind Karmarkar viewers believes in the long-term compounding story, and that's why it's not just the recency thing. I mean, I think some of the investments in consumption have been there for a while, and he's now reaping the benefits of that. One quick question, Milind: Are you enthused by this whole conversation of rural spend move? I know you said that you don't look at rural versus urban, but the reason why some of the people are buying into staple companies is the belief that rural spend will move up and therefore their numbers could look slightly better over the next 12 months. Do you buy the argument?
So I have looked at rural companies earlier, but the issue is that focus only on rural doesn't work. Especially in FMCG, I think rural markets are deeply penetrated. So that is the reason why the growth in rural markets may not be significant for FMCG companies. And that, I think I had talked about it earlier also, that even in the US, the top 5 companies way back in the 70s were all FMCG companies. And in the next 20 years, the baton moved to retailing companies, because the pricing power moves from FMCG companies to retailing companies. And that's what will happen in India also. So even if I want to have a rural play, I will look at those companies which probably are focusing on rural. They have got their cost under control and they have got their business model right. So between the two, my preference is towards retail, playing the same markets.
Got it. One final question, Milind. And that is because you cited Zomato, right? I was looking at the results of a bunch of platform companies, PB Fintech, a much better performance, Zomato doing that, a couple of others have done that, save for Paytm, which has gotten caught in the eye of many storms, so that's leave that out. Are Indian platform companies coming of age? Are you more enthused about investing in them now than what you might have been 2-3 years ago when they started off?
So that's correct. As I said, that I prefer to invest in companies once they are very close to generating cash profits. So I am keeping a watch on them, though we have invested in one or two fintechs of late, because we think that some of them have got their platform right, they have got their credit appraisals right, because especially in fintechs, what is crucial is the credit appraisal. And because they are mostly catering to SMEs and small borrowers. So if they have their credit appraisals right, and they have their overall, capital base well placed, then fintechs also could be interesting. But in the other sectors, fintechs could be interesting provided they have reached closer to cash profit.
Noted. Point well taken. Milind Karmarkar, such a pleasure talking to you. Thank you so much for taking the time out and giving with us. And I'll read that book. Though I think you told me the last time too. So I'll make it a point to read that book. Thank you so much.
Thank you. Bye-bye.
All right. That's Milind Karmarkar. Ace in consumption amongst other things. Still comfortable buying into some of those expensive consumption names. He believes the profit growth will make up for the high valuations out there. Still has about 20 to 20% of his portfolio towards the capex oriented themes. Speaking of capex, I think one sector that is doing it in abundance is power. And Tata Power numbers were much better than estimates. We get in Mr. Praveer Sinha on the other side of the break to talk about the numbers, capex and more. Stay tuned. Back with Talking Point. Tata Power is a company in focus, in line or slightly better than expected in terms of the Q1 delivery. Large capex plans for the next couple of years in order to double the revenue size between the next 3 to 4 years. Dr. Praveer Sinha, CEO and MD of Tata Power, joins in to tell us about how the year started and the year-end targets and more. More importantly, what's happening in that space. Dr. Sinha, great having you. Thanks for joining and I hope all is well.
Thank you, Niraj. Always a pleasure to be on your show, and thanks for the invite.
The pleasure is ours, sir. Can you tell us a bit about how did Q1 shape up? It was slightly ahead of what the consensus estimates were. What stood out for you?
This is, of course, the 19th consecutive quarter growth in PAT. And I think what has done well is all our existing operations, whether it is our conventional generation or renewable or transmission and distribution, have started doing exceedingly well. Many of the steps that we took in last few years in terms of making a strong foundation on these businesses have started showing results. And with our continued focus on capex on new businesses, I do expect that our performance will continue to improve in future too. What you see is basically a reflection of a very, very strong foundation of the business. And once you have done that, then it virtually gets on autopilot, and you need to just ensure that there is consistency in the performance.
There's improved performance. Okay, I'm trying to break it up into segments. I mean, the Discom business, a strong number out there in percentage terms, 34% growth, improved performance in solar EPC as well, and that percentage number looks very impressive too. Is this a sign of what things could look like over the course of the next few quarters, sir?
So it will actually improve our distribution business, which is in Delhi, Mumbai, Ajmer, and Odisha, have done well. Normally, the first quarter is the most difficult quarter, considering the heat wave, where many of the things that we carry out, whether it is in terms of reliability or billing and collection, gets a little impacted. So you can definitely expect that the second, third quarter will be much better than the first quarter. Similarly, our renewable business, we could implement some of the projects, the EPC business. We also have a very good pipeline of nearly 8 gigawatt, out of which 5 is our own utility scale projects, and 3 gigawatt is third-party EPC. More than 3 gigawatt will get implemented in this financial year, and I expect about more than 4 gigawatt to be implemented in next financial year. So everything is lined up. We have set up our manufacturing plant, so the cell and module that we will manufacture in the plant will be used for these 8 gigawatt projects. So I think what you are seeing is that there is a huge amount of consolidation that has happened in all our operations. And the results are there for us to see that our consistent performance is happening. So I feel very confident that we will continue to do exceedingly well in coming quarters, and we will surprise everyone with our performance.
Okay. Since you would have paucity of time, I will not go into individual segments, but try and get the bigger picture from you, sir. When you say that you will surprise people, the expectations are that over the course of the next few quarters, albeit the next few years, your EBITDA growth could be as high as 20%. Now, is it possible to surprise on estimates which are of such a high magnitude any which ways, Dr. Sinha?
Well, in last 4 years, we have more than doubled our revenue. Our EBITDA has gone up, is 1.5 times. Our profit is 3 times. So I think our results speak for themselves. And you will definitely see that many of the things and initiatives that we have taken, the results will start coming in the future quarters. So I won't give a number, but yes, we will continue to do exceedingly well as we have been doing in the last few quarters.
Okay, I'll not ask you for a specific number on a quarterly basis, but I presume you have officially given a target of doubling revenues from FY23 to 27. With the capacities coming on stream, sir, would you believe that that is something that is a cakewalk? That is something that is eminently doable, or that is something that is aspirational?
There is no cakewalk in this. There is a lot of hard work. And mind you, we are a public utility supplying power to consumers 24/7. So there's a huge amount of hard work, even in such hot conditions where we had a very, very difficult summer. So, but yes, this is the aspirational number for us, and we definitely meet whatever aspirational numbers we have set for ourselves. And in fact, we end up doing little better than the aspirational numbers.
Sorry, I by no means was saying that the work is a cakewalk. I just thought with the work that has been put in, are the targets a bit of a cakewalk? That was what I was trying to imply, Dr. Sinha. I have last two questions, sir, because I understand I have to let you go. But the first question is on the space at large. Very tall targets across renewable space in particular, but presumably even otherwise. I mean, wind, solar, hybrid, thermal, very tall targets for India as a country. I would love to understand, is the opportunity size right even for a large player like you to have sizable expansion plans? Because when I look at the capex plans that you have, 20,000 crores for FY25 and 26 is no mean feat. That's a fairly large capex that you are putting behind your growth plans as well.
I think the demand of power is definitely there. We have seen consistently in last 3 years 10% CAGR, and I think this is only getting enhanced. One is because the country as such is doing very well, whether it is in its industrial production or otherwise also the aspirational Indian in terms of the electronic and electrical goods that they are purchasing and using. The second is the climate change is also impacting, where we saw this year record high temperatures during the summer months, and thereby that much more increase in energy consumption. So both these factors put together, the demand is definitely there. To meet that demand, the growth has to be done, and for us, our per capita consumption continues to be very low compared to any developing country or even the world average. So I think we will be required to do this to meet the energy security. And as a large company, we have already identified a huge capex year after year. We're talking about nearly 60,000 in 3 years. This year, we have planned 20,000, out of which we have already implemented 4,000 in the first quarter. So you will only see that this will get enhanced. You have seen that not only we are growing in our renewable space, but in our transmission business and also in our hydro business, where we have 2,800 megawatt of pumped hydro. And we announced yesterday about our intention to develop a 600 megawatt hydro plant in Bhutan with Drup Green. So I think we will see huge capacity additions taking place, and Tata Power will play a very, very important role in all these sectors, whether it is in generation, transmission, distribution, or renewable space and hydro space.
Remember, viewers, over 50% of the capex allocated to renewable, 30% to transmission, 10-15% to new areas like pumped hydro as well. Keep up the great work, sir. Thank you so much for talking to us, and all the best for the quarters ahead.
Thank you. Thank you very much, Neil.
The pleasure was ours, and viewers, with that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.
Markets trade higher, tracking Asian peers. The Sensex trades above 79,200 and the Nifty looks comfortable about 24,200. All sectors trade higher, led by metals and the oil and gas pack. And the Bank of Japan says it will not raise rates when markets are unstable. Deputy Governor also says that the central bank needs to keep easing firmly for the time being. And relief for property owners on long-term capital gains as Finance Minister amends the budget proposal. Taxpayers to now avail lower rate of 12.5% without indexation or higher rate of 20% with indexation. Hello and welcome. You're watching the F&O show, and over the next 30 minutes, we'll take you through all the action in the F&O markets and derivative trading strategies for the day. Well, the markets are looking good. The Nifty is holding on to its gains from the get-go. It was a good start on back of a positive set of cues coming in from Wall Street and Asian markets alike. The Nifty is holding on to 24,300 and building on its opening gains. The breadth of the market is strong. Of the Nifty 50 companies, most of the counters were trading positive. Broader markets are performing in line with the benchmark. The mid-cap, small-cap and the micro-cap index are also eking gains closer to 1.5%. Largely, the stock-specific action, though, is driven by earnings. So you've got lots of counters that are reacting to either a good set of numbers or a bad set of numbers. But all in all, Agam, good morning. It's a decent setup. Yesterday's recovery didn't look sustainable.
Yeah.
This morning, though, I think there's a lot more calm and there's a lot more stability that is emerging in trade.
We were actually seeing that, Samina. To be honest, while there was a little bit of, we did have a little bit of a rocky start, and specifically the last half an hour, we actually did see the benchmarks move towards day's lows. We once again starting to see a little bit of recovery from there onwards. Sure, I mean, it is a Bank Nifty, a weekly options expiry, so that's always going to be a factor which will play out in terms of increased volatility in today's day of trade. There are a lot of positions which have been taken over the past few days, and today will be an important one. We have moved below the mark of 50,000, and as I was suggesting, while that may not be a very key resistance or support region, 50,000 on the Bank Nifty will be where we actually do see a catapult on both these sides, considering there's been so much accumulation and open interest over the past few days around that particular strike. As far as the Nifty is concerned, we are looking at a whopping 1.2% up move there on an intraday basis, and we are looking at that Nifty trading at around 24,280 odd levels, very close to 24,300. In fact, the futures is already above that mark, and unwinding continues. But entirely uncertain whether or not this is towards the short covering, and can this be an end to any rally of sorts. But as far as the Bank Nifty futures are concerned, again, let's take a look at how things are panning there. There's been no change in the futures. We'll also talk about the options market. The Nifty specifically in this case, as I was once again mentioning, that while the Nifty closed below 24,000, there was still a significant amount of puts in the system around the 24,000 strike. And that means that there was a pocket in the market which was fairly certain that come today, there could potentially be a little bit of a reversal playing out. So for all those who stood put in that specific put, well, they're certainly heaving a sigh of relief at the moment, considering the Nifty is now well about 200, 300 points above the mark of 24,000. And as far as the Bank Nifty is concerned, again, I've been talking about the 50,000 mark being a little bit of an important, center point, if I can call it that, because that's around which we are looking at the Bank Nifty to continue to hover around. So in general, that's how things are faring as far as benchmarks are concerned, Samina, where it's a positive day of trade, and one can only hope that we continue to stay in the green, at least for today.
Indeed, that looks like what the trend is seeming like this morning. It seems to be calm, and that's what we're going to be taking heart from. Ajit Mishra and Akshay Bhagwat both joined in with their trading strategies. Ajit, I'll start with you. It's been rough for the last few days. Yesterday was a failed attempt to close in the green. This morning, though, the setup looks far better. The breadth is good. Broader markets are performing in line, and everybody's participating in terms of a recovery. Do you feel like there's merit in going long on the Nifty at these levels?
Yeah, good morning, Samina. Good morning, Agam. So, like last 2 days, obviously the volatility was high, and we have seen a cool off in the volatility index also. Apart from the recovery in the global market, which is comforting the participants, and today we are seeing that we are holding the gains so far. But Samina, I feel from the risk reward point of view, still the risk reward is not in favor of initiating any fresh longs, because 24,350 to 450 is the area basically where we have multiple resistance. Ultimate at 24,450, which is the 20 EMA, which was earlier we were defending during the correct up phase, and now that should act as a resistance. So I feel for a timing now, it's prudent to stay away from the index, because banking index is also hovering around 100 EMA. So though so far we are seeing that both Nifty around 50 EMA and Bank Nifty at 100 EMA are trying to defend those levels, but volatility is still at the higher level. So for index at least, I feel that one should refrain from aggressive longs, and in case if you have any existing position, 24,250, 24,200 should be your strict stops, and use any recovery towards 24,450 to exit your longs.
All right. Well, so there you have it. That's the view coming in on the Nifty and the Bank Nifty from Ajit. Akshay, morning to you as well. How are you placed when it comes to trades as far as benchmarks go?
Good morning, Agam. Good morning, Samina. Well, yes, the index is in the process of charting a short-term support base. Even your options data, as you mentioned at the beginning of the show, 24,000 is the key pivotal zone for the market. Here, a lot of put writing bets, even if you see tomorrow's weekly expiry on the 8th of August or the monthly on the 29th of August, the highest open interest in puts are placed at 24,000. So that's an important support point. And with a cool off in VIX in the last couple of days, a lot of more put writing bets are slowly piling up, considering still the juicy option premiums which the market is trading at. So level wise in Nifty, 24,400 is an important trading resistance. The first sign of momentum pickup in the Nifty would be if the index manages to cross and sustain about 24,400. So really there is no trade, because it's in a range, it is nearing the upper end of the range, and whether the breakout matures or not is a question mark. But overall, I feel let the levels break, then we will take a review of the situation. But as far as the Bank Nifty goes, still with the bank policy a day away, the index is a bit weak looking at the current setup. 49,550, 500 is the range. 50,700 should be the breakout point if any momentum has to get back into the banking index. So no fresh trades as such, but those who are holding on, just the hope is that the support is slowly building up and the market is gearing up for a possible breakout. Whether this matures in the next couple of days, that's the question mark, and which needs a review.
Right. Ajit, there is enough and more triggers. You've got the MPC meet tomorrow. You've got Bank Nifty expiry today. In terms of a strategy on Bank Nifty, are you picking up any direction, any strategy that's worth sort of executing, or any actionables really?
So, Samina, banking was anyways underperforming, the index, and that clearly shows that we are already at 100 EMA when it comes to banking, while Nifty is still holding the short-term averages. At the same time, if you look at from the major constraints, HDFC, after the initial recovery, we are again seeing, selling pressure emerging at the higher levels. Excess, despite the oversold position, we are not seeing any respite, and we are seeing fresh selling pressure in ICICI. So, though we have a support, and there is a possibility that banking might also make an attempt of recovery towards, let's say, 50,500, 700 zone, which is the resistance area of the 20 EMA on the daily chart. So, but I still feel that since we have important event lined up, and the VIX is still at the higher end. I feel that one should be cautious in case if somebody is planning any fresh trade, then call spread is something that they may initiate with 50,000 call being on the buy side and 50,500, 600 for the shorting trade. So that could only be the strategy, that in case if somebody is willing to take that risk of entering into the event with a positive bias. Otherwise, one may avoid.
Okay, so volatility has returned. So firstly, if we can very quickly pull up the Bank Nifty intraday chart and see how things are faring, because over the last 5 minutes, we saw the Bank Nifty go from the levels of about well below 50,000 all the way to 50,200. So that was a roughly 200 odd point move in just about 5 minutes. I know it's a small move, but the fact that that move happened very quickly and it kept the Bank Nifty and above 50,000 is always something that needs to be kept in mind. And I mean, I'm continuing to say this because today is the weekly options expiry. 50,000 becomes important, and we are likely to see a lot of traction in and out of 50,000 on an intraday basis. The other aspect is that the VIX has come off quite a bit, and that is also an indication of the kind of option premiums that have come off significantly, which means that option writers in markets like these are always going to see a little bit of a challenging day, specifically and especially when you actually go and take far out of the money positions. The traction on an intraday basis is going to be considerable. So that's where selling becomes a very, very I would say a risky proposition on days like this, when the Bank Nifty is in fact playing in and around crucial psychological as well as technical levels. So that's always something that you have to keep in mind. And that sharp surge that we saw in the last 10 odd minutes, it does seem like the Nifty once again, the Bank Nifty is once again trying to settle in at around the 50,000 mark. So it's just going to be one of those days, and I'm sure that traders out there are well aware of this aspect. But for those who are still relatively uninitiated, these are some of those factors that you need to keep in mind. That just because you've sold a premium at 5, even though the Bank Nifty may not end up closing at the money at that particular strike option, it doesn't mean that you're on an intraday basis, that premium of 5 cannot become 25. So that's something that a lot of these traders have to keep in mind. But with that, let's shift focus to stocks then, and very quickly we'll take a look at all the stocks which are actually seeing unwinding and potentially fresh longs as well. So let's pull that list up. So we have longs in something like an HPCL, Apollo Tyres and Alchem Laboratories. Bata under pressure on account of poor earnings. So we do have about shorts building in there as well. Coromandel International is flat and wouldn't want to necessarily classify that as longs or shorts. In terms of other stocks which are in focus, among stocks which are seeing unwinding, we do have short covering from Chambal Fertilizers. We have Emphasis, Dixon Technologies. Dixon Technologies is making a strong up move once again. So these are some of these names that you can keep an eye on. With that, let's take a look at what our experts have on their radar. Akshay, I'll come back to you. Stocks that are looking interesting to you today?
Yeah. Considering the current market conditions, many of the stocks are heavily oversold, and bounce back is what I'm looking forward to. So stocks which I'm looking from the buy perspective here, first is Havells. Now, if you look at the price structure of Havells, a possible double bottom is in the making. That's the sense I draw looking at the past few days of trading action. The support is slowly building up around 1770. Long additions are slowly piling up from 1770 to 1800, and the belief is that this stock should do well in the short term. 1892 and 1920 are the two targets which I'm projecting in the short term, with a stop loss of 1764. The second call is IGL, Indraprastha Gas Limited, which trades around 546. A very healthy chart structure, undisturbed by what's happening in the index in the last couple of days, heading for its recent swing high breakout. So very strong setup, gives you potential targets of 575 to 592. The stop loss will be 529 on this trade. So IGL and Havells will be the two buy recommendations from my side.
Ajit, what about you? What are your top trading recommendations, stock-specific calls?
Yes, so Samina, though we are seeing a rebound, I feel that in a market like this, wherein global clues are still uncertain, it's prudent to maintain position on both sides. So first stock that we like on basis of the overall sectoral performance from the FMCG pack, HUL, which is leading from the front. The stock has witnessed a consolidation range breakout, and despite the challenges and volatility which we are seeing in the markets, holding strong, inching higher with every passing day. So we expect this move to strengthen further, and 2850 is what we are eyeing in the near future. So with stop at 2730, one can go long in HUL. At the same time, Bajaj Finance from the NBFC basket is struggling to hold the recent lows and inching further lower. It's just a day of pause today, and which I feel is a shorting opportunity in case if somebody is willing to initiate any fresh shorts. So 66.90 should be a stop for Bajaj Finance, and 64.80 positionally is something that one can maintain as a target.
Okay. So, well, some names coming in from our experts as well. Maybe we can take up a handful of stocks that we can, that are actually seeing a bout of volatility here as well. But I'm going to talk about Dixon because the reason behind me taking this stock up is, well, largely it's been one of the trader favorites because it's seen so much strength of late. Of course, this was before the volatility set in. It's still not too away from its life highs. It's in fact, its life highs somewhere between 12,500 to 13,000 rupees per share. We've not seen a staggering correction here, and it's about 500 odd points away from that 12,000 mark at the moment. Today, it's seeing a little bit of recovery, but it has seen its fair share of volatility. The question really is this a stock which is now range bound? And if that is the case, what do we do with Dixon, and what are the key levels that you can keep an eye on? So, Ajit, I'll pose this question to you on Dixon Technologies. Your view here.
So, Agam, yes, you rightly mentioned that at one point of time we were seeing just a vertical up move in Dixon, and the stock managed to reach to 12,500 plus zone in less than a year time, and now we are seeing that from last 1 month we are witnessing a bit of volatile swings in the stock. The tone was largely positive, but of late we've seen that after making an attempt to claim the record highs, the stock failed to hold those levels, and again we are seeing a bit of a profit taking. So this indicates a possible consolidation in the stock, which is healthy because so far we have not seen any major price correction in the stock, and we are still hovering around the 220 EMA on the daily chart, so which indicates that short-term trend is still intact. But yes, I feel that this consolidation might continue. So if the view is very short-term, then one needs to be strict with the stop losses. So close to around 11,000 is something that one should maintain a stop if you have an existing position, and in case of recovery, 12,200 to 300 is the area basically where one can look to book profit. For fresh buying, and if the view is positionally, then one can continue to accumulate on dips around 11,000 to 10,500 zone for the positional longs, with 10,000 being the major stop.
Right. Okay. Thank you, Ajit. Thank you, Akshay. Great talking to both of you. That's interesting to get trading strategies from you. Remember, there's a lot more data as well that we're eyeing. You've got the MPC meet tomorrow. You've got Bank Nifty expiry today, weekly expiry. So there'll be enough and more triggers that will keep the markets up and alive. We'll take a break. We'll come back. We'll put the focus on commodities. So stay with us.
welcome back to the F&O show. Well, we are now taking stock of the commodity space, and we have Dinesh Somani of Pro IntelliTrade Services joining us on the show right now. Dinesh, good morning. Thanks so much for joining in. I suppose the most obvious question at this point in time and what is on everyone's mind is gold. With the way things are turning out when it comes to the currency markets, the big move coming in from Japan, uncertainty with respect to the US economy at the moment, how are you playing the two precious metals, gold and silver?
Good morning. And definitely the US recession fear, the Middle East tension, the Japanese yen, the falling, all currencies, they're adding on to the MCX, almost every commodity. Gold is still able to survive and is trading well below the 70,000 mark. But the trading activity is very much range bound as of now. We expect a very crucial support at 69,500 and the upside resistance is 69,400. For the intraday perspective or for 2-3 days, we expect prices to accumulate around 69,920 for the upside target of 7150, 7380. One should place stop loss at 6960.
Sure. What about crude with rising stress in terms of geopolitical tension? And of course, everything else that seems to be risk off or was risk off till this morning. How would you play crude? Lots of pulls and pressures here.
Yes, definitely the Middle East tension failed to add premium to the prices. We see crude oil prices in MCX trading well below the 6200 mark. Any pullback rally around 6250, 6255 should be a selling level. 6315 should be the stop loss. Downside, I expect around 6165, 6115 levels.
What about silver? I think, Dinesh, we got your view on gold, but I think we missed out on what the trading strategy on silver was.
Yes, definitely. Silver collapsed almost by 4,500 rupees almost 2 days back. From 84,000, it collapsed to 78,500. 78,300 is a very crucial support zone, and I expect prices to move up from this zone. On the intraday perspective, we can say around 79,450, 500 should be a good buy level upside. 8250, 8600 should be the target. 79,100 should be the stop loss, please.
All right. So that's your view on silver. Dinesh, let's talk about your base metals then. Anything in specific that you have on your radar in this pack?
Yes, copper is trading at a very supportive zone. 775, 776 is the accumulation point. I think prices should move up from here to 783 on a short-term basis. 769 should act as a very crucial support. If the prices are able to sustain about this 785 level, we can expect around 805 on the upside target.
Okay, well, that's as far as copper goes. Dinesh, once again, quickly, your view on the Indian dollar pair as well right now, the INR USD pair. What's your sense and how are you going about this?
As far as USD INR is concerned, it stayed above the resistance zone of 83.80 level. And unless it goes and closes below the 83.70, 85 level, I think it should test around 84.20, 84.55 levels. I expect it to move further.
That's the call coming in on the dollar rupee pair. Copper, gold, silver and crude. It is an interesting space to be currently trading with so many pulls and pressures, risk on, risk off trade, which pretty much changes daily in that sense. The markets in the meantime are holding on, and that's what we're taking heart from. The Nifty trades at 24,300. The breadth of the market is good. Bank Nifty, though, struggling a little bit, but that's all because you've got the much anticipated MPC meet tomorrow, and it could turn volatile on back of Bank Nifty's weekly expiry. Stocks that are driving the markets are largely based on reporting of earnings, so it's the broader market space that looks a lot more active in today's day of trade, and stocks like Dixon Technology also picking up quite a bit of steam. Well, that's what we have in terms of market action. Sectorally, stocks from the oil and gas pack, metals and IT, which have a global facing role, are doing quite well. With that, completely out of time, anything else, Agam, that you're picking up on that we should be highlighting before we wrap up?
No, I think it's going to be important to keep an eye on the Bank Nifty. I reckon only because it's the weekly options expiry and 50,000 continues to remain that crucial mark. But with that, it's a wrap on this this edition of the FNO show. Indiabulls Housing Finance Limited is now Samman Capital Limited. Jio Samman se. Keep watching NDTV Profit for all your news updates. Back in just a bit.
welcome. You're watching the Small and Mid Cap Show. I'm Mahima Vajrajani and with me is Harsh Saita, and we're also joined by Mihika Barve on this edition of Small and Mid Cap Show. Well, before we move on to the managements that we're going to speak to today, let's take a quick check on what the markets are doing. Well, the markets are faring out to be pretty well today. In terms of the Nifty 50, it's trading within a range of roughly 150 points. Currently trading 1.2% higher and almost at its day's high now as we speak. Let's also pull up the Sensex. Sensex is trading within a range of roughly 500 odd points. Currently 1.07% higher. Almost at its day's highs as we speak again. Let's also take a look at what the broader markets are doing. The broader markets are doing a tad bit better than the benchmark indices. The mid cap 150 is up around 1.8%. The small cap 250 is also up around 1.6%. Let's also quickly pull up the Nifty contributors. What's weighing up and weighing down the Nifty? Well, in terms of what's weighing up the Nifty, there's HDFC Bank, Infosys, ONGC, L&T, Let's also quickly see what's weighing down the Nifty. There is Indocent, Asian Paints, Bharti and Eicher Motors. Let's also quickly pull up the breadth of the market. The breadth of the market is of course skewed towards the buyers, but let's see what the ratio looks like at present. What are the advances and what are the declines as we speak? Well, the ratio is roughly the ratio is roughly 5:1, almost 6:1 actually, in terms of advances versus declines. It's 1800 odd versus 267 declines. But Harsh, what are the sectors doing in trade today?
Well, let's pull some of them up. In fact, let's pull up the heat map first off. The Nifty energy in focus, in fact. But outside of that, the PSU basket buzzing, metals doing very, very well for themselves. And you're also seeing good traction in realty and pharma. Where is the Nifty Bank? Let's pull that one up. 0.6% higher. We are above the 50K mark. So that's one piece which is a bit of a relief. The Nifty Auto also up 1.5%. But you're seeing pretty much secular green across all indices. And that's the key positive. The Nifty Oil and Gas is up 3%. And you're seeing strong gains across the board in oil and gas stocks. You have Oil India, Castrol, ONGC, Hindustan Petro up. In fact, the first three, Oil India, Castrol and ONGC up over 7%. If you can pull those up, really driving the Nifty Oil and Gas higher. Let's quickly pull those up. And we also have something like a Hindustan Petro, BPCL, GAIL, all up over 3%. IOCL also up nearly 3% in trade. So clearly buzzing the Nifty Oil and Gas energy stocks in focus. But let's quickly take it across to the first management we have on the show today. We have Manish Gangwal, who's the Chief Financial Officer at Gulf Oil Lubricants, to talk to us about Q1 numbers. Strong set overall. The stock also up and away, almost 8.5% higher in trade. Welcome. Good morning, Manish. First off, let me try and understand from you. You had undertaken some price hikes in Q4 of FY24. How has that translated to the numbers in Q1 FY25, both in terms of volume and value? What's the kind of split like? How are the numbers looking?
Yeah, good morning to all of you. Thank you for having me. Yes, you are right. It was a very strong quarter, Q1 for us. But the price hike, if you're talking about, we took a small price increase in the month of May, which is still to pan out fully because it takes nearly 30 to 60 days for the full effect to come. And in the meantime, this price increase was taken when in April, you will recall the crude touched nearly $90 and went above that. And that was the time when we sort of thought of a price increase. But as we speak, the crude has come down below $80, and if this remains stable or around below $80 or around $80, we believe that we will see, the prices stabilizing in the market for lubricants.
Right. Mr. Gangwal, can you help me break down the kind of revenue that has come from different segments, that is automotive and industrials? And also if you can give me a breakdown as to how much of revenue has come from your premium products versus the non-premium ones.
Yes. So overall, our revenue growth is 9% for the quarter, which is nearly more than double of what we can say the industry growth. Because industry, we typically believe grows in 2 to 3% or in good times 3 to 4% in terms of volume, and the revenue growths are typically a percentage higher. But overall, our profits have grown fantastically in the quarter, nearly 29% growth in PAT. And all has come on the back of a good growth across segments. So I will not pick up a particular segment, but because we have done very good in terms of B2C growth, in terms of both B2B as well as, there was except infrastructure segment, which I would say was slightly, on a lower single digit in terms of growth because of elections and because of, heat wave in the parts of India when the laborers are not available. Other segments have all done very well in terms of volume. So even rural has also done well. Agri segment for us has done well during the quarter. The motorcycle, personal mobility, including car, has done very well. So the growth has come from all categories. And at the same time, except the factory fill business, which is linked to the OEM production, which was still under degrowth, and continuing from the earlier quarters degrowth. Of course, there is an improvement, but still in the degrowth because last year quarter one was very high. But overall, we are seeing traction across all categories.
Hi, Mr. Gangal. This is Mika this side. I also want to talk about the automotive lubricant industry, which is one of the growth areas that has been identified at the company. What's the revenue breakup coming from automotive lubricant products, and what's the strategy going ahead?
So typically, our automotive segment is around 80-85% of the products. But we supply automotive products to even B2B segment, like our OEMs, like infrastructure segment also buys automotive products. So if you go by the product category, it is roughly 80-85% automotive and 15% to 20% industrial products. But overall, from B2C, B2B perspective, roughly 50-55% of our business is B2C. So as I mentioned, we are seeing good traction in automotive. Vehicle growth has been robust. We are seeing that motorcycle segment, which was earlier under pressure last year during the same period, has come back strongly for us. And overall, we are seeing good traction in vehicle growth. And that is reflecting in a positive outlook for lubricant industry as well. And we are seeing tailwind coming on account of vehicle growth as well as the GDP, which is in positive direction.
And in terms of new product launches within the automotive industry, are there any sub-segments that the company is targeting?
Yeah, so we have launched products across the categories. For example, SUV within the passenger car segment, we see 40-50% of the new vehicle is SUV nowadays. So we have launched complete range of SUV products for that segment. We have launched top tier products in the motorcycle range, in the synthetic range. At the same time, we have also launched certain value products to cater to the mass market and take care of that segment as well, because some of the segments are price sensitive as well. So we are focusing on premiumization, but not looking away from the market realities of value segment also coming in certain pockets.
Got it. Mr. Gangal, what's really stood out is AdBlue. You've got, or rather built up now, a 25% market share there. First off, just give us a lowdown on how margins are in AdBlue and how they are aiding your overall numbers.
So typically, AdBlue is an adjacency. It is consumed during in the running of the vehicle across all BS6 diesel vehicles, and which is mandatory. So it's a product which is a consumable. So it gets sprayed over and it gets consumed, unlike lubricant, which lasts longer. So it's a high volume driven market, but obviously the margin profile we have been highlighting in the past has been lower, but it is an I would say essential category to cater to our end consumers who are consuming lubricant. And margin obviously are I would say mid single digit, but are slightly towards that. But overall the volume takes care of the kitty what we get to develop because of this AdBlue category, and we are clearly the number 2 player in the market as of today. And our objective in AdBlue is to cater to the high quality AdBlue, which is required by the OEMs and the new vehicles, BS6 vehicles. So we are clearly in terms of product quality, we are top notch, and that's where we come from. We also are focusing in distribution of AdBlue, and we have now more than 12 satellite plants across India. So it's an important category for us, and we look forward to, because this will continue to grow 20% CAGR for the next 4-5 years is what we believe.
Got it. So that's where top line growth will get aided. Talk to us about the more value added products or the premium products that you're trying to work with. What's the composition of the overall revenue, and what's the kind of margin you're making on some of these premium products, and where does the margin number go for premium products? Just want to try and understand how much of the focus is on premiumization and how will it shift going forward.
So we have actually revealed a Unlock 2.0 theme in the month of June for our next wave of growth. And there we have 3 things, accelerate the current business, premiumize the portfolio, and transform our existing business, including bringing in new product categories like EV chargers, etc. So that has been our theme, Unlock 2.0. Internally and externally, we have communicated to all stakeholders. And within that, premiumization is a key focus area. Across segments, we have not only launched premium products, our sales teams are driven by selling more of a premium product. saying a particular percentage at this moment, or what we are chasing in terms of a particular target is difficult. But the objective is to continue to improve the portion of premium products within all the segments, including B2C and B2B across all product categories.
Okay, but Mr. Gangwal, what's the composition currently, premium versus other?
So, as I mentioned, it will be difficult to tell you the premium versus other, but overall, the trajectory is to improve that ratio within each segment. And our sales incentives and everything is also being targeted to be linked towards selling more premium products.
Okay, well, Mr. Gangwal, I want to understand that your export volumes were around 5 to 6%. Going forward, what is the kind of share of exports in terms of total revenue that you're expecting? And then what are the kind of margins that you're aiming at?
So, a large part of exports are linked to OEM sales. When OEMs are selling their vehicles across, for example, Bajaj Auto today, if they export their motorcycles, we on the back of their exports sell lubricants, which are co-branded products with them. Similarly, with our other OEMs like Ashok Leyland and all. So, our most exports are linked to OEMs exports and we have seen good traction in all vehicle categories, especially in motorcycle and in commercial vehicle and LCVs. So our objective is to give service to our Indian OEMs and on the back of their ride in the overseas markets, grow our export portfolio. We believe that it can be around 8 to 10% in next 2 to 3 years of our total volumes.
And Mr. Gangwal, before we let you go, one last question I want to ask in terms of what the company is doing in the EV and battery segment. How much could these segments contribute to top line growth? And you have 700 crores of cash. Would this be implemented for these segments, or is there a different strategy for that?
So as a part of our transform theme, Unlock 2.0 transform theme, we have invested in certain EV charger manufacturing companies and EV SaaS providers, software as a service provider companies in the last 1.5 to 2 years. And these are businesses which are manufacturing Tyrex, for example, where we hold 51%, is manufacturing fast chargers for electric vehicles. And similarly, our another investment in Indra Technology, they make slow chargers. So we have sort of tried to participate in the EV value chain. These are nascent businesses, emerging opportunities. But with the strength of Gulf Oil in terms of our brand distribution network and our relationship with OEMs, we want to nurture these businesses and take it to a meaningful level. We believe that the charger market, the fast charger market alone, can be nearly $1 billion to $1.4 billion market size in India by 2030. And if Tyrex, which is currently at 8% market share, can continue and grow their market share, you can calculate that it can be $100 million plus opportunity in next 4 or 5 years.
Got it. And Mr. Gangwal, with regard to the cash on your balance sheet?
Yeah, so we have been investing in these new opportunities out of the cash we generate. We generate very robust cash flows out of our current business. And at the same time, you will see that progressively our dividend payouts have increased. And last year, as we speak now, the final dividend of 20 rupees is going to be paid after the AGM. And we had already declared an interim dividend of 16 rupees in February. So total 36 rupees dividend per share translate to roughly 58% payout. So our payouts have been increased in line with the cash we have on the balance sheet, as well as the future we see and the robustness. The board has the confidence in the business. So the payouts have been increased. And at the same time, we'll keep looking at the opportunities in EV and other adjacencies.
All right. Thank you so much, Mr. Gangwal, for giving us a lowdown on the numbers as well as breaking this down for us. Thank you. We appreciate it. Quick time. It's time to slip into a short break. On the other side, we'll be speaking with the management of J. Kumar Infra Projects to talk about quarter gone by. Of course, stay tuned.
Welcome back. You're watching the Small and Mid Cap Show. Well, one company that is in focus on today's edition of SMID is J. Kumar Infra Projects. It came out with its Q1 earnings where revenue was up around 13%, EBITDA was up 14%, and net profit was up roughly 18%. But to discuss as to how the quarter has gone by and how FY25 is shaping up for the company, we're joined by Dr. Nalin Gupta, the Managing Director of J. Kumar Infra Projects. Welcome to the show, Mr. Gupta. My first question to you is that Q1 performance has been pretty good for you. I want to understand that, you have given a target of EBIT margins going up to 15 to 16% from a long-term perspective. At present, they are around at 14%. When do you expect the margin shift from that 14% to that 16% mark?
Well, good morning and thanks for having me here. And yes, the EBITDA margin that we have given of 15 to currently we are between 14 to 15. And as we had mentioned that we should be looking at improving our EBITDA margin by some basis point from 15 to 16%. And for that, we had given a guidance of around 6 to 8 quarters. And looking at the healthy order book and the type of geography that we have backed the order, we are quite comfortable that we should be able to achieve our given target.
Fair enough, Mr. Gupta. Now I want to come to your order book. So now you have guided for a revenue growth of about 15 to 16% for the current year. Taking that into consideration plus the 4x of the order book-to-bill ratio that you have portrayed in FY24, that takes your order book to, taking that in consideration, your order book stands at about 24,000 crore as against your guidance of 22,000 crore. Again, FY24 was a strong year, was a high base, but I want to understand, are we guiding for a conservative guidance over here in terms of order flows?
Well, I would like to mention that currently, as on 30th June, if you look at, we sit at an order book of close to 19,800, say 20,000 crore order book, with a L1 of close to like 6,000 crores, 6,500 crores worth of projects there where we are L1. So this looks, but we need to deduct the current year's top line as well from this. So that's how we are looking at an order book of close to 6 to 8,000 crores for the current fiscal year. Keeping our order book as of 31st March 2025 close to around 22,000 crore is what we are looking at. So that's how I would say it's of course, if you get some good opportunities, there are still 9 months to go. So we are very hopeful that we'll back some orders. But yes, that's the style of J. Kumar to always be giving a numbers which is on the little bit on the conservative side.
Right. And, Mr. Gupta, then I also want to understand that from a longer term perspective, you've guided for an order book of roughly 25,000 crores by the end of FY27. Do you think that you would want to revise these targets then? Because you'll be already doing a significant order book in FY25 itself.
Well, so I would say that, yes, looking at the growth that we had in FY24, I think the target that we had given, maybe we achieve it before 27. But yes, as I would say that, J. Kumar, we always believe in having a strong bottom line and not just the order book or the top line. So we would be looking at and focusing on to works where we can have strong bottom lines and grow with a good financial discipline for what J. Kumar has been doing in the past.
Right. So, this is Harsh joining in, Mr. Gupta. I want to try and understand a couple of things. First off, on your top line for FY25, what's the number you're targeting? Will it be 6,000 crore?
Well, Harsh, I think it's a good number to target. But yes, we are giving a guidance of 15% growth on a year-on-year basis, which is around 5,600 to 5,700 crores. So, yes, always higher the better. But I would say that 15% growth over a base of 5,000 crore, I think it's a decent number. And I would like to still mention the same number. And yes, of course, if there is an opportunity and if the revenue keeps clocking the way we expect, if it grows higher, it is always better.
Right. And margins, I know we came to that, we asked you that. 15 to 16%, how quickly do you get there? Do you get there FY26 exit because you're gradually going up? I appreciate and I acknowledge that.
Well, I would say that this is making a EBITDA of 14.5% itself, Harsh, is a quite good profitability that you can see in the peer competitors, because infra segment making EBITDA of 14 to 14.5% itself, I look at it as a good margin. But yes, our continuous endeavor is to keep working on the margins that the company has been making, and I think we should be able to take it up in next 6 to 8 quarters, and we are confident that we should be able to improve it.
Just a follow-up on that, how are we seeing this higher operational efficiencies coming up? Is it because of a shift in the segment mix that we are seeing the higher margins coming in?
Well, if you look at the size of order book and if you look at the, I would say the overheads that the company has, we have been always believing in maintaining a financial discipline. So, and also the geographies from where you back the orders. So if, currently, Jaykumar, we have been operating into 7 states. And we always try to take up more and more jobs in the same state wherever we already have a strong presence. So that eventually gives in a lot of leverage over your overheads, over your optimum utilization of resources. Like even if you talk about metro, almost like more than 50% of Bombay Metro is done by Jaykumar. Or flyovers again if you talk of. So that eventually gives a lot of advantage in terms of your shuttering, centering, ready-mix plants, in terms of casting and development expenses. So that's how there are a lot of factors put together. And as again, Jaykumar never usually works as a main contractor. We never go for subcontracting or subletting. So that's how the entire margin of the project is retained within the company. And again, if you look at the gross block, we stand all the major equipments that's required for the project are usually purchased by the organization. So that's how Jaykumar can retain even the margins of the equipment hiring companies. So that's how there are various factors put together. And again, the specialized, I would say a very important point about taking up projects which are of core technical expertise, wherein you mentioned of underground metro or talking of the elevated corridor of Chennai, which is a 20-kilometer long elevated corridor. These are all cable stay, double-decker with double-decker clover leaves. Even the GMLR project, again, if we talk of being the largest tunnel ever made in India. So these projects, of course, helps us in getting a better margin and the expertise that the company has.
Right, Mr. Gupta. And now coming to the final question over here, what are your capex plans for FY25?
Well, so incrementally we do a maintenance capex of 100 to 150 crores. But this year, in the coming next 2 years, we expect a capex of around 450 to 500 crores in the coming next 2 years, mainly happening due to the requirement of the 2 tunnel boring machines that we are buying for our GMLR project, and also the other capex for the Chennai project that we have bagged, wherein being in a different geography and being a different nature of work, like it totally depends. Like if we bag MSRDC, once we get this order, the launchers that we already have can be utilized on these projects. But the Chennai project, being a very specialized and a different nature of work, again, the capex requirement at Chennai would be high. So that's how we expect around 450 to 500 crores in the coming next 2 years.
Okay, thank you so much, Mr. Gupta. That's been a good conversation. Thank you so much for coming in and speaking with us. It's a wrap on the SMID show on the back of that. But remember, Indiabulls Housing Finance Limited is now Samman Capital. Jio Samman se. Keep watching NDTV Profit. More on the other side. Stay tuned.
Hi, thanks so much for joining in. You're watching NDTV Profit. My name is Alex Matthew, and this is Ask Profit. Like the name suggests, this show gets you answers to all of your stock-related questions, whether they're short-term and technical-based or long-term fundamental-based. We've got you covered. Before we get to those questions, though, let's take a look at where the markets are right now. And you have the benchmark Nifty 50 that's trading with gains of close to 1% and trading about 24,200. Around this time yesterday, you had similar gains on the benchmark, and then in the second half of the session, you saw quite a bit of selling and the erasement or the removal of all of those gains. The broader markets are looking even better at this juncture, in fact, and you have the mid-cap index that's gaining about 1.5%, similar gains for the small-cap index, and all told, as a result, the market breadth is tilted very firmly in favor of the advances. You have as many as 1,700 plus advances and only 300 or so declines. Now, what does this tell you about what's happening in the markets right now? And this is all related to a global churn in assets. You're seeing an unwinding of the yen carry trade that everyone's been speaking about all through the week. But you're also seeing certain statements that have been made earlier this morning by the Japanese central bank or representatives of the Japanese central bank that spoke about the fact that they may pause interest rate hikes going forward. Now, all that will tell you is that there is global turmoil with regard to assets. There has been quite a big shift, both in terms of the yields on bonds as well as risk assets, particularly tech stocks in the US, and that is having a bearing on our markets as well. In terms of the contributors on the Nifty 50 today, you have HDFC Bank, which is leading the contribution, and you have Infosys as well as ONGC, but not too much to speak of in terms of the gains, not significant gains. On the losing end, you have a couple of the banking names that are leading the declines, at least in terms of contribution, ICICI Bank and IndusInd Bank, but again, not too much to speak of in terms of the losers. Among the sectors, all sectors are currently in the green, but the Nifty Bank has given up quite a bit of the gains from earlier on in the session. It is now trading with gains of just about 1/3%. We are focusing on one particular stock at the start today, and it is from the pharma pack. We're talking about Lupin, and it was up as much as 5% earlier on in the session. It is close to 5% higher as things stand right now, and this is on the back of earnings. We've got Varsha joining in to tell you about the reason why investors are enthused about the results. Varsha, what stood out and what is positive?
Well, thanks Alex for that. So it's good set of numbers. Company did beat estimates on all fronts. If you see, numbers are already flashing on the screen. The performance was driven by new products, key geographies and improvement in the operating margin. If you see, the margin improvement was led by growth in sales and operating efficiencies that company has. Also, if you see the key highlights, let's see the segmental performance also, rather geographical performance. If you see India business grew almost 18% year on year, which is actually good for Lupin, and if you see the chronic share stands at almost 62% of sales. The outperformance was led by cardiology and respiratory. Lupin is actually launching many such products in respiratory as well. If you see the North America business grew almost 28% year on year, which accounts almost 37% of global sales. US sales grew 25%, and company has been seeing 8 consecutive quarters of EBITDA improvement. And in US, growth was led by new launches offset. This was offset by single-digit price erosion in base products and additional generic competition that they are seeing in certain key products. If you see the share of complex portfolio, which stands at 35% of sales. A company is expecting strong pipelines of launches in FY25 in US. If you see the Europe, Middle East and Africa, the sales were down 26% year on year, which contributes almost 9% of global sales. And the active pharma ingredient sales, if you see, were up almost 40% quarter on quarter and 7% year on year, which contributes almost 7% of global sales. So overall, good set of numbers, and it did beat estimates on all the fronts.
I like the words that you've used, Varsha, in the pink of health, Lupin, and in fact that is visible in the numbers. Thanks so much for getting us those details. We've got Shahina Mukaddam, who is independent market expert, as well as Vaishali Parekh, who's a VP Technical Research at Prabhudas Leela, that are joining us this morning. Thanks so much, ladies, for taking the time. Good morning to you. I'm going to come to you, Shahina, on Lupin first. A significant increase in the PAT number, 78%, and on the back of quite an expansion in margins. Are you as enthused as the street seems to be about Lupin, and would you buy into this stock right now?
Yeah, you can buy it, but keep a deep stop loss because the overall markets are volatile. In terms of valuations, now it is just about less than, in fact, 4 times price to book, which is pretty attractive for the size of, Lupin and for the quality of their plants and products. While I believe for the shorter term, maybe next couple of, say a year or so, you could see the US market show a bit of flattish type of growth because just recently they have sold, their women health, some products almost for about $84 million. So that would be a cash flow that they would get, but it would have some impact on the top line for Lupin. But I believe that overall, it looks like a decent bet for the medium to longer term, provided you keep a deep stop loss.
All right, keep a deep stop loss. We've got so several questions have already come through. I just want to remind you, if you're tuning in for the first time, the number that you see at the bottom of your screen, that's where you send your questions. And the first question we're taking today is from Shrikant. He's writing in from Hyderabad. He's asking about Birlasoft, which he's bought 200 shares of as many as 2 years back, Vaishali, at a price of 450 rupees. He's saying that he can hold for the long term, but he's worried about the recent performance of the stock. He's wondering whether to hold or should he book profit and move to something like a Wipro.
So I would say, see, the stock has really shown a lot of corrective move right now. And I would say that, yes, it is showing signs of weakness. But all the same, I mean, currently it is at a good support of 560 levels. If then expect a bounce from here on, and it can go towards 600, 620, that could be the level that he can exit and get into Wipro. But if 560 levels break, then of course he needs to exit. So that is how I would look at the stock, because the stock has already got corrected. I think a bounce is quite possible from here on. So that should be the strategy. Sell on rise.
Sell on rise is the strategy on Birlasoft. Tata Motors is the next counter that we're talking about. And in fact, Sandeep from Bengaluru is bought at levels of 1,082. Elevated levels, if you can look at the screen. In fact, it is currently trading at just over 1,000, so not too far away. But he's looking at holding this for a period of a year. Shahina, on the fundamentals, if I remember correctly, it was a good set of numbers in the quarter gone by. Jaguar Land Rover has done reasonably well. The consolidated profits are looking good. Standalone business is also doing quite well. Would you hold on to this on the fundamentals?
Absolutely, I agree with you. The numbers were very healthy, and we did see a very good demand growth, both in terms of the domestic as well as the global business. We have also seen an improvement in their EBITDA margins. In terms of four-wheeler stocks, I think Tata Motors, despite the run-up that we've seen over the last 1 year, is still one of the most attractively priced in the four-wheeler space, with a very good management, growth prospects, especially in EV. So I think one should continue to hold. I mean, but the investor has made slightly, at the investment at a higher price, but still it's a hold from here.
And what is, so he's saying 1 year, but China, would you expand that time frame a little bit?
Yeah, definitely. Because for the shorter term, you may see a bit of consolidation, no doubt. But for the medium to longer term, there is a good upside from here. So I would say it's not only a medium term, but long term holding stock, portfolio stock.
Yeah, 2023 best performer on the Nifty 50, right? Let's see if that pans out going forward as well. The next question we're talking about is ITC, and we've got Amit from Nagpur who's written in and who's asking, he's bought 3,000 shares at a price of 497.5 rupees, and that's not too far away from the market price right now. Vaishali, he's saying that he's got a time frame of the next month or two. From that perspective, would you hold on to this?
I would say so, because right now also in a corrective market, ITC acts as a defensive. So if he has to hold on just for a month, I would say 475 should be taken as a stop loss and continue holding, because FMCG should be the safe haven right now. And from what we are seeing, its move is quite positive. So this can go towards 525.30, taking a month's horizon. All
right. Those are the levels to watch out for on ITC. Narayana Hrudaya, I struggle with this all the time. Narayana Hrudayalaya. Which Prabhu from Mumbai, or Ramesh from Mumbai, has bought at levels of 1,248. He's asking, is this the right price to accumulate the stock? And since it's not a fundamental question, he's asking whether to hold or sell or accumulate at this price. I'm going to come to you, Vaishali, and hopefully you'll have better luck saying the name.
Well, Narayan Rudralaya, that's the one. It's just been consolidating. There is no trend right now. It is just at a good support level and a cluster of moving averages. So why not? That holds as a very good support. It should hold as a very prominent support. So in my opinion, he can accumulate from these levels.
And what are the levels that you would watch on the upside then?
Well, so I would say on a near-term basis, 1150 should act as the support. And right now, I would just observe a range of 1150 to 1330. Once we see a move above 1330, and if it sustains above that, then it's on a further upward track towards 1400 and so. So that is the way, for now, the strategy should be played.
All right. Shabir Surti has got this next question. He's asking about Walchand Nagar, which he's holding at levels of 98 rupees. Okay, so actually, I'm going to take this because it's relevant for not just Shabir, but everybody else that is looking at this IPO. First Cry IPO, which is open right now. Shahina, have you looked at the prospectus and what's your view? Would you suggest subscribing to this?
No, I'll pass the question.
Oh, you'll pass the question. Oh, fair point. Yeah. Okay, then I will go back to you, Vaishali, on Walchand Nagar. Bought at levels of 98. What would you do? Would you hold, and what's the target that you would have?
So if he's bought it and he's holding on for such a long time, I would say continue holding. I don't say that there won't be a possibility of this stock seeing some erosion. But when I'm looking at a monthly chart, and I'm seeing that the stock has given a breakout even on a monthly chart. So I think, in my opinion, this is all likely to go towards 500 and higher. So if you're not bothered about the whipsaws that the market can witness in a market like this, then I think you should continue holding.
All right. We've got Chris who's asking this next question. It's about data patterns. And Shahina, I'm wondering if you have a view. He's asking buy, sell, hold, accumulate. What's the view on this one? And what fundamentals are you watching for?
Yeah, it would actually be, if you're just a very short-term investor, then yes, the valuations are very expensive. It's a niche business, so you can sort of book your profits, but it's in a good, defense related also. So to an extent, the growth is likely to be pretty good in the longer term. So if you're a longer-term investor, yes, you can continue to hold. But for the shorter term or medium term, I feel it will be in a consolidation phase.
Okay. Teja has got this next question. Teja, you've got a lovely name. He's asking about Snowman Logistics, which he's bought at levels of 83 rupees. 1,000 shares have been bought, and he's wondering what the strategy should be. Vaishali, on the technical, Snowman Logistics, not something we speak about very often. Would you hold on to this?
I would think so, because it's quite unaffected by the corrective move that we are witnessing, and it is overall in a trending way. So I would say that can average more even at 75 levels, because long-term horizon, if you see, the stock is getting into the new price territory. So in my opinion, this is a hold also.
All right. Vinay from Andhra, and I guess I'm coming back to you on this one, Vaishali. Marine Electricals, I was trying to pull up the chart. I'm just trying to figure out what the market capitalization of this particular counter is. Just about 3,400 crore or thereabouts. Stock is trading up as much as 5%. It actually is at upper circuit right now as we speak. He's bought at levels of 250 for the long term. Would you suggest a hold or an exit?
I would say hold, because stock, even now, if I'm looking at the near term, that is a daily chart and all, it is getting into a new round of momentum. 220 acts as a good strong support. View gets negated below that, but till then it is a hold. It can go towards 285 to 300 for now.
All right, that's a view on Marine Electricals. We have to slip into a very quick break. Shahina as well as Vaishali, do stay with us. And viewers, we'll be back on the other side to take more of your questions, so do stay tuned. Welcome back. You're watching Ask Profit, and we're in the midst of taking all of your questions. The first one that we'll take on this side of the break is RVNL, Rail Vikas Nigam, and it is currently trading at 556 or thereabouts. It's up as much as 1.8%. We've got Sushila from Bellary, who has bought at levels of, she says 154. That's quite the buy price, Sushila. Would you hold on to this one, Shaina, based on the kind of gains that it's had? This is a multi-bagger for a lot of people, but would you take money off the table?
No, I think while it is expensive, I would still continue to hold it for the medium to longer term. Short term, I think the overall market has corrected a bit, so you have all stocks, special railway stocks correcting. Valuations are slightly on the higher side, but given the order book size and the performance that they already reported in the Q1 likely to continue, I think it's a good hold. It could become a portfolio stock in the medium to longer term.
Okay, I'm trying to pull up HBL Power Systems, and as I do, let's try and pull up the chart and see where it's currently trading. It's up, it's doing quite well today actually. It's up as much as 3.5%, and we've got Rajkumar from Bengaluru who's wondering whether to buy in at this current juncture. Vaishali, does today's strength indicate a longer term trend, and would you buy into this right now?
Actually, most of the power stocks are really unaffected by this. Power stock is still showing a lot of strength. And talking about HBL Power, yes, it is got a good gradual uptrend. So, according to me, there should be a buy at every decline. However, if you're asking me currently, yes, 550 acts as a support, and we are seeing a good momentum coming in. So, these are good levels to start buying, accumulating.
Okay, 16% over the last 3 months. Not a bad run for this stock. Adani Energy Solutions is the next counter that we're talking about, and it's been in focus in the recent past. But we've got Ramya, who's bought at slightly elevated levels, 1,228. The stock is currently trading below that, just about 100 rupees or thereabouts. I do not know the quantum, Shaina, but she's holding, and she's wondering whether to keep it. Would you hold on?
Yeah, in terms of valuations, actually, it's very difficult to, give a buy on it. But I think there's a lot of buying coming in, a lot of interest in the stock. Of course, the prospects are very good given the very aggressive plans that the company has got. So I think it is a good hold at current levels. We hold it with a stop loss.
Okay. Just a standard disclaimer, if you've been watching this program, you will know this by now, but I still have to say it. NDTV Profit owned by the NDTV Group, which in turn is owned by the Adani Group. We've got the next question coming in from Hari, and Hari's asking for a short and medium term view on RPP Infra. He has bought at levels of 210 rupees per share, and he's looking for both the short term as well as the medium term outlook. The stock is currently trading at 212, which is very close to his buy price. Vaishali, on the charts, how does it look?
It looks very strong, and it's in a very strong uptrend. I would say that if he's holding, continue holding. We have target projections coming to around 250 from here.
250 is the target on this particular counter. The next question that we're taking is on Ujjivan Small Finance Bank. And Manoj has got this question. He's holding at levels of 46 rupees. He's asking whether to continue to hold his stock at the current juncture, or should he add more? Should he sell? Shahina, on the fundamentals, what would you say?
I would say it's better to exit Ujjivan. Small finance bank. I think there are better banks that are available at similar valuations, and in terms of performance, I think it's better to switch from Ujjivan.
Okay, what would you buy then?
I think in the same category, something like a federal bank. I think that would look interesting at current levels. Even an RBL actually would look more interesting.
Fair point. All right. The next one is on oil stocks, and I'm coming back to you on this one. We've seen quite a bit of volatility, though crude, China is trading at, last I checked, talking about Brent crude at about $76 to the barrel. I'm not actually sure whether he's talking about, Satish, by the way, is talking about upstream or downstream oil companies. What's your view on the sector, though, and which would you buy, if at all?
Actually, at current, with crude closer to $75, though, of course, there is, consensus that it will not go below that. And it is a very, it's good level considering the upheaval that's going on in the Middle East. Given these factors, I think both upstream as well as downstream both look good at current levels. We saw the ONGC numbers that came out, which were very healthy, and they're talking of good, strong growth. So upstream definitely looks good. Downstream also, I believe BPCL looks very interesting at current levels. So I would say that both the segments are looking like decent hold at current levels, given the fact that valuations have actually remained pretty stable in the shorter term. Last couple of months, they have not really moved up substantially, so valuations are decent.
Okay. The next counter is Exide India, and we've got Naman from Delhi who's bought at levels. I actually don't know the level that he's bought at, but he's he's asking whether it can be bought at the current levels for the long term, and he's defined that, China, as the next 10 to 12 years, which perhaps is a little too long for you to gaze into the future and guess what the fundamentals would be. But the prospects have been good, right? If you're talking about electrification and electric mobility and the course that the company has taken, what would you say about buying at the current levels, though?
I would say buy it at dips. You can use every dip to keep adding on to Exide. Not only are they doing well in their core business, batteries for ICE vehicles, but also they have got good plans in terms of R&D and in terms of capacity putting up for the EV segment. So it's a buy on dip strategy that I would give for Exide.
Okay. The next question coming in is from Rahul, who's writing in from Haridwar. He's bought Mukta Arts, and I must confess that I've not really come across this counter. Mukta Art, which is currently trading at 75, doesn't look like it has too much in the way of volumes. It is up, though, as much as 43% in the year so far. Vaishali, if you can possibly pull up the chart, what would you suggest? He has 100 shares, but I'm not sure at what purchase price. What are the trends that you're looking at?
I think it's in a good consolidation. If the stock goes above 76 levels, it could get into a trend and then look for a target of around 82 to 83. So right now, there is not much that is happening. But yes, a broad-based consolidation with the support of 66 and 76 as the hurdle. So it needs to sustain above 76 to make a view for higher targets.
Larsen and Toubro, Shaina, much has been said about the fundamentals. Of course, the order book and all of that looks great. But in terms of execution, there have been comments that have been made about the need for manpower, and there was not too much in the way of action in the first quarter. What would you say about holding this for the very long term, though, as a portfolio stock?
I definitely believe it's a portfolio stock. With the type of infrastructure that is being planned over the medium to longer term, and the investments that are going in. Until now, it has been largely from the government, but I think as the private sector also starts, pumping in, increasing the capex, L&T is definitely going to do much better going forward. Middle East also, they're getting very good orders from there. As you mentioned, order book is very strong, so it remains like a good hold. While the stock has moved up, valuations are not cheap, but if you're taking the very long term, medium to longer term, it is an interesting hold.
All right, Lionel, I hope that answers your question on Larsen and Toubro. It's a hold, and I understand that you've already bought this. Motherson Sumi or Precision Camshafts, which one would you enter into right now? And this is a question from Vijay Reddy. He's asking this question from Delhi. Both from the auto Ank space, Vaishali, on the charts, which looks more interesting to you right now?
So Motherson, basically you're talking about Samvartan.
That's
it's
right.
Already a good trend. So I would say that means the stock has shown strength and it should continue. So my preference would be Motherson, that is Samvartan's 177 levels. That would be the stock that I would choose for now.
Okay. Jigna Thakkar is asking about Hindalco, and we've seen a bit of a negative development last evening with regard to the CBI investigation into a case that was quite a while back. The stock is up as much as 2.5% though in trade. Is there anything to worry about here, Shaina? Is an investigation that has to do with mining in Odisha. Would you be worried about that? Would you buy into it based on the fundamentals?
Well, I think in the shorter term, there are a lot of negatives that, news flows are likely to keep the stock a bit weak for the next couple of months. We also have the the possibility of additional payments to be made to states for mining. And the metal prices are remaining pretty stagnant given the fact that China, the demand has been soft. So I think if you really want to buy metal stocks, and Hindalco included, it is better to wait, better to buy it at dips, watch what the news transpires over the next couple of months, and then you can enter into some of these metal counters.
All right. Unfortunately, we're completely out of time at this juncture. I'd like to thank both Shahina as well as Vaishali for taking the time. Always a pleasure having you on the program. Thanks so much. Now, viewers, we've tried to answer as many questions as possible. Unfortunately, several of you got missed out. Hopefully, the answers we've discussed have benefited you in any case. We've got lots lined up over the course of the day. Do stay tuned. This is NDTV Profit.
Welcome to Earnings Edge. This is Mahima Vajrajani. Well, before we move on to the managements that we're going to speak to in this edition of Earnings Edge, let's take a quick check on what the markets are doing. Well, the markets are trading in green, up and above in green as we speak. Let's pull up the benchmark indices. The Nifty 50 is trading at 0.1% higher, so it's off from its day's highs at present. The Sensex is also trading at roughly 1% higher. The Sensex is also cooling off from its day's highs, trading at around 0.8% higher as we speak. But let's also pull up what the broader markets are doing in comparison to what the benchmarks are doing at present. Well, the broader markets have sustained the gain throughout and at present are almost at its day's highs. The Nifty Mid Cap 150 is up around 1.6%. The Nifty Small Cap 250 is also up around 1.7%. Nifty Small Cap 250 is also sustained its gains and almost is at the day's high. Let's also quickly pull up the contributors on the Nifty 50. Well, a lot of good stocks weighing up the Nifty: HDFC Bank, Infosys, ONGC, L&T. But something that's not doing very well in trade today is Bharti Airtel, IndusInd, Asian Paints and Kotak Mahindra Bank. Let's also quickly pull up the breadth the breadth of the market in terms of the advance and decline ratio. Well, the ratio has been sustained to that 6:1 mark, whereas there are 6 advances versus versus just 1 advance for every stock. We have around 1,800 odd advances versus 280 odd declines. Let's also quickly pull up what the sectors are doing. All sectors in green as we speak. There you go, Nifty PSE, Nifty Metal. All of them up and above in trade at around 2%. Let's quickly pull up what is doing very well in Nifty PSE if we can. The constituents of Nifty PSE, what's pulling up the Nifty PSE to that 3% mark almost. There you go. There's Oil India up around 7.8%. ONGC up around 7.12%. Coal India up around 5%. LIC also up around 3.3%. But let's also quickly pull up Cummins India. Cummins India's con call is going on, and which is why the stock is doing very well in trade. There you go. The stock is up around 4.6%. Let's also quickly pull up Tata Motors, what it is doing. The Tata Motors new launch is in progress, and there you go. The stock is up around 0.6%, so not doing very well, not doing much in trade, in fact. Let's also quickly pull up some earnings that came in post-market yesterday. Let's pull up what Gulf Lubricants is doing. The stock is doing very well in trade today after a good set of numbers. The stock is nearly up 7% as we speak. But let's shift focus to Symphony, and it came out with its Q1 earnings. But to discuss more about how the quarter has gone by and how FY25 will shape up for the company, Lupin Shah, Managing Director of Corporate Affairs at Symphony, joins us now. Welcome to the show, Mr. Shah. I want to understand that you've had an extremely good quarter, and this is, I reckon, it's on the back of good summers that have taken place in the quarter so far. But I want to understand overall, what is the demand outlook like, and how much of this is value versus volume growth?
Thanks. No, so there has been phenomenal demand in summer, but it was also on back of series of initiatives and strategies on which we were working during COVID and post-COVID, including launch of path-breaking models, penetration in semi-urban and rural market, D2C e-commerce and alternate channels, and also adjacent product category. So it's a combination of all that. And hence, probably, in summer-related industry, air cooler, I think, has registered the fastest growth, which otherwise there was some skepticism probably in the mind of some of the analysts that air cooler may not be a viable category or may not grow much. But in reality, not only in the cooling appliances category, but across summer-related industry, air cooler has registered the fastest growth. And this is true not only in India, but we know very well because of our international presence. Even in overseas markets, that's the reality, especially considering climate change and summer warming up year after year. And hence, currently, whether at a company level or at a trade level, in India, almost across the geographies, in Mexico, Brazil, and few of other overseas countries, the inventory is much below normal level.
Right. And just to give a context for the viewers, can you tell us and quantify that value versus volume growth for us? Have you taken any price hikes? Overall, what was the volume growth for your business in Q1 FY25?
So on account of competitive reason, we exactly don't share that, but you can take it that value growth is almost in line with volume growth, something here and there, or subject to product mix change. As far as price hike is concerned, effective 1st July, there has been a price hike in some of the models. In some of the models, tactically there is no price hike. And just yesterday, we announced launch of 17 new path-breaking models across 6 range. And they are at a premium level in terms of the tranquility and calmness of the cooler along with the efficacy, and some of the models are really at an entry level to take on certain local players or so-called partly unorganized players. And for the first time in our history, at a time in 6 range, 17 new models have been launched.
Okay, and Mr. Shah, so all of these new launches, you've said that you've launched 17 new launches. I want to understand that what is the kind of top-line addition will these products, give for the entire FY25?
So as per our IR policy, I can't share any specific guidance for the quarter or year or otherwise. However, we are very optimistic about the potential as well as top line and profitability growth on back of summer 24 performance.
And a lot of FMCG companies, Mr. Shah, have seen a significant rural demand uptick, and in a lot of cases, the rural demand has outpaced the urban demand. What is the trends that you're observing in the consumer durable space? Then has it been the same case in Symphony as well?
No, absolutely. There has been a same case, but it's not only on account of the rural demand. It's also on account of the kind of the network what we have created in the rural and semi-urban. And on top of it, we believe that still lot can be done and miles to go. Once products are available, appropriate network is created, I think there can be further boost.
Got it. And Mr. Shah, despite the significant uptick in revenue, the cost of raw materials have come down. So what is exactly happening there? What is the kind of raw material price trends that you've observed in the quarter?
No, in the quarter, I think raw material price by and large was for us almost in line with earlier 2 quarters. But it was also on account of partly tactical pricing and sales mix, on account of which we could increase the gross profit margin percentage.
Okay. And Mr. Shah, I also want to understand that, you have announced a buyback. Do you think that the promoters will also be participating in the buyback?
So just yesterday, less than 24 hours before, Board of Directors have recommended and announced the buyback, including the amount and pricing. So yet to take a call on that. But to me personally, I don't think it's an appropriate question, because whenever there is a shareholder payout, it can be in 2 forms, dividend and share buyback. If it is a dividend payout, this question is never raised or asked, because all the shareholders in proportion to their shareholding get the dividend. Why it shouldn't be applicable to share buyback also? On the contrary, in share buyback, if we consider end-to-end, that is, company pays the income tax versus shareholders pay, then in share buyback, net inflow to the shareholders all put together is about 8 to 10% higher than dividend.
Right. Okay. So basically, the buyback that you've done, what you're saying is done in the new budget announcement. There has been different changes in buyback rules, and that company is now not going to pay the buyback. So do you think that you've announced the buyback to take the benefit of this then?
Yes, one of the reasons, but at the same time, buyback also conveys the management and company's view about its future, about its potential and true value, along with whatever slightly accretion in EPS, and hence when there is a surplus, why unnecessary to burden the equity?
Right. Okay. And, Mr. Shah, in terms of your Australia performance, revenue was down around 14%. And there are some kind of demand headwinds that Australia business is facing. Give us some color on that, and when do you expect a recovery there?
So in Australia, certainly there are demand headwinds because there are some economic and macro factors, particularly post-COVID. Many real estate players are facing major trouble. And until recent past, our substantial sale was attached with them. So that was number one. However, despite decline in sales because of successful implementation of Part 1 transformation strategy, which was essentially substantially reducing the cost of doing business, we have reasonably contained the losses. As far as Part 2 strategy of our transformation is concerned, it should be in place by September, and we expect that in December quarter and then after, there should be further uptake, and 25-26 should see the complete reflection of that transformation.
Okay, got it. Mr. Shah, one last question before I let you go. Your treasury position, that is your overall cash position, is around 534 crores. What are your plans with respect to this kind of cash that you're sitting on? I believe buyback will be a part of it. But apart from that, anything else that is on the cards right now?
So, in current quarter, at a console level, our PAT is 88 crore. Buyback amount, interim dividend, and taxation and expenses put together on buyback, all in all at a company level outflow will be about 98 crore. So it's almost like 115% of the quarterly profit which is being paid. And our stated payout policy is at least 60% of the PAT. So we will see down the line, but as such, immediately there are no acquisition plan unless there are some compelling opportunities.
Got it. Well, Mr. Shah, thank you so much for giving us those insights on Symphony and taking out time and speaking with us at NDTV Profit. But with that, it's time for a short break. On the other side, we'll speak to the management of Raymond Limited, so stay tuned. You're watching NDTV Profit. I'm Mahima Vachhrajani. Well, Raymond Limited is in focus. It came out with its Q1 FY25 earnings where revenue was up nearly 98%. Margins have improved from the 9.7% mark to that 11% mark, and profits from continuing operations have grown by nearly 27%. But to discuss more about how the quarter has gone by and what FY25 looks like for Raymond Limited, we're joined by Mr. Amit Agrawal, who's the Group CFO at Raymond Limited. Welcome to NDTV Profit, Amit. My first question to you is your sense of how the quarter has gone by so far and how FY25 overall is shaping up for you.
Thank you very much for having me on the channel. It is indeed a pleasure to say that our businesses have done very well. Now, before I start, let me give you certain clarifications that the Raymond Limited numbers which we are presenting and talking includes the real estate and the engineering business, because our lifestyle business has been demerged on 30th of June 2024, and that's separate into Raymond Lifestyle Limited, which will be listed in the next 45 to 60 days. So very clearly, the lifestyle numbers are not in here. It is just the engineering and the real estate business. Now, let me talk about two businesses, how it has been. And I think very, very clear. We have spoken earlier also that our real estate business is the unique philosophy under which we operate, that you build fast, sell fast, and collect fast, enables a business to grow at a very fast pace. Now, we have got a significant amount of land bank of 100 acres in Thane, which we are developing at a faster pace. We started our JDA project outside of Thane, which is at Bandra, and there we have seen an overwhelming response from the customers in terms of sales booking, which is clearly reflected. If you see, more than 600 crores of sales booking has been done in the first quarter. So that is very, very clear, a strong sign of our business, and which we talked earlier, that we are in a path to become a 4,000 crore sales booking revenue company in the next 3 to 4 years on an annualized basis. Now, as far as engineering is concerned, as you all recall, that on 29th of March 2024, we acquired the Mining Precision business, which is operating into aerospace, defense, auto, ancillaries business. And I think that business, the full contribution of that revenue in this quarter of close to 230 crore has added into the revenue of this year. There also we see a very significant opportunity for growth, because, aerospace defense is something which India today is almost only 1% out of a $100 billion industry. And I think as a country, we are very clear destined with China plus one and with our precision skills that we can take 1% of this $100 billion industry to anything between 2 to 3%. And we, as Mining Precision or part of the Raymond Group, we are clearly destined because we supply engine critical components. And most difficult is to get into that company, get into those customers, and once you get into, then you continue to expand your portfolios. So these are the two broad reasons how we have grown, and we continue to see a significant growth even in FY25.
Right. Mr. Agarwal, I believe that both your engineering business and realty business are doing pretty well. But, talking about your lifestyle business, overall the revenue was down around 8% and textile business has taken a hit of around 18%. So, first of all, I want to understand that how are demand trends in the lifestyle business, one thing. And secondly, this entire Bangladesh crisis that has taken place, does that affect your overall business?
Yeah, sure. So look, lifestyle business, I think lifestyle business, we are building on a very robust long-term basis. Okay. In the first quarter, we all know that there was very excessive heat. Second thing, there were no weddings. And kahavat hai ki India mein koi wedding nahi hogi jab tak Raymond ka suit nahi silao. So to that extent, when you don't have weddings, you are seeing significantly larger number of weddings happening in the second half of the year. So that is the other reason. Third thing, because of elections, people were busy into some other things, getting into some holidays were there. So people were not coming out and shopping. So these were some of the 3 or 4 plus the inflation. So these were the 3 or 4 factors which impacted the demand for our products. Now, it is a very temporary blip, but we know the weddings are going to be in a very large number in the second half of the year. And every time when you have a large number of weddings, the demand and festival seasons comes in, the demand picks up. And we are very confident that that demand is going to pan out and will get the benefit. So we should not really look this business as 1 quarter business or a 2 quarter. And traditionally, always the first quarter has been a seasonally weak quarter. Now coming to the opportunities, we clearly see Bangladesh as a great opportunity. Bangladesh, because what used to happen was, we are an integrated player where we were supplying the fabrics to Bangladesh, and some of the larger customers would get it stitched out of Bangladesh because of the FTAs. They enjoy the duty benefit, which makes them much more attractive compared to India. However, still we have built a large business of over 1100 crores in the garmenting export business, which is attractive, and we are going to continue to expand. And I think the unique thing which we have as an advantage, we are investing almost 200 crore of capex as we speak today, and that capex is to additionally 1/3 increase in the capacity. Now, since we have the capacity, people, our customers, are in a position to shift from today to tomorrow the products and take the delivery from us. So in every such crisis or challenges in the marketplace, we see a great opportunity for us. And I think India as a country, because of this crisis, what has come, which is around $50-55 billion of exports, which Bangladesh would do primarily on the stitching part, has given us an opportunity to participate. We have seen a significant growth in the China Plus One. Now, similar is an opportunity. And I think if I look at it, these crises also enables us to become much more stronger, agile, so that you can quickly adapt and get new customers. So looking forward for a very strong overall lifestyle business overall, because retail is something, it will come back. It is only a question of 2 quarters, 3 quarters, it goes into trouble, or people don't buy, inflation, but people want to wear. And we have also, let me add also, we are also adding some new product lines. Let's say example, sleepwear. Now I consider sleepwear is not more a discretionary, it is an essential like an FMCG. So what happens is, we have launched that sleepwear, which is very attractively priced, and we are creating the distribution strength for that. So clearly that product can become a very fast selling product and can create a larger revenue. And
I want to understand that in the retail business, you're planning to add 200 plus stores, which will be asset light. But I want to understand that will this be done through internal accruals, or you'll be raising some funds for this particular thing?
So actually, the best part with the Raymond is that we have got franchisees who have been working with us for more than 60, 70 years. And this is just an extension for these franchisees that today they own a TRS, the Raymond shop, or a Park Avenue, and tomorrow they will open one more shop of the Ethnics or a Color Plus or a Park Avenue. So to that extent, I don't think so we have required to make any larger investment. Some advertisement and such things we need to do, but fundamentally it is the investments being made typically by the franchisee. Some 20-25% of the stores which will be open, there also it is not a capex model, it is a rental model where we'll pay the rent and which is a periodic cost.
Right, got it. And any particular geographies you're planning to expand in, one thing, and your export versus domestic number right now, and what are you aiming at?
So if I look at in the lifestyle business, I think very clearly we are opening the stores in tier 1 to tier 6. Very simple, jo dikhta hai wo bikta hai. So if I don't have a store, then the ability of a customer to walk into this place will not be there and he would not buy our product. And cities are expanding. So first of all, even if I look at a tier 1 and 2 and 3 cities, the cities are expanding. The periphery was here, the central was here, and the periphery is expanding. So we are trying to locate the right store in the right mall or on the high street in the newer areas in a tier 1, 2 and 3 cities. And ethnics, very clearly we are opening stores where is the big marriage purchases happen. There you are opening the ethnic stores. And the tier 4, 5, 6 cities, I think the whole focus of a young consumer in these cities is that if the product is available, then I'll buy it. And we are very clear that from an e-commerce point of view, compared to a touch and feel product, is still very, very large. So the brick and mortar has a very significant role to play in the retail business.
Right. And one last question, Mr. Agarwal, what is the kind of ticket size that you're targeting when you say all of these tier cities that you're targeting? Any particular ticket size that you're targeting?
So actually, I would not call it ticket size because I think more is a store size, which we are looking in depending upon other than ethnics, practically anything between 1,000, 1,100 to 1,500, 1,600 square feet. That's a store size. And maybe the ethnic stores are slightly larger. And I think that is a way we need to build. And what we want to give to the consumers a delight. When they come, they get a great experience. It is also not just to sell the shirt or a trouser or a kurta. I think it is also a delight, and retail is a therapy. So you have to experience that. And I think that is the fundamental which we want to make a difference with our stores in the manner and the look, the which people get an experience when they walk into our store.
Right. I think what you rightly mentioned is retail is therapy. Well, it's very true when it comes to the psychology of a customer when he or she buys. Well, Mr. Agarwal, thank you so much for giving us those insights and giving those comprehensive answers to us on Raymond Limited. And all the best for FY24 and the future. And thank you so much again for speaking with us at NDTV Profit.
Hello and welcome to NDTV Profit. The market regulator came out with a consultation paper which basically brings in restrictions for offshore derivative instruments or also called as participatory notes. It also equates the kind of compliance and regulations which are available, which are existing for foreign portfolio investors in India to those being held through FPI route or ODIs held through FPI route. And to discuss this consultation paper, I have with me Moin Lada, who is the partner at Khetan and Company. Moin, what is the first impression from the consultation paper that you get?
I think the first impression is that the regulator is very keen to take as many measures as possible to get to the back end of beneficial owners, discourage derivatives generally, and P-notes or offshore derivative instruments, as we call it, have always been the bad boys and have always been under the radar since almost a decade now. So this is yet another measure which makes it more difficult to be issued, as well as, it makes it more unattractive. So I think these are my initial impressions, honestly, on the discussion paper. Obviously, it's still a discussion paper and there will be a finalized regulation based on the feedback. But this is really what I think about it.
If you look at some of the key regulations or the key proposals which are coming through in this discussion paper, the one being which came in August 2023, which is concentration and size. Now that was something which was imposed on the foreign portfolio investors who are registered in India, and many of them were given 6 months to a year to comply with them or redeem their investments from the country. Now the same has been put on the ODIs as well. How do you see this playing out for them?
I mean, see, none of us will say that ODI had any relaxed beneficial ownership disclosure requirements. This started off as a route to avoid regulatory complexities and yet access the Indian markets. But over a period of time, it was looked at as a route which was misused on certain occasions where beneficial owners were not disclosed. So Sebi has consistently required additional details, regular interval details of beneficial owners. This amendment now, I think it has a twofold impact. One is that one will have to see how at a subscriber level the implementation will be done, because there is the FPI related amendment had a twofold requirement. One was driven by how much market exposure you have in the Indian market. And the second was if your single stock exposure was 50% or more. Now with and while there is a solution proposed in the discussion paper, one will have to see how in a segregated or a sub-fund level system where the fund has multiple funds, how this compliance will be undertaken, and whether if one cannot undertake this compliance, then essentially it becomes ineligible. They need to liquidate, they need to give up. So whether it really means that one will be able to do such subscriptions is also going to be one question.
The interesting fact is that the sub-fund level or the segregated level was not even applicable in FPIs for FPIs today. Now it will be applicable for FPIs and ODIs. So from we are taking off from what we did in August of 2023 and going back or going forward to another level of micro level where you can do it. And I think one of the biggest concerns with many of the FPIs or market intermediaries had was that it's very difficult for them to monitor these things at that level. How do you manage such a kind of concern for the FPIs then?
Well, I think on the aspect of segregated funds, there was a regulatory arbitrage so far as these ODIs is concerned. My personal thinking is that even if you managed it through sub-fund segregated funds, as an FPI, the disclosure you were required to make if you had a single entity exposure of 50% or single stock exposure of 50% or more. And I think you're right. Managing compliance is always going to be a challenge. But I think the thresholds are large enough. At an FPI level, I don't think this should be very difficult to do. At an ODI subscriber level, given the fact that the ODI subscriber is using this route, assuming it's a genuine investor, to reduce complexities, are we really reducing complexities is the question. And whether the number of additional intervals and daily reportings that will be required, whether FPIs will be keen to further continue or use this route is the second question. And the third, I think, amendment is that you have to have a separate FPI registration only for these purposes. Maybe this will bring some ease on monitoring compliance, because commingling and using the same FPI for your proprietary investment and as well as managing ODI underlying investments has always been a greater challenge.
Yeah, that's true. We saw that happening in some of the stocks last year as well, where funds came in and shorted some of the companies there. But specifically on the issue of separate registration for ODI FPIs, is it going to increase the compliance cost, and does it make it now more suitable to come directly to the Indian market?
I think that's the intention of the regulator, that if you want to get the benefits and advantages of the Indian market, you better come directly. You register, but you see there is a broad basing requirement. There is an annual compliance requirement. There are various conditions. So it depends on how committed the investor is to our market. I don't think it still becomes as complex as registering as an FPI. And on your question of separate registration, that is for the issuer. The issuer needs to do that. And it's only a question of how attractive this model as a business will be for issuers. And eventually, when we have the final amendments in place after the comments on discussion paper are considered, will we know whether this really remains as a model, or is this an indirect way of saying that we reduce it even below 2.1% or to a very, very minuscule percentage.
Is there a route available, Moin, and I don't know whether you will be able to answer that, of a liberal regime if you're coming through a gift city?
No, coming through a gift city, I don't think the Sebi has given any exemption if you're following and press P-note. I may be wrong, but I don't think there is a liberalization or reduced disclosure requirement if you're coming through gift city. That's more to do with accessing overseas market, in my view.
Okay. Another thing which was the biggest issue, and though there is not much of an exposure there, is the benefit which was given to ODI with respect to hedging of positions, right? If you have a position in India, you can hedge them on a one-on-one basis into the derivative markets in India. Now, Sebi has withdrawn that exemption provided to ODIs. Will that be a big deterrent? Even though if you look at with what the data has been provided by the regulator, none of the ODIs have an underlying derivative exposure except for the issuer, which has some 3,000 odd crores of exposure.
I think, I'll try my best to answer this question. There may be financial mechanics to this as well, and as a solicitor, I will have limited, understanding on that. But the thinking was, and what I could understand is that there is multiple levels of leveraging, and there are multiple levels of, derivatives involved in certain situations. So ODI per se is like an offshore derivative instrument which has an underlying stock, correct? And you're using an ODI further down to leverage with a derivative instrument is another issue. So I think those multiple levels is what is trying to be addressed. And yes, it was allowed on one-on-one basis. To my mind, it will still be allowed on one-on-one basis, but in the cash segment, really.
So basically, you create a synthetic structure at the ODI level and then come and hedge in the cash market. That's what it means, right?
Yeah, and as you know, and you must have, as you've seen over the last few weeks, we are getting more and more sensitive on how our derivatives market and the derivative securities market is being controlled or handled. And someone taking positions in the Indian derivative market only with the intent to hedge really creates a sort of a risk for the investors. That could be one of the thinkings that Sebi would have had with this proposal.
Over a period of time, we have seen a shrinkage of the entire, P-note area from 44% to now 2.5%. But in terms of value, is still much higher. I mean, 1.4 lakh crores coming through the ODI route, which is there, and that compares to 2.4 lakhs, at 2007 level, which is there. But the concentration of AUM in the hands of few. Because number of FPIs have also moved from those jurisdictions to directly into the Indian market. Is that something worrying Sebi?
It could be one of the concerns. It could be one of the concerns that is, worrying Sebi. But I think the real intent seems to be that whoever it may be, it should be a genuine investor. And it should be someone who is not misusing the route to make an investment to get around any limits that are prescribed under the takeover regulations, say, or limits for non-public shareholding. So that could also be a few other concerns Sebi would have thought of, while proposing this discussion paper.
Do you see some kind of resistance coming against this consultation paper?
I see. I mean, it can really depend on what is going to be the impact on an FPI to be able to leverage its position in the Indian market. If that really happens, there may be some resistance. And as you know, this is still not law. So we do have the opportunity to put, comments and provide data to substantiate if there should be another measure or a more easier way to leverage if cash, one-on-one basis, security to security, cash to cash, hedging is not possible. Apart from that, I don't know what kind of resistance one can make so far as disclosure requirements are concerned, separate registration requirements are concerned, because this is the discretion of the regulator generally.
Is it fair to say that at the end of it, it's basically the issuer, which is the issuer of ODIs, and the DDPs, dedicated depository participants, their role and their compliance levels and the complicities of their life is going to increase if this discussion paper goes through?
That is correct, and they've been used to complexities increasing at regular intervals, so I think it should be manageable for them, but on a lighter note, really. That's really a good summary. I agree with you.
Moin, thanks for joining us today and giving us your perspective on this consultation paper. Thanks for joining on NDTV Profit.
Thank you very much. Thank you very much. Thank you.
Radhika Gupta, back at our Mumbai studio, we pretty much watch out when is it that we are getting you on our air. So it's great that you're here in front of me right now. But You heard what Mr. Damodaran said about regulations and the way that regulatory environment in India is currently, right? We've seen, the RBI governor say a few things. We've seen Sebi chairperson say a few things, and then same evening, come out with a consultation paper that scared the living hell out of everybody. But, and then them coming out and clarifying things. I want to get your view as somebody who's a regulated entity or who runs a regulated entity. How do you see this whole regulatory environment in India? Are we talking about a situation where things are way too complicated and way too tight?
Wow. Good evening, everyone. Before I start, thank you so much for having me here. It's a lovely environment. It's a delight to be here. And it's a delight to follow this conversation with the legend that Mr. Damodaran is. It was a pleasure listening to you, sir, and I will always remember the line, greed and grief. It is also a little cruel of you to ask someone who's a CEO of a regulated entity to speak on regulations in the presence of a former regulator and right after a former regulator.
We need two sides.
I am extremely nervous about what I am going to say.
We need two sides, for sure.
So we need two. And I will attempt to be as candid and balanced as possible. So I think the answer is that there is a middle path. Now, as the Damodaran sir said, nobody likes regulation, but the reality is that in a country like India, where financialization is just started to happen, where levels of financial literacy are young, you can't run without a constitution in place. Just like a country needs a constitution, otherwise it moves into anarchy. You do need a certain amount of regulation in financial products, otherwise you do have anarchy. I represent an industry that has become 60 lakh crores, that is the mutual fund industry. Today everybody talks about, every time I come on a TV channel, they're like, Madam, 21,000 crore ki SIP book ho gayi, it's 25,000 crores. All of this has happened because of a regulatory framework, because people today know that when they put money into a mutual fund, it is transparent. They can take it out with 2 business days notice. Not a lot of people can promise that. So regulation has also played a part in getting us this far. Now, your specific question was about all the noise around F&O. And I must say that when I saw the economic survey, the language I saw was very, very strong. Now, there is nothing wrong, as Damodaran sir said, with young people entering the equity market. But since we are talking in an NBFC background, there is a different kind of risk if you told me a bunch of young kids were taking a loan to fund their education at IIM or Harvard or whatever it is and create a productive asset, versus a bunch of young kids taking a loan to go spend their day in the slot machine. And I think that is the difference that is happening here. If you see the data that has come out, 1 crore people have lost 50,000 crores speculating. Probably something needs to be done. I don't think anybody is saying that derivatives in themselves are bad financial instruments. People are pointing out a certain segment of the market, which is options, and the fact that there is an expiry every day, where if something were to go wrong, people can lose a lot of money. I talk to a lot of young people. I don't think 40 is young, but I talk to a lot of young people because of my social media presence. I have heard countless stories of 25-year-old kids telling me, I'm going to leave my job and just do F&O trading. Okay. That to me is very, very scary, because you're spending the most productive time of your life doing something where you could lose more money than you have. So is intervention important? I think it's absolutely important.
Okay. Now let's take this conversation a little forward. I don't want to keep harping on regulation for long, but the evolution of Indian, the public. I think it was Uday Kota who said that we're moving away from being a country of savers into becoming a country of investors, right? You're talking about younger people going to the market. Forget about the F&O space, but even broader equity space. how are you seeing this? What do you think this will lead to?
So I think young India is changing for sure. Whether it's the way they consume, whether it's the way they think, whether it's the way they invest. And, sometimes we can be questioning of young people, but we have to realize that they are growing up in a very different India. So my father was a civil servant. He was born in the 1950s, and he grew up in what I would say was an India of scarcity, absolute scarcity. I consider myself a little bit old now, but I grew up in the 80s and 90s, but I grew up in what you would call an India of transition, where you still saw the family waiting 10 years for a mobile phone connection or a gas or a scooter. I have a 2-year-old son who's somewhere on the beach. He is growing up in an India of abundance where he can order an air conditioner on Blinkit and get it in 10 minutes. So this is the context in which young India is thinking, consuming, saving, operating. Now to the question about deposits. And by the way, before I get to deposits, this reflects in your job choices too. So my father's India, perhaps joining the public sector was the most popular thing to do. I think in the India I grew up in, we thought, let's get a job, let's, help out the family, we'll work at a nice MNC, salary value, all of that stuff. You talk to a young person today, all they want to do is do a startup. So risk appetite has gone up across the board. That reflects in how you invest. So again, from an India of deposits and savings certificate, you are seeing a young person want to take risk in the capital market. And to your point, if that risk is going into good quality companies in India, forming capital in India, making domestic markets more independent, it's the best kind of risk that someone can take. Of course, we want that person to invest for 5 years. Of course, I'm paid to sell mutual funds. Of course, we want to get that person to invest via mutual funds, all of that. But the point is, risk appetite has gone up, and risk appetite is helping build domestic capital markets. It's the biggest win-win that can happen.
As somebody who watches this market, banks are crying because they're losing out money every day, right? Your deposit growth is just not picking up. And even the RBI governor in a latest statement said that, too much money is going out of the banking system into other avenues which are making people more money. Should we start looking at fixed deposits as a sort of a relic?
So I think this banks are eating mutual funds narrative has been around for the last year or so, and it worries me a little bit, because if you go back to what RBI governor said, my understanding is he said credit growth should not run ahead of deposit growth. He actually didn't say banks are eating mutual funds, and as Damodran sir said, you guys are media, so you like to add mirch masala and spices to
not
everything.
Us, I can tell you that, not us.
But so I think that was his statement. Credit growth should not run ahead of deposit growth. That's all good. I think people moving from deposits into regulated asset classes, into financialization is a very natural course of India's evolution. It happened in the US. So if you track the US economy of the late 80s and India's GDP today, is similar to US of that era. A major movement of financialization happened in the 90s. If you track China 15, 20 years ago, the same trajectory happened. The same trajectory is happening in India. So I don't know why it surprises people. I should give a little clarification to this comment. A lot of the growth that you've seen in the mutual fund industry over the last 2 years has come from something called mark-to-market, which is essentially equity market growth. It's not that money has been pulled out of the banking system and gone into mutual fund AUMs. It's come from equity market growth. And finally, all this money remains in the banking system. It doesn't go away from the banking system. So yes, people are exercising the choice to take more risk, to invest in equities. But even today, by the way, at the end of all of this, mutual fund AUM to GDP is 16%. Okay. You know what the global average is? 80%.
Okay. So that's like too far away from where we are at this point in time, at least. Okay. How do you reach that 80%? Or do you want to?
You should reach that 80%. So I think while we celebrate that we are 24% of bank deposits, that we've come so far, that we are 60 lakh crores, all of these lovely things. We have only hit 5 crore unique consumers. 5 crore is a very small number, and let me just contextualize this small number. And I read these statistics to myself to feel bad most of the time and tell myself how much work we have to do. There's a company called Dream11. You must have heard of it. Dream11 has 20 crore users. There are companies called Amazon and Netflix. They have about 50 crore users. So the Indian streaming population is 50 crore users. That means 50 crore Indians are paying 100 rupees a month to Amazon or Netflix. I'm sure these 50 crore Indians can start an SIP. So we have a long way to go. And the real answer is continuous outreach, continuous financial literacy. Now, every time I ask this question about 20 crore Dream11 and 50 crore Amazon, someone tells me, Radhika, an SIP is not as glamorous as speculating on Dream11 or chilling on Amazon Prime. Equity markets are not that exciting. But the constant job is one, financial education, and the second is creating more distribution. Because finally, financial products in India do get sold, whether it's fintech distribution or physical distribution. It's investing in distribution.
Benchmarks trade higher, tracking Asian peers. Sensex trades at 79,300 levels, while Nifty crosses 24,200. All sectors advance higher in trade, led by gains in metals and oil and gas. The Bank of Japan says it will not raise rates when markets are unstable. Deputy Governor also says that the central bank needs to keep easing firmly for the time being. And relief for property owners on long-term capital gains as Finance Minister amends the budget proposal. Taxpayers to now avail lower rate of 12.5% without indexation or a higher rate of 20% with indexation. India's gold contender Vinesh Phogat disqualified for being overweight by a few grams. Phogat defeated Cuba's Guzman in the semi-final yesterday. welcome. You're watching Market IQ. In a big blow to India's chances of winning a gold medal, Vinesh Phogat was disqualified from the women's 50 kg wrestling final at the Paris Olympics. The 29-year-old was found ineligible to compete on the second day, as she was found the first ever Indian woman to reach the Olympic wrestling final. The Indian Olympic Association, in an official statement, confirmed the disqualification. It also requested stakeholders to ensure Vinesh Phogat's privacy. On each day of the competition, there is a medical exam. A quick look at how the markets have fared. So it's not a bad day at all. We have continued to build on the recovery that we saw yesterday. The Nifty 50 as well as the Sensex off the day's highs, but very much in the green. The Nifty 50 is up by almost about 1% in today's day of trade, while the Sensex is up by 0.75%. Let's also take a quick look at the top gainers in the Nifty 50 and what's pulling up the index. HDFC Bank in the lead, contributing about 37 points to 38 points alone. ONGC, L&T, Coal India among the other top leaders. What's not performing particularly well is Bharti Airtel, Indusand, Aisha, Asian Paints. A little bit of a drag, but not too much, with most stocks very much in the green. Just about 7 or odd stocks that are currently in the red on the Nifty 50. Let's also take a quick look at the sectoral indices. There again, it's a sea of green. With PSC in the lead, it's up by over 3%. Metal seeing signs of recovery, up by 2.5% almost. Energy, commodities, media, pharma, MNC, infra, all performing well and above by at least about 1.5%. Let's also take a look at the broader markets, and those continue to outperform the benchmarks. The Nifty Mid Cap 150 is up by 1.7 odd percent, as is the Nifty Small Cap 250. So it is turning out to be a good day of trade. We do have an action-packed week. We already have seen, quite a few global developments spilling over. What we're looking forward to now for the remainder of the week is, of course, the MPC's decision that is due tomorrow. For her quick insights on that, I'm joined by Upasana Bharadwaj, Chief Economist at Kotak Mahindra Bank. Upasana, hi. Thank you so much for taking time out.
Hi.
So, before we dive into what your expectations from the MPC are, earlier today we did hear news that came in regarding the weightage of food in India's inflation basket, and how we have been talking about this for a while. We do expect the weightage of food to come down when the index is reviewed and when the panel constituted by the government does come up with its findings. But Bloomberg estimates that drop to be anywhere up to about 8 percentage points. I did want to ask you for a quick view on that.
Yeah, Pallavi, I think clearly this was something which was known to us. We knew that the consumer surveys were already done, and there was a slight tilt towards a lower weightage which would be coming in the CPI basket on the food side. While we'll have to wait, but I guess 5% plus is something. 5 to 6% is something which is likely to be the downward revision to the food index weightage. That will obviously have some bearing. And I think if you see the markets, bond markets, there is some kind of a euphoria setting in because of that. Because, food inflation tends to be extremely volatile, and that tends to, cause a lot of havoc, and, decision making comes under pressure because of that. So, yes, we will have to wait and watch, but we do expect somewhere around 5 to 6% of a downward revision to the food weightage.
All right, Upasana, before we can move on, I do want to ask you one more question. We do expect the weightage of several constituents of food to come down. What is the broader implication? We can expect more stability on the headline inflation print. So that way, is the move a positive? How are you viewing it? And also, what are the constituents which might then see a little bit of an uptick in their weightage?
Talking about stability, yes, because clearly, given the weather disruptions that we've been seeing over the last few years, the supply side issues that has been plaguing, the food market globally, not just in India, and the dependency of India on monsoons, all of that, does suggest that there should be a little more stability. But the reduction, honestly, is 5 to 6% only. And when certain segments move, they move really, the volatility is very high. So we may still continue to see a fair amount of volatility. We are still going to be talking about near 40% weightage, so that's quite a bit still. So I'm not fully convinced of a very stable environment, but yes, clearly, probably some amount of stability would be there. Talking about the change or the increase in certain weightages, if you look at the consumer basket of the consumers or the surveys that were conducted, there is a shift towards more service-oriented categories. And I think recreation and all should be increasing in that sense. Education should be coming down. I think clothing will be coming down slightly more. So we will be seeing a little bit of revamping of the weights in the core inflation side as well. But I think recreation and all will be also witnessing. Housing within rural might come into the picture, while we might see some kind of a rejigging there as well. So I think some of this will be going through a fair amount of personal care, for example, will be also going through an upward revision. So yes, these are the categories I think will be seeing an upward revision.
All right. So, Upasana, moving on to the expectations from the MPC tomorrow. So from the last MPC to this one, we have seen the economy broadly remain resilient, but we have seen a modest uptick in the headline inflation print because of vegetables, seeing higher prices. What is the expectation tomorrow, while we are expecting a status quo on the benchmark lending rate? Is there any chance at all of a change in stance, or is a continuation in stance also a given?
If you look at the bond markets, probably there is a partial expectations of a stance change which is building up. But honestly, I don't think RBI will act in a jiffy right now. They will be patient enough to hold on to their stance, and rates, of course, is a given. But I don't see scope for a change in the stance. While, yes, I agree that the liquidity situation has become extremely benign now, comfortable. And ideally, RBI has allowed the overnight rates to prevail between the lower end of the LAF corridor, which is between the SDF and the repo rate. And that in itself probably suggests that financial conditions have eased significantly, and we are moving towards a stance change. But I think at this point in time, we need to keep into account how the volatility in the global markets have increased significantly. And, domestically, again, like you mentioned, we did see an uptick last month. 5.08% was the inflation, largely led by food inflation, of course. And then again, even July, while yes, I agree that there's a very strong favorable base effect. So the numbers are going to look very rosy. We are somewhere around 3.2, 3.3% for the upcoming inflation reading. But that's more because last year, same time, we saw about 7% plus numbers in inflation. So the favorable base effect is helping. Otherwise, sequentially, the food inflation still is a problem. And going ahead, RBI will be watching out for the sustainability of overall inflation trending eventually towards 4%. So they have voiced this out quite categorically. And hence, I see that they would rather wait. To add to that, like I said, because global conditions have turned very volatile and rupee is under pressure at this point in time. So reducing or changing the stance is just probably going to add more pressure on rupee at this juncture. So maybe they should just pause and wait for the next 2 months. Some kind of sanity will be back in the markets. And then maybe that's the right time for them to act. So we are looking at a change in stance in October policy.
Okay, got it. I do also want to ask you about the monsoon trajectory. That was one of the key factors that we were going to be watching out for, especially given the concerns on food inflation and vegetables specifically, and given the fact that we did see heat waves, they did have a toll on vegetable prices. From the last policy, very recently, the IMD has once again reaffirmed expectations of an above normal southwest monsoon season for the remainder of the season, and Kharif sowing trends so far also appear to be fairly healthy. So all in all, at this point, can we say that there is less of a concern emanating from that factor?
Absolutely. If we see the La Nina phenomena has started building up, so we do have less of a concern. There is good temporal and spatial distribution of rains that is happening. Reservoir levels are building up. Kharif sowing is now moving really well. So, I mean, the data is showing and providing us comfort on that front as well. So we do expect that, in fact, if you just look at the data on high frequency, the vegetable prices I would say from the third week of July onwards, had already started, normalizing. Of course, they're still high, but they have started normalizing quite a bit. And that should continue to pan out over the next 2 months. By September, we do see seasonality stepping in and more new production, new supply starts coming into the picture and things normalize. So yes, it's less of a concern for sure. But I think, the RBI will be waiting and then moving, once they are in October, they have seen the full monsoon period, had some more clarity that there's no excessive rains destroying output. All of that needs to be also kept in mind. And hence, I think they would rather not act immediately.
Sure. Okay. And the latest high-frequency data for vegetable prices, does that indicate some easing from the price pressures we'd seen previously?
Yes. The last 10 days or so, we are seeing a fair amount of moderation in the vegetable prices. They have been increasing, but very low. The pace of increase is much lower than what we were seeing until, the first half of July or so.
Okay. So at this point, is the larger concern going forward then the geopolitical conflicts or chances of escalations there? Also the fact that we've seen weaker data from the US, and while there were modest chances of a slowdown in the US, the latest data does indicate a slightly weaker economy than might have been earlier anticipated. So is that the primary sort of factor to be watching out for, the global economy, US, as well as geopolitical conflicts?
So, I think the way RBI functions is clearly going ahead, they will be looking at domestic inflation trajectory on a primary basis. If there is comfort which they are drawing on that yes, now this disinflationary trend that they are looking at, running into FY26 as well, we are not seeing any upside risk, or even H2 as a matter of fact, then they will look at all other factors. And like I said, yes, the global conditions have turned benign. We are getting more and more data validating that the rate cutting cycle by the US Federal Reserve is in the making. We begin with September. Now, whether it is a 25 basis or a 50 basis will be determined by the next 1.5 months of availability of data in the US and what that really tells us. So conditions are fairly benign on the global side, but at the same time, as you mentioned, geopolitical risks do remain. The good thing is, I would say at the moment, at least crude oil prices have been very well behaved. They haven't responded too much to the geopolitical risks till now. But clearly, that also will be something which will be watched out for. But overall, I would say the risks are manageable, not too much of a worry. But domestic inflation is something wherein they would be focusing on. And as we go into the next few months, they will have much more assurity. And hence, they will be in a position to change their stance and then subsequently do rate cuts.
All right. Thank you so much for taking time out for us, Upasana. And with that, it's time to slip into a short break, but do stay tuned. We have more coming up on the other side for you.
welcome. You're watching Earnings Edge. This is Mahima Vachhrajani. Well, Indigo Paints came out with its Q1 FY25 earnings, and the numbers, in terms of the numbers, revenue was up around 8%, EBITDA down around 1.4%. Margins have taken a hit from 16.8 to 15.4%, and net profit was overall down by 16%. Now, paint companies in Q1 overall have altogether have faced pressure in terms of margins as well as revenue on account of election days, as well as the kind of heat wave that was going on. But to understand how the quarter has gone by for Indigo Paints and how FY25 is shaping up, we are joined by Mr. Hemant Jalan, Chairman and MD at Indigo Paints, who joins us now. Welcome to the show, Mr. Jalan. My first question to you is that revenue has been under pressure and margins have also been under pressure for the quarter. How was the quarter as per you, and what does FY25 overall look like to you?
Well, demand in the paint sector has been somewhat muted for at least the last 2 quarters. Both in Q4 of the last fiscal and in the Q1 of this fiscal, the demand remains muted. And on top of that, the industry took what I thought was a somewhat needless price cut in November and January, which has also put some pressure on the margins of all the existing players. Thankfully, some of that is being corrected now with some price hikes having happened in July and some more happening in the next few days. So margins should see some bounce back. And as far as demand is concerned, we have had a very good July, but to predict as to whether the whole quarter Q2 is going to pan out extremely well or not is a little difficult to say at this stage. We have to wait and watch and wait for the consumer sentiments to change and the demand to really bounce back.
Right. Mr. Jalan, how much of a price hike have you taken altogether in Q1? And since you mentioned that you're also planning a price hike in the coming weeks, how much of a price hike are you expecting going forward?
No, there was no price hike in Q1 per se.
Okay.
There has been some price hike towards the end of July and a little more happening next week in August. So the combined effect of these price hike across the portfolio would be roughly about 2%.
Okay, and then when you say that because of these price hikes, your margins might bounce back a little, how much of a bounce back are you expecting in the margins?
About 2%, but there is a seasonal character to margins in paint industry. So normally the product mix deteriorates in Q2 because of the monsoon. External painting takes a hit, and therefore a lot of the profitable products do not have a high weightage in terms of sale quantity in Q2. So normally in Q2, in general, gross margins and EBITDA margins do decline, and we expect to see that. But on a Y-on-Y basis, we expect to see good growth happening both at the EBITDA level and at the PAT level in Q2.
Right. Okay. And Mr. Jalan, I want to understand that your advertising and promotion costs have been going down since some years now. So, I want to overall understand that what is happening here, because from what I believe that there are larger players that are coming in the paint industry, and there might be a possibility that they might take away some of your market share. So I want to understand the overall picture here.
So the advertising and promotion spends on an absolute amount have not been going down at all.
Okay.
They have in fact increased at a very marginal pace over the last few years. As a percentage of the top line, they go down, because the top line has been increasing at a faster pace than any increase in A&P spends. Now, we think that our A&P spends are at a comfortable level and much higher as a percentage of top line compared to the rest of the industry. So we have no plans of making any drastic increases in A&P spends. And what new competition chooses to do on advertising is their business. I don't think that we will take our decisions based on whatever advertising they intend to do.
Okay, and Mr. Jalan, I'm sure you've got this question a lot of times, but do you expect to lose some market share as to the new players that are entering?
No, I don't. I don't expect that to happen at all.
Okay.
I think any new incumbent would necessarily start with a reasonably low market share, and whatever market share they may gain, I don't think that for the next few years, the competition that we can expect from a new incumbent would be at all comparable with the competition that we have always faced from the likes of Asian Paints, Berger Paints, Kansai and Akzo. So they have been our toughest competitors for the last 25 years, and they're likely to remain so in the foreseeable future.
Okay, and Mr. Charan, overall in the consumer consumption space, we're seeing that the rural demand is upticking. Have you observed the same in paints as well?
Well, frankly, the slowdown that was there for the last 2 quarters, we didn't notice any appreciable difference between urban centers and rural centers. In general, consumer spend on discretionaries was going through a slight downturn, and that is why all paint companies have reported either negative or very marginally positive top-line growth. As I said, we have seen an excellent bounce back in the month of July, but it's too early to say whether that is sustainable in the months of August and September and going forward in future quarters, or whether this is just a temporary, unexpected positive blip. So we'll have to wait and watch before we can make any concrete comments as far as a bounce back in demand is concerned.
Okay, and Mr. Charan, are you seeing any kind of change in terms of mix of your products? Because from what I understand is that emulsions volumes have been flattish in this quarter, whereas the volumes for cement paints have gone up roughly around 8%. So is there any change in the mix that you're observing? And also a lot of paint companies are also seeing an uptick in their premium portfolio. Is it the same case for you as well?
I think we are seeing, the uptake or downtake, whatever you may call it, is pretty much even across all price points. So I don't think that, for us, premium products have grown faster. And that is because our base on the premium segment is somewhat lower than some of our larger competitors. When you say cement paint, it's really not cement paint, it is putty, which drives that segment of our paint category. And we have seen good growth happening in both the putty segment as well as in the primer distemper segment. Of course, these segments themselves have a seasonal pattern to it. Come Q2, you'll find the weightage on distempers and enamels to be much higher. So we have seen a huge jump in enamel sales in the month of July, and also in distempers and the primer segment. So sometimes it is difficult to make a judgment by looking at 1 quarter numbers of volume growth or value growth for any particular segment. I think you have to allow a slightly larger time span to elapse before you can make a concrete comment as to whether any particular segment is underperforming or overperforming.
Got it. And Mr. Charan, I want to understand that I believe that you would be making investments in terms of improving your supply chain overall. And you've also said that, you're looking to expand in current strategic locations that you're already present at. So I want to understand that what is this kind of strategy that you're adopting there, and what is the kind of impact it will have on your overall costs and margins?
Well, we are pretty much present pan-India. And there is no part of India that has a higher focus for us or a lesser focus for us. Every part of India is important, and sometimes certain regions perform better than others in one year, and you find the reverse happening in some other year when some other region starts outperforming. So I don't think that we give any special focus on any particular geography per se. And I don't know what investment in supply chain that you're talking about. I'm not aware of having made any such statement. We are ramping up manufacturing capacity. We commissioned a very large plant in Tamil Nadu in September of last year. And we are building another similar state-of-the-art water-based plant and a solvent-based plant in Jodhpur, where we have an old installation for manufacturing. So manufacturing capacity will be ramped up sometime in the next fiscal when those plants come on stream. But I don't think that necessarily has any meaningful impact on cost or logistics.
Okay, well, Mr. Jalan, thank you so much for giving us those insights on Indigo Paints and taking our time and speaking with us at NDTV Profit. But with that, it's time to slip into a short break. But stay tuned to NDTV Profit for more news and updates.
welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is the show where we talk all about mutual funds and how they can be a great investment for you. Today, we're focusing on ETFs or exchange traded funds. We're asking, are ETFs a good option for you? We break down their pros and cons, and especially right now in a period of volatility. We explore how they stack up against mutual funds and help you decide which investment vehicle suits your financial goals best. To speak on this today, I'm joined by Prableen Bajpai, founder of FinFix Research and Analytics, and Nikhil Kothari, director of Etika Wealth. Welcome to both of you, and great to speak to you on the show. Prableen, let me begin with, and we'll just start with the basics. What exactly is an ETF and why are they popular?
Good afternoon, Tamanna. Thanks for the invite for the show today. Exchange-traded funds, as the name suggests, so they can be traded on the exchange. It is a fund, so it constitutes a number of stocks when it comes to an equity-oriented ETF. So there is an underlying composition, and it tracks an index or a commodity. So broadly, ETFs are a basket of securities that are tradable like a stock, but the composition is more like a mutual fund because it's diversified. In India, the first ETF was launched in the year 2002, and we saw that for more than a decade there wasn't much activity. ETFs were recognized as an asset class only in 2013, and the progress in this segment where ETFs started becoming popular began when EPFO started to allocate money towards ETFs, which was in 2015. And now approximately 15% of the funds are allocated. Today, passives, ETF funds is a kind of a passive fund. So passives overall in India are now almost 17% of the overall AUM of the industry. And ETFs alone are approximately 70% of that. So Tamanna, overall, ETFs are a great strategy for investors who are looking for a transparent, low-cost medium to invest in the markets, but it's a passive way of investing. So broadly, you're going to get the returns of the underlying index or the commodity or the security which is being tracked. So in case it's an gold ETF, so you're tracking the price of gold. If it's an ETF which is tracking Nifty 50, you would replicate the performance. So you're tracking the underlying security or the index, and of course it's tradable. Those are the main two features of an ETF.
Okay, so now let's put that in context. Nikhil Kothari, great to have you on the show. Why an ETF versus other kinds of passive funds, or even versus other categories of mutual funds?
Okay, so as was rightly mentioned, that's a passive oriented fund. So you don't take a fund manager risk. You know that what is the stocks are in this portfolio, and the fund manager is just going to buy those stocks accordingly. And depending on the stock movement, the NAV of the price of the ETF will move. Now, comparing to index funds, so how ETFs are superior? There are two reasons. One is the cost is lower for ETF as compared to index fund, because many of the index fund just go and invest in the ETF. So there's a two line of expenses in case of index fund, whereas in ETF there's only one line of expenses. Second reason why people prefer ETF, because you can buy ETF during the day in terms of market thing. So say for example, 2 o'clock the markets are down and you want to invest in Nifty, or right? So if you buy through a mutual fund, you will get the day ends NAV. So say for example, market was down at 2 o'clock, but market recovered 3:30 again. So when you invest in mutual fund, you get a day's end NAV. Whereas in ETF, you can buy during the day. So if you want to buy and sell, or if you markets are dipped and you want to buy on that particular time frame, then you can use ETF as a far better alternative as compared to the index funds or mutual funds. So if someone wants to have a passive, he has a demat account. That's most important for ETF, because you need to have a demat account to buy ETFs, and you want to and one wants to buy for long term, can invest in ETF as a option. And nowadays, you have a wide variety of ETFs. You have large cap, you have Nifty, you have Sensex ETF. Apart from that, nowadays you have lot of smart beta ETFs, which is basically low volatility momentum ETF, and then you have sector-based ETF also. So from an investor perspective, there are lots of variety of ETFs available now.
Prablin, let's come to the basic difference between an ETF and an index fund, because if the idea is to not take risk and just bet on the underlying asset, then both could have a bit of an overlap and have the same purpose, isn't it?
Absolutely. So, Tamanna, the broader difference is that, they both are representing the passive strategies, just the structure is different. So you cannot trade an index fund. You are only buying it at the NAV, end of the day NAV. But like Nikhil mentioned, you can, we trade an ETF. So you have the option of not only buying it at the end of the day price, the NAV, but you can trade it during the day. And if yesterday we saw the markets were going up, and then by the end of the day, there was a correction. So ETFs give you that opportunity to do that buy and sell during the trading hours. That's the main difference between the two. The second difference here, I think, which is important, is that you would require a demat. So the structure is different. So an ETF has to be in the demat. So if in case investors are already trading, they have their brokerage accounts, then demat facilities available to them, and they can choose the ETF strategy. If somebody is looking to do an SIP and invest through this medium of doing their monthly allocations, then I think index funds would be preferable for them. So a lot of large investors who are wanting to take the high net worth individuals and more savvy investors who are looking to take advantage of the dips during the day, I think they prefer the ETFs. Otherwise, even for retail investors who do have the facility of demat, they can definitely choose the ETF option, but they would require a FOF or a fund of fund to do an SIP, because SIP is one of the most preferred options of investment these days. Other than that, one big difference is that the ETF, the holding period, Tamanna, for taxation now, when you get taxed at that 12.5% for whether it is a gold ETF or any other ETF, the holding period becomes 1 year. So the taxation remains same for an index fund as well as an ETF. Just the holding period difference is for everything else, it's 2 years. For an ETF, even if it's not equity, it becomes 1 year.
Yeah, so that becomes an advantage if you invest in an ETF, isn't it? Yes, Nikhil, you wanted to come in.
So I think that's one basic advantage is taxation, what Praveen rightly said. But one thing which I want to very, very highlight to investor is that ETFs are not so simple that just you can go and buy any ETFs. One of the major problem in ETFs is the tracking error and the volume, right? So many times what we realize that the price which is quoted in the market, there's a huge difference between bid and ask price. Okay, so you may say that okay, I'm going and buying an ETF, but at times even the markets are up because of low volume in the ETF market, the price may be far different than what the underlying index price should be, right? And because of that, you may, if you place a market order, like if you want to buy during the market, and you may end up buying at far higher price or far lower price, or you may end up by selling at far lower price. So one has to be very, very careful when he's buying an ETF in terms of the bid and ask spread between the buyer and the seller. And based on when he's placing the order, he has to be very, very careful. Whereas in case of index fund, it's very simple because they will buy the index. They will buy first high liquidity index, and here you'll always get the return in line with the index performance. Whereas in ETF, your buying and selling price makes a huge difference in terms of your return.
Okay, so those are some basic differences between an ETF and an index fund. The recent tax changes also makes ETF attractive, so that's an important portion. Now let's come to whether ETFs are a good option right now and for whom. And probably let me start with that. The context also because we're seeing a lot of volatility right now. So for which category of investors does ETFs make sense?
Tamanna, I'll club ETFs and like passives together because I think the main advantage of passive investing is that it's very simple to understand. So, for example, on Monday, the 5th of August, the market fell. So, when you're buying at low markets. When you're buying an active fund, it may be possible that the composition of the portfolio is very different from the, index that it's going to track, the broader index. For example, an active fund will have a very different composition from the Nifty 100 or Nifty 50 for that matter. So I think for investors who are looking at very long-term investing, want a very simple strategy, do not want the fund manager's bias or, are wanting to be away from that basic problem of whether I am investing in the best performing, let's say, large cap fund, or am I investing in the best performing mid cap fund? They should choose the ETF or the index fund option. I think because it's a very simple, transparent, low cost strategy for the long term. So for any investor, be it today's markets or otherwise, Tamanna, I feel that the core of your portfolio should now be built with passives. As India becomes a developed economy, I think the rise of passives will only grow stronger. So I think the core should be passives, and then, you complement it with other active funds which are available to us. Currently, I think the large and the mid cap space, definitely a passive strategy can be picked via an ETF or an index fund.
Nikhil, that's interesting. In context of volatility that we've seen recently, do ETFs become more attractive or a good choice? If so, then for whom?
So as Praveen rightly said, that you need to have both the strategy in the portfolio, passive and active. Okay, so for passive strategy, if you have a demat account, then you can use some part of your portfolio, like a large cap space. You can have 60-70% of your portfolio through ETF or an index fund, and 30% of your portfolio can be through active funds. Whereas in mid and small cap, right, where the alpha generation can be, where there's a huge variety of stocks which they can buy, and there's a scope of alpha generation. There, the 30% of your portfolio can be in ETFs or an index fund, and 70% of your portfolio can be in a active managed fund. So from an investor perspective, you have to balance both the things. Apart from that, there are few specific sector ETF. So if those ETFs are available and the investor wants to take a call on this particular one sector, like say for example, there's a private bank ETFs, there's a PSU ETF, so there are a lot of other sector-based ETF. If an investor who is very smart and who has experience in the market and wants to take a call in a particular sector, then he can buy those ETFs and add as a tactical call to his overall portfolio. But as Praveen already said, some part of your portfolio can be passive, which is through ETFs, and remaining can be active managed funds.
Right, so that's quite a bit about ETFs. I hope that's been helpful on whether you should invest in an ETF or not. But stay tuned, because a lot more on the other side. We're taking a very short break, but when we come back, we take all of your queries. So there's a lot to look forward to. We'll be right back in just a bit. Welcome back. You're watching the Mutual Fund Show. Now it's that time of the show when we take your questions. Swastik writes in, aged 48, and says, I've invested around 2 lakh rupees in mutual funds during Corona period, and now the fund value is more than double. Should I exit or stay invested? Well, first of all, congratulations, Swastik, for continuing your investments during what was a very uncertain and tough time. It's obviously worked out well for you. Prableen and Nikhil are joining us on the show today. Prableen Bajpai and Nikhil Kotari are continuing with us and taking your answers. Nikhil, let me start with you first. He's asking, should I now exit or stay invested?
Okay. First of all, Swastik, it was a great call, which Tamanna already said that it's very difficult to invest when the markets are down. And when you invest that point of time, right, and if you have patience to stay invested for 4 or 5 years, we have seen the result that how equity market gives you a very promising return over a long period of time. Okay. Now coming to the question that should I redeem? Now you should only redeem if you need the money. If you do not need the money, next 5-7 years, India looks a very good story, or equity markets over a long period of time can give you better return on on a post-tax basis as compared to traditional investment plan, but you need to have a very long-term horizon of another 5-7 years. So if you have a long-term horizon and if you do not need the money, I will rather recommend that you continue to stay invested. But if you need the money next 6 months, 1 year, 1.5 year, then I recommend that you can take out this money and move to a liquid or a arbitrage fund and then redeem whenever you actually need the money. So your your withdrawal should not depend on return you've already made. Your withdrawal also should depend on when you need the money, right? Depending on when you need the money, you should be able to withdraw the investments.
Okay, so if you don't really need the money right now, maybe you should not exit. Prableen, do you second that?
Absolutely, Tamanna. I feel that an exit strategy is more important than, when to invest, because a lot of investors are unsure of whether they should redeem when they are in having profits. So I think if the goal is close by and it's 6 months or a year away, definitely book your profits. And if you do have the long-term horizon, then continue. But because we don't know the name of the fund, let's say it's a thematic fund or something where you have made money and which is a risky bet and probably doesn't suit your risk appetite, maybe, the call would be different. But I think, yes, like Nikhil mentioned, it's broadly based on whether you need the funds or not.
All right, Fiza writes in, age 28, says, I'm invested in the following funds on a lump sum worth 1.68 lakh rupees, and my goal is to reach 2 lakh rupees in a short-term basis. Am I reading that right? Yeah, 2 lakh rupees on a short-term basis. Is it a viable goal? And look at her funds: SBI PSU Direct Growth Plan, Aditya Birla Sun Life PSU Equity Fund, Invesco India PSU Equity Fund Direct Growth Plan as well. So pretty well laid out, but a lot of focus on PSU, at least 2 PSU funds over there. She has not defined what is the short-term basis, Prableen. So, assuming about 6 months to a year, do you think that this is an achievable goal?
Firstly, Tamanna, that, I think somewhere Fiza has fallen for the recency trap, because this category, the whole category of PSU, has done exceptionally well, and all the 3 funds are broadly covering that. So you'll have NTPC, Coal India, REC, HAL, names like these, in all these 3 portfolios. So the money is really concentrated in this sector overall. So having the short-term view in the equity markets, it's not a very wise idea. If the markets do well, of course, she can reach a target of 2 lakhs. That shouldn't be a problem. But if we see, any sort of a sharp correction, then of course she's taken much away from the goal that she's set for herself. So ideally, my request to Fiza would be to look at investing in equity only for the long term. And if she understands the risk and she's okay to take the bet to stay invested for a short time period in these funds, which are broadly thematic, then that's fine if that suits her risk appetite. But it's not the way you should be investing. And also now, if it's going to be short term, then her taxation will be high at 20%. That also is something that she should consider.
Okay, let's go across to Poonam Patel's question. She's aged 50 and says, I'm an NRI who's looking to invest 20 crore rupees. Can you recommend any ICICI Prudential specific funds to invest in? Thus far, we have invested in the ICICI Prudential Business Cycle, India Opportunities and Energy Opportunities Fund. That's a recent NFO, and a FlexiCap multi-asset fund. All right. So, Ms. Patel, thank you so much for writing in for us. Nikhil, let me take that question to you. What I found interesting is that the viewer is asking for recommendations from one specific fund house, possibly because it's been easier so far or they've had a good experience. But do you think there is any reason to stick to only one particular fund house?
So first of all, when you're investing your money, you should be investing in 4 to 5 overall schemes, and that money has to be divided into different categories of fund and different fund houses. The reason being is that one fund houses may have a slightly biased towards one particular strategy, and then all your funds will in that fund houses will follow similar strategy to some extent, not completely. So in that case, if the sector does very good, or if the strategy does very good, all the funds will do good, and vice versa. So I recommend that first of all she should divide into different categories of fund and then to different fund houses. Now coming to only specifically ICICI fund house, She already have 4 funds in the portfolio. It doesn't make any sense to add any more fund in from the same fund houses to the portfolio. If she wants to only invest in ICICI, then I'll rather recommend that invest in the additional money in the existing fund only, which is Business Cycle Fund, India Opportunity Fund, or a FlexiCare Fund. If she wants to add another fund on the overall portfolio, then she can look at from some other fund houses.
Okay. What about to you, Prableen? What would be your advice?
I'll concur to what Nikhil said, that, number one, that your investments must not be concentrated in the same AMC, Tamanna, because the strategy, the fund investment style will broadly be the same. But if in case she is keen to invest in ICICI, then I would say that now she needs to add the passive strategies, because even if it's ICICI, because it will be the passive strategies, the fund house, the relevance of the fund house, it reduces. AMC wise, ICICI has a decent corpus that they are managing assets in the passive space. So I think she can look at the mid cap index, some passive strategy, the momentum strategy from the ICICI AMC. That will reduce the risk that is there in a portfolio, which is being brought in with the same investment style from the AMC.
Okay. Uttam writes in, aged 60, says, I'm investing in 2 types of funds, hybrid aggressive funds and a balance advantage fund. Investment value is 50,000 rupees a month, and my goal is a corpus of 50 lakh rupees in 5 years. First of all, does that math add up? Prableen, let me come to you on this.
Sorry, Tamanna, what is the amount that he's investing? 50,000.
50,000 rupees, and his goal is to get 50 lakh rupees in 5 years.
Okay. That definitely is a steep target for the hybrid category, and he is going to take, that'll probably require him 7 to 8 years to achieve his target, given that we really don't know where the markets would be heading in the coming years. But if we take realistic estimates of, let's say, 11 to 12% returns, he would require to extend his investment horizon by a little. Otherwise, the hybrid aggressive and the balanced advantage categories, I think, are very suited for the current market type, and they would reward him even if the markets, go up from here, and will reduce his downside risk as well if there is a correction. So overall, the strategy is great, but I think he'll have to extend his investment horizon by a little.
Okay. One quick question before we wrap up the show today. Siddharth, age 25, asked, should I shift from my small cap to contra funds in the current market landscape? Good question, Siddharth. I'll ask Nikhil to take that. Considering that there's a bit of volatility and small caps have been very, very popular, have given great returns, is it a good time to look at a contrarian bet?
Yeah, so in the current context, though I don't know his overall portfolio, but if I take a specific case, moving from small cap to contra, I think it's a good bet, because small caps are, from a valuation perspective, quite expensive as compared to other categories of funds. So from a risk reward perspective, I think contra funds seems to be suitable bet as compared to small cap funds in the current market.
Okay, so contra funds would be a better bet than small cap funds in the current market. Well, that's all the time we have on the show. Do write into us if you want our experts to answer your queries. The numbers are on your screen. But for now, thank you so much, Nikhil. Thank you so much, Prableen, for joining us and taking all of our questions. That's all the time we have on the Mutual Fund Show for today. But stay tuned. A lot more coming up on NDTV Profit.
Hello and welcome to NDTV Profit. You're watching Large Trades, the show where we talk about all kinds of bulk and block deals and market-moving stocks and sectors. I'm your host Mihika Barve, and with me is Agam Vakil. But before we go on and address the stocks that are buzzing in trade today, Agam, how are markets looking like right now?
Well, it's I would say it's quiet. We haven't seen too much of a change, but in general, of course, we're continuing to see positive traction as far as the Nifty is concerned, which still holds on to a gain of around 1%. And Bank Nifty, of course, is up by a little over 0.5%. It is the weekly options expiry. And I reckon that at this moment, the battle is more about 50,000 on the Bank Nifty more than anything else, because that's the level around which the Bank Nifty is continuing to move above and below. And that's potentially why we're keeping an eye on that one. There's also a lot of traction with respect to options around that mark. Now, specifically between something like a 49,900 put, where we've seen a lot of traction in terms of open interest, and of course on the higher end 50,000, 50,100 and thereabout. But I'm going to talk about the benchmark for now. Let's take a look at how the pull and push is. And when it comes to that, let's take a look at the constituents of the Nifty, because that'll give us a better idea about what's actually driving things up and what's actually dragging things down. HDFC, ONGC and Infosys among stocks which are actually looking at advances, and on the other hand, we're looking at IndusInd Bank, Bharti and Eicher Motors looking at very, very marginal weakness. All in all, it's certainly a day where we are actually seeing the Nifty outperform the Bank Nifty. So that's the other thing to keep in mind. When it comes to the broader markets, again, when it comes to key indices at the moment, we're seeing an outperformance. And yet again, the mid-cap index up nearly 2%, and the small-cap index is also up as much as 2%, a little over that. So broader markets continuing its resilience and continuing the relative outperformance with respect to the Nifty 50. Overall, it's certainly a good day of trade for the broader markets. And you have names like Dixon Technologies, BSC, Mazgon Dock, Zomato continuing to show strength in today's day of trade. In fact, you have that. There's your list. BSF, what a stellar set of earnings coming through, locked in an upper circuit of 20%. Let's also pull up Venky's. If we can actually take a look, because Venky's is also locked in an upper circuit of 20%. So a handful of names out there standing out. We have a recovery in a lot of these defense names as well, like something like a BEL, that's Bharat Electronics, doing well. Mazgon Dock is up around 3.5% as well. And then we have peers like, a little bit of recovery when it comes to Cochin Shipyard. Look at Trent. This one has also resumed, and it's up move. So that's the other one which is actually starting to show some amount of traction on the positive end. Now, this is as far as your markets are concerned. We take a look at all the stocks that we, in fact, do want to address in the show today. And right at the top of the list, we have Gland Pharma, which is on the radar of our colleague Varsha. So let's get her in. Varsha, good afternoon. What do you have for us?
Well, thanks Agam for that. So Gland Pharma is seeing some kind of pressure. This is on the back of weak earnings that company has posted. If you see let's talk about the numbers. If you see the US revenue that grew 79% year-on-year on the back of new launches, but their India business declined 19% as majority of their products come under drug price control. Now Senexi business, if you see Senexi, they've acquired recently. The revenue stood at around 388 crore, but they did EBITDA loss of 28 crores due to some one-offs. Some of the few con call highlights that we have: lower milestone income and ROW, that is rest of other world's sales, did hurt earnings. There was postponement of products by European customers which hit performance. EBITDA margin impact was led by higher employee costs, offset by lower other expenses, and PAT decline was led by higher depreciation and tax related expenses. Company has maintained guidance of mid-teens year-on-year growth in revenue for FY25, and they guided that EBITDA to be positive in fourth quarter of FY25 and in FY26 as well for Senexi business. Q2 of Sensex would be impacted due to European holiday season. Also, the company is collaborating with big CDMO players for biosimilar CDMO and in-licensing opportunities. But investors need to be cautious on Gland Pharma due to annual plant shutdowns and volatile growth and margins in the recent past owing to client and product-related issues. Brokerages are also, they've downgraded the rating. Jefferies have downgraded to hold, and Nomura has also downgraded to reduce because of the Sensex, which may take longer to turn around, and weakness in their base business.
Yes. Well, thank you, Varsha, for giving us those insights. Gland Pharma has seen a total traded volume of 15.36 lakh shares, but the buy quantity does outnumber the sell quantity. But, moving on to the next stock that we do have in focus today, and that's Cummins India. It's up 6.5% right now. It reached an intraday high of over 8%. And I believe this was on back of numbers. And we have Anushi joining us. Anushi, how did the numbers look like?
Hey Mihika, so if you had to look at Cummins numbers, now they did come out yesterday itself. Now, if you had to just go through the numbers, the revenue was about 4% up, beating the Bloomberg estimates, while EBITDA was about 38% up, and EBITDA margins moved upwards to 20.4% as compared to 15.4%. And again, net profit similar to the EBITDA growth, 31% of a growth here. But it is not the numbers that were pretty exciting in the morning. The stock opened with a % gain or something, but it was the positive management commentary that happened the post the noon session, which took the stock to an intraday high of about 8.34%, while the volumes currently are trading at about 3 times its 30-day average. So just to give a brief sense on how the management looked and some of the key highlights. So if you have to look at the key highlights, the domestic sales rose about 12% to 1,873 crore. While the export sales decreased about 22% year on year. Now, power gen revenue was comparatively softer due to the CPCB emission norms. Now, CPCB means Central Pollution Central Board, and now they have switched over to CPCB 2 to CPCB 4 products. So, to comply to that, we are seeing this power gen revenue being softer. But again, the company maintains that it has a strong portfolio there as well, so it expects a recovery going forward. But coming to the con-call highlights of the business, the company has maintained its 2x of a GDP growth, which implies about 13 to 14% growth for the fiscal. Again, industrial segment remains on the stronger side, led by segments like construction, railways, and mining. Now, again, products pursuant to the CPCB norms, as mentioned earlier, now they have contributed to 30 to 40% in this quarter itself, which has led the company's margins to rise to about a 5-year high. And again, so that was a main highlight over here. But however, the company did state that the margins are not sustainable going forward, and there might be a pricing impact which might lead a downtick in margins, but the margins will continue to remain at a healthier level. So this is overall on what we are picking on Cummins and why the stock has reacted in trade today.
Okay, Anushi, thank you so much for getting us that update on Cummins. But from there, we talk about Uno Minda, which has in fact come out with its earnings just some time ago. We have Puneet who's joining us to give us an update on that, as well as a bunch of other announcements coming through for the company. Puneet, over to you.
Well, thanks for that. So really strong set of numbers coming in from Uno Minda. They reported a revenue growth of roughly about 23%, which coming at roughly 3,800 odd crores. Now, this met Bloomberg estimates are roughly 3,700 odd crores as well. So positive on that. EBITDA margins also grew by roughly 23%. And margins finally came in roughly in the flat level of 10.7%, higher than Bloomberg estimates of roughly 10.5%. Profitability was also strong, coming in at a 17% growth and bang in line with Bloomberg estimates of roughly 211 odd crores. Now, when you look at the key business actions the company has taken, there are a couple of them which were very notable. The first one is, of course, an acquisition of further stake in the current JV of Minda Onkyo India. Now, this was earlier a 50-50 JV, and the company has acquired 49% further stake from its JV partner, the Japan-based Sound Corporation Onkyo company. Now, basically, this particular business and JV is in the manufacturing of speakers as well as speaker systems. The turnover of this business was very strong in the previous fiscal year, coming in roughly 807 odd crores. So, positive impact on that. The second key business activity is the company is entering into the new segment of sunroof systems going forward for passenger cars as well. Now, they've approved an investment of roughly about 62 odd crores in this particular project, and they've proposed capacity of roughly 80,000 units per annum. Now, the capacity will come on stream in FY26 and 27, and this is on back of an exchange filing the company had filed in the last week where, it has tied up with, Aisin Group of Japan for these sunroof systems. They'll be taking the technical assistance from there, and now they've put in their share of investments for this particular transaction. Why this particular segment of sunroof system is key? Because, it's a $10 billion global market and is expected to reach that level by FY26. Apart from that, it's a lot of competition from domestic players as well. And going forward, with additions of domestic value additions for the auto industry, this will be a key step. Apart from, Uno Minda, there are certain players who already have tie-ups in this space. So, Minda Corporation is one of the companies which has a JV with, a Taiwan-based manufacturer. Last year, Gabriel India also tied up with a Dutch-based Inalfa Group. And we saw Motherson Sumi last year acquire Yachiyo, which is a subsidiary of Honda Motors. So, the sunroof segment is very key, and Indian auto component makers definitely making a mark here. So, positive results and positive moves by the company. The conference call is scheduled today at 4 p.m. So a little more details awaited on that. But overall, a strong show. Back to you.
Yes, well, thank you, Puneet, for giving us those details. Up next we have EIH, which is in focus today, and the stock is under pressure. It's down, over 5.8% in trade today, and we have Mahima joining us to tell us the reason why. Mahima.
Right, Mika. So as you rightly mentioned, the stock is under pressure and probably investors are booking profits here. Well, in terms of volume, the stock has been trading at 9 times its 30-day average. Now, in terms of earnings, it came out with its Q1 FY25 earnings yesterday, and the revenue was up around 5.8%. EBITDA, however, was down around 13%. Margins have slipped from 31% to 25%, and net profit was down around 9% roughly. So this is one of the major reasons, numbers, because of which the stock is under pressure. Now, in terms of what the company has guided so far in terms of expansion plans, well, they're opening Rajgarh and Vindhya Vilas hotels later this year. They're also announced projects that are included in Tirupati, Vizag, and Goa, and overseas opening include 2 boats in Nile. Now, Mumtaz Hotels and EIH Associates involved in various projects going forward, and construction of Vizag Airport is also underway. Now, future growth, the company is aiming 50 additional hotels by 2030, and the demand in luxury segment will go up by 8 to 10% is what the company is aiming, which they are currently catering to. And overall, in terms of share performance, where 5 days the stock's been under pressure, down around 12.6%. However, 1 month it's been down around 14%, and 6 months it's been down around 12.5%. So this is the overall view of why EIH is buzzing in trade today.
Okay, well, thank you so much for that, Mahima. That's your view on EIH coming through, even as it slips on the back of earnings. And in fact, a lot of reactions here on the back of earnings, a lot of volume buzzers too. But with that, it's time to slip into a short break. But don't go anywhere. Lots more lineup on the other side. Keep watching NDTV Profit.
Hello and welcome to NDTV Profit. You're watching IPO Adda, and my guest today is from Saraswati Sari Depot. It's an IPO which is opening on August 12th, closes on 14th. Price between 152 to 160 rupees per share. It's a combination of fresh issue and OFS totaling to 160 crores. And joining me today is Nikhil Dulani, who is the head of investor relations at the company. Mr. Dulani, thank you for joining us today. To begin with, sir, take us through your business model and then and how you're planning your expansion as well.
Sure. First of all, thank you so much for having me at NDTV Profit. Let me start off. It's a big event for us. An IPO it's a milestone. We've been in this business since past 58 years, and we are at Saraswati. Every one of us are very happy about this. The business model that we work in is basically B2B space. What we do is basically the sari industry is fragmented industry, and a lot of players are situated across India, and they work at very small scale. Now any retail outlet, if they want to start a sari business, they need to have a lot of SKUs. The problem that they face is they can't travel across India to get different SKUs. So that's where we come in. What we do is we procure SKUs from 900 weavers, and we specially design them. There is a R&D team which works on that. We get the sample, and then we procure, and then once the sample is hit and tested across our customers, we have 13,000 unique customers. Once the product is tested across customers, and once they give a go-ahead, we start placing more orders for that. So the number of SKUs that we cater to are 3 lakh SKUs, and it's a huge number in itself. Let me also point out, we started in 1966. It's been 58 years, and since then we also have started taking different strategic decisions. One decision was in 2002 we started something called Utsav. Utsav is sort of a business festive for us, where we invite our cream customers. Mind you, our customers are 13,000, and the scale that we work at, and out of those, cream customers would be top 10% customers, which is 1,300 customers. Top 10% of that 13,000 customers, 1,300 customers. We visit them personally, individually. We invite them initially, and this happens for 2 weeks. Basically 2 to 3 weeks, and what we do is during those 2 to 3 weeks we give them special designs, special offers, and we try to give them the best of the product. And this special design which is being given to them, it helps during their season, which is festive season, which is Diwali or a wedding season. So we've been doing this since 2002. Again, in 2015, we we took a strategic decision and increased our space. Currently, now we work in the space, which is roughly 1,69,120 square feet, and this is since 2015. And since then, we've been scaling really well, which also reflects in our numbers. You could see ROC is 64% in 2024, and ROE is close to 58%, which is in a number in itself.
While I understand that it's a B2B business, how do you, take it to the next level from B2B to retail, and so you have relationship with all the retailers as well, and how does this entire supply chain work in that sense?
Our major focus is B2B, and it's been B2B since past 58 years, because I think there's a lot of gap in B2B space. As I told you, for person who wants to start a retail outlet, let's say a sari business, they need to keep a lot of variety, and variety is basically saris known from the origin that it comes from. For example, Banarasi sari is being worn in Banaras. Then again, Bangalore silk is being worn in Bangalore. When I say worn, I'm talking about the production part. So the retailers who want to start this business, they need to have variety of sarees in Banarasi, Bangalore, Kolkata, Jaipuri, Pathola, Paithani, Irkal. And these sarees are not manufactured at one place or in one geographic area. It is scattered around. And for them to go around, get the best supplier, get the best designs, get the best rate. It's not possible for the retailer to travel across India. That's where we come in. Everything, what we do is provide everything, best of supply, best of designs, best of variety and best of price under one roof. So that has been our USP, and that is where we try to focus more, and we are planning to focus more on that. So our major focus will be B2B. Slightly we'll move into e-commerce as well, which will be again B2B, which will complement our existing physical B2B stores, because we already have data points of 13,000 customers unique customers that already we cater to. And with help of those data points, what we're going to do is we try to increase the number of purchases that they already do. For example, a person who purchases once in a week, we try to get them twice a week by providing the product that they require through our data points and data analytics that we do. And similarly, we are planning to get into men's ethnic wear, which is our expansion plan again. In men's ethnic wear, I think in B2B space, there is a gap. And I think we can cater that. And we already have customer in place who already keep men's ethnic wear as well as sarees. And I think once we come in that space, a lot of orders could flow towards us.
Who would be your top customers? I can understand the suppliers part of it. Who would be your top customers in that sense?
So we have 13,000 customers and 900 suppliers. So in 13,000 customers, we are not focused or dependent on much of the customers. As you can see in our DIHP we provided and also the RHP that we would see, only 8% is being contributed by top 10 customers. So it is insignificant to the entire sale of 610 crores that we've done in 2024.
That your top line has been pretty much flat in the last 2 years. So can you give us an idea of the kind of growth that is there in this segment?
Yeah, let me point out. I think if you're looking at the number, I think you should focus on the journey that we've done since 2014 till 21. We did a CAGR of 9 to 10% in our revenue, and similarly 22-23 growth was 10%. 23-24 probably you're pointing out at one-off event, which is understandable, but if you look at the aggregate average level, we are growing at industry level. And also what I would also like to point out is if you'll see in the entire industry, which is above 50,000 crores, only 25 to 30% is organized, and rest 70% is unorganized. So I think organized share is going to grow, and that also what industry report reflects, that it's going to grow. So I think there is a lot of space for us to capture, because in the sea of this 50,000+ crores market, we are just at 610. So I think there's a lot of
I get that part of it. If you think the industry is growing at 10%, why haven't you been able to grow between FY23 and FY24 with that growth rate?
So as we can see in industry report, it's fairly 5%, and if you consider our numbers from FY21 to 23, we are as per our industry. I mean, the numbers are as per the industry.
Welcome, you're watching India Market Close and it's been a good day. It's been a good day on the street after the beginning of the week being fairly volatile and tumultuous. Even yesterday, though you had a gap up in the beginning, it did not sustain. That's not quite the case today. I would say the big takeaway from the market is that you've had a sustained run up and it's pretty much stayed there in a zone where one would have thought you would see a bit of profit booking. Let's pull up the intraday chart of the Nifty to just give you a sense of how the day has looked so far and what has worked. Interestingly, it's been an all-round kind of a positive day, not just any one part of the market which is pushing it up. So you have the Nifty doing fairly well and nice and even through the day and not really off its highs at all, still about 290, nearly 300 points up. Let's pull up the heat map as well to show you what is revving. I mean, we had a fantastic screen when we opened markets today where all 50 stocks were in the green. Not quite the case, but not half bad either. You have just about 6 companies in the red. ONGC is having a runaway day. I mean, crude prices could be one of the reasons. Since the results as well, they've been doing fairly well and it continues. In fact, the entire PSU back is been having a bit of a rebound after being down in the dumps and in the doldrums for the last few sessions. So ONGC is up the 7.5%. Coal India is some of them. The Adani pack is buzzing in trade today. Adani and Adani Port as an example of that. But if you look at the overall picture from the top line of this heat map, you will see definitely the PSUs dominating. Auto's not having a bad day. Bajaj Auto is revved up as well. And a smattering of financials with Shriram Finance and HDFC Life. So a mixed bag. Let's pull up the sectoral index as well, because that's giving you an idea of how broad-based this is. And all of your key Nifty sectoral indices, all of them are in the green. So that gives you a sense of what's really working. And like we said, public sector companies right on top. Reality is still positive after the indexation benefit that was widely expected has actually come in, but not really revving up to that extent. I'll just pull up advanced decline ratios before Harsh comes in and talks about the broader markets to give you a sense of what that breadth is, and it's staying fairly steady. This is a robust, healthy market. Just an hour before close, I would say, and the advances dominating the declines by a far stretch. And it's important. It's coming right a day before we hear from the RBI governor, the monetary policy, but nothing really phasing the markets right now. Just a quick look at Europe for a second, and then, of course, we'll go into the broader markets. Europe, because we need to see where that global market cycle is sitting, and we've seen US turn the tide. Europe is continuing that momentum. So, Harsh, green all round, at least for this afternoon.
Absolutely, and in the broader market, some very strong reactions and plenty of sectors to talk about. We were just speaking about that before we started off on this one, but good strong 2% move on the Nifty mid cap. Let's pull up the small cap index as well. Kind of similar move on the small cap as well. Let's pull up the graphs before I go to stocks, if I can. Nifty mid cap, if we can have the graph intraday to try and see how we've done. There you go. We're very, very close to the high point of the day. That's what I'm trying to mark out actually. So we're seeing good positivity right towards the end, very unlike yesterday. Let's pull up the Nifty small cap as well, similar intraday graph, and there you go, similar trend coming through. So that's where the positivity currently is, and hopefully that sustains all the way to the end of the day as well as the week. But let's quickly pull up some newsmakers, especially on the result side of things. Venky's came out with numbers very strong. That EBITDA negative number now turning positive. So that's one big plus, 20% higher. Venky's locked in upper circuit. BASF2 can join that same party because up 20% as well. Cummins, while the stock had a muted reaction at the start of trade today, it really gained traction after the commentary came in roughly around 11:30, 12-ish in trade today. Midway through the day, we saw that kind of 3-4% spike, and thereafter it's up 7% now. Gulf Oil, again on strong numbers, has been up and away in trade through the day today. Harsha Engineers as well came out with numbers today. Again, a strong set, 7.5% higher. Safari Industries, when I'm looking at the year-on-year numbers, nothing fancy, but nonetheless, the stock is up 3% on the back of those numbers. PB Fintech yesterday, a strong set when I'm looking at it YOY, annualized recurring revenue also going up 25 odd %, and the stock is away in trade on the back of that. Chambal Fertilizers, well, better margins both sequentially as well as year on year, but the growth on the top line has been strong when it comes to the sequential number. 6% to 15% on sequential basis. Those margin numbers have made a huge difference on the stock price. That reaction showing. Lupin as well, strong reaction, and we'll speak with the management later in the show on that one as well. PI Industries up 3.5% as well on the back of numbers. Now, which ones are not doing too well? Fusion Micro locked on lower circuit right from the start of trade. 13% credit cost. Guidance is in the 1.5 to 2% band. 13% credit cost is what Q1 FY25 numbers reflect. EIH also sharply lower in trade, 5.5 odd %. Gland Pharma also seeing a bit of a beating with regard to how markets have responded to numbers. Bata and Fortis, if we can pull those up quickly, even those are ones which have seen a reaction. In terms of newsmakers, plenty. Shilpa Medicare, Cupid's second consecutive day where we've seen Cupid locked in upper circuit. Suzlon also up, as has been the case for a better part of at least this month. And Aurobindo Pharma is also up. Believe that there's an approval which has come through over there. Oil and gas stocks in focus. Oil India Limited, Castrol, ONGC, HOEC, all four of them are buzzing in trade today. And the Nifty Energy Index, therefore Nifty Oil and Gas Index, I beg your pardon, is up and away in trade. BSNL's Mega Bharat tender opens tomorrow. 65,000 crore of cable and fiber and the like, all of that. And you'll see some of the stocks buzzing. Tejas Networks up 10% nearly, and HFCL up 7% on the back of that. Media stocks in focus. Tips Industries, PVR are some of the other stocks which are in focus, keeping the Nifty Media in focus. Agrochem fertilizer stocks also in focus. Deepak Fertilizers, Rallis, if we can pull some of those up. There you go. Those ones are also in focus. Now, in terms of the rainfall over the country, second half monsoon seems to be quite good, and therefore likely that above normal monsoon, keeping some of these stocks in focus. If you can put up a Chambal Fertilizers as well, that one is up and away, 5% higher.
Fertilizer had a good set of numbers as well, which came out today. And Safari is an interesting case, specifically as Harsh has mentioned, because Safari was up about 7-8% since the get-go this morning, even before the numbers came. At that point, it looked like it was reacting more to the poor numbers from VIP Industries, its peer in the space, rather than its own numbers. And now when you actually see the detailing in, the numbers aren't that great, but Safari is still about 3.5-4% up. Ruchit Jain of 5 Paisa is joining us. Ruchit, a very good afternoon to you. Great to have you on the show as always. Let's start with your take on the indices. It's a good time to go long.
Yeah, hi, very good afternoon. I would wait for some more time before creating fresh longs on the index. Primarily last week, we did see that negative divergence on the Nifty daily chart, and the impact was clearly seen in this week. But I think the index has not yet crossed its immediate hurdle of 24,350, 24,400 range. Now, if I take some retracements of this correction from 25,080 to the swing low of 23,900, then 38.2% retracement is coming in that range of 24,350 to 24,400. So I think until we surpass that level, it's too early to say that we are out of the woods yet. So I think still some more consolidation or correction would be seen. Only about 24,400 we would be forming longs on the index. Otherwise, it may be a pullback move which we are seeing intraday, but still not completely out of the woods yet.
Okay. What about your top calls for this afternoon, Ruchit?
A couple of recommendations on the long side, one on the short side. I'll start with a buy call, would be a buy call in Alchem Lab. So pharma is one space where we are quite bullish with respect of market volatility. This has, this sector has continued to do well. Alchem Lab has given a breakout from a recent consolidation phase with rising volumes, which is a good sign. So one can go long over here with stock below 53.20, expecting targets around 5650. And IndusInd Bank is looking weak, where short positions could be formed. So ideally, if you look at this daily chart structures, when the bank Nifty was going up, when it was in an uptrend, already this stock was a relative underperformer. And when there is some weakness in the overall banking space since last few days, the prices have started again forming low top, low bottom, and today even the previous swing low has been breached. So I think that weakness could continue in the near term. One can go short on the IndusInd Bank with stop loss about 1390 for potential targets around 1300 to 1280.
Okay, thanks for that, Ruchit. but stock of the day, one that is seen a really, really strong surge, especially midway through the day, is Cummins India. There you see the intraday graph, how the stocks just surged midway through the day. Well, positive outlook from management being one of the reasons why. Q1 results otherwise, of course. Anushi joins us with the key Q1 details. And Anushi, if you can also give us a lowdown, couple of quick, big positives that came through from the management commentary.
Absolutely, Harsh. So as you mentioned that we did see the stock reacting to the positive management commentary in the second half of the day. This was after the earnings con call which took place. But before we go into that, let's just see what the results were. Now the company reported a 4% of a revenue growth, while EBITDA saw about a 38% growth. Margins remain in the main focus, inching upwards to 20% as compared to 15% now. And net profit in line with the EBITDA growth saw about a 31% jump. So the stock after the management commentary did hit a 8.34% of a intraday high, while its volumes were trading about 3x its 30-day average now. So some of the key highlights also include the domestic sales going up around 12% YOY, while the export sales decreased by 22%, and the power gen revenue being softer due to the CPCB norms now, which have revised to CPCB 2 to CPCB 4. Just to understand what that is the emission norms for diesel power genset engines, and CPCB means Central Pollution Control Board over here. But onto the key con call highlights that we are seeing, the company continues to maintain its guidance of up to 2x GDP growth, which implies a 13 to 14% of a revenue growth for overall of FY25. Industrial segment continues to remain the focus area, with growth led by construction, railways and mining over here. Now, we have spoken about CPCB norms before. Now, this contributed about the products of these contributed to about 30 to 40% of sales in Q1, which resulted in the gross margin seeing about a 5-year high, led by the higher mix that we are looking at. But other than that, the management did highlight the margins that we are looking at as currently not sustainable, given the pricing action which might take place due to the increase in competition. But overall, it does not see much of an impact, with margins to continue to remain at healthier levels. So this is what we are overall looking at. Cummins, strong management commentary, strong set of numbers overall.
Okay, thank you for that, Anushi. So, of course, strong management commentary, 30 to 40% of top line impacted by those CPCB norms, which is Central Pollution Control Board. And those norms, of course, aiding the numbers for Cummins as well as the margins. But, before I go to a break, let me quickly ask Ruchit. Ruchit, this one, 7% move in trade today. Of course, lots of fundamental reasons, which we will continue to break down, but give us technicals. How are you looking at this one?
So technical sector is also looking positive. In fact, if we look at the last 2.5 months, the stock has gone through some consolidation phase. At the start of May, the prices were trading around 3,400, 3,500 kind of range, and even as on today's low, if we see similar around 3,450. So rising trendline support is also there. So I think till the stock is trading about the 3,400 mark, the broader trend still remains positive. And today's up move is not only just a price-wise up move, but even if you look at the daily volumes, then the volumes are also good along with this up move. So I think the risk-reward ratio is favorable for a resumption of the up move over here. So downside seems to be very limited, and it looks positive till about 3,400.
Downside limited and looks positive. Thank you, Ruchit. Stay with us. We're going to slip into a very short break. We delve deeper into today's big movements, especially on specific counters as well as sectors. Stay tuned. More insights on the other side. Welcome back. Good afternoon. You're watching India Market Close here on NDTV Profit. We have also with us Sudeep Bandyopadhyay of IndiTrade Capital. Welcome, Sudeep. Good afternoon. We were just before going to break speaking about Cummins India and the kind of commentary and the kind of numbers that have come through from Cummins. Of course, the management is cautioning that margin sustainability may start to become a challenge. But just with regard to the rally in the stock price that we've seen today, as well as the larger rally we've seen over the last 2 years, both in cap goods as well as Cummins specifically, what's your sense now?
Well, I think the numbers are pretty good. That much I must say. And in between, based on the global parents, numbers and commentary, the market was little worried. So this numbers which came out today was definitely a positive, definitely significantly positive. And I think, the rally, as you mentioned, in cap goods and particularly in Cummins, I think continues unabated. But having said that, I think in spite of the good performance, I also would be a little cautious because the valuation does look full at this stage. And I don't think I will, recommend a buy or jump to buy Cummins at current levels.
Got it. Okay, Sudeep, thank you for that. I just want to also quickly flag out some of the other stocks which are buzzing. Metal counters doing fairly well in trade. Media stocks in particular doing well as well. Let's pull up the Nifty media, some constituents there. Ruchit, in terms of, while we're pulling those up, in terms of the constituents, Ruchit, could you give us some kind of a lowdown on your sense of where this is going? Because we're seeing good rally, especially in media and metals. Your sense of this?
So I think there has been a decent underperformance in the media stocks over last couple of years, and many of the stocks have been forming a rounding bottom kind of base over here. So if one is looking from a bit mid-term perspective, then there could be some selective media names which could do well. Within the entire basket, I think Sun TV is one stock which clearly stands out in last 2 or 3 months, and that uptrend could continue even further. So Sun TV would be one stock where one can take some exposure at current levels and keep some room to average in case if we get any kind of short-term declines in the near future. And amongst the metal space, I think it's more of a stock-specific trade setups over there. It's not that the entire sector is looking much bullish from a near-term perspective. JSW Steel, I think, could be a relative outperformer within the sector, where we have seen that the price has formed a lower low in this correction of last 2-3 trading sessions, but RSI has formed a high low, which in technical analysis is usually termed as a positive divergence. So JSW Steel amongst the metal space looks positive, but not the entire sector as a whole, but one can take some stock-specific approach within the sector.
Okay, now we'll shift focus from all that we're covering to pharma. We've got a couple of names, mid and large sized, which are making fair moves, both in different directions. We'll start with Gland. It's under pressure. Q1 numbers were tepid. Company posted a weak quarter versus at least estimates. Varsha, talk to us about one, what was your key takeaway from the numbers itself? And second, what are brokerages saying? Any change in views?
Well, thanks Harsh for that. So yes, Gland Pharma is under pressure today on the back of weak numbers that company has been posting now. If you see that US revenue grew 79%, but India revenue declined by 19% as majority of their products comes under a drug price control. Now Sensex, which they've recently acquired, a CDMO player, their revenue stood at around 388 crore, but there was a EBITDA loss of almost 28 crore. Now lower milestone income and ROW sales did hurt earnings, and of course there was a postponement of products by European customers which did hurt performance. Now EBITDA margin impact was led by higher employee costs, though this was offset by lower other expenses, but there was PAT decline which was led by higher depreciation and tax related expenses. But company did in the con call, they said that they are maintaining their guidance of mid-teens year-on-year growth in revenue for FY25, and they guided that EBITDA to be positive from fourth quarter of FY25 and in FY26 as well for Sensex business. The second quarter for Sensex would be impacted due to European holiday season. Now, the company is also collaborating with big CDMO players for biosimilar CDMO and in licensing opportunities, but brokerage have mixed reviews, wherein Motilal Oswal has buy rating due to revival in biologics business and building a healthy portfolio in US products, but Jefferies have rated downgrades to hold with target price of around 2,180, and Nomura also have downgraded to reduce, which implies a downside of almost 13.7%. Now this is due to Sensex, which may take longer to turn around, and the weaker base business that they are expecting. So this is all we have views on Gland Pharma.
Okay, point taken, Varsha. Thank you so much. Sudeep, your views with regard to Gland's numbers, unimpressive, but what really stood out for you, and this 3% reaction on a day when you're seeing pretty much a solid coat of green across all indices as well as the broader markets and even across sectoral indices. What's your sense?
Well, I think, Harsh, it was pretty much on the back of the performance. I think it was a pretty, underwhelming performance, and naturally the reaction of the market is on expected lines. The fact that India business is not showing positive signs is a bit worrisome. And overall, I think, I am looking at pharma companies which have a significant domestic focus, and the domestic business is growing as the winners in the near future. Domestic pharma, the opportunity is growing at 25% CAGR. And companies which are focused in this space and doing well should do well going forward. That's what our belief is. US market has its own set of challenges, and US market has its own set of pricing pressure, particularly in the generic side. And while some of the companies, at least Indian leading pharma companies, have started doing well, performing well in US, but I'll still be cautious on the US business at this stage. Now, Gland US business doing well is not any great solace, because India itself is underperforming, and under the circumstances, I definitely will stay away from Gland.
Okay, so Sudeep, you have a strong view on pharma. Also, I was just pulling out the charts on pharma over the last maybe 6 to 7 trading sessions, especially since that volatility has set in. We've seen pharma really hold up. In fact, it's up 1% over since 31st of July, if I were to take that as a benchmark. So it's been fairly resilient if you look at all that we've been through. What's your sense like? What should one therefore bet on? Are there any names you're looking at specifically?
Well, first of all, I would say that, that traditional thinking that pharma is a defensive stock, I think is a bit overdone. Look, there is enough and more volatility in pharma, and the volatility comes not only because of the market movement, general market movement, but also their individual, position, individual business peculiarities, and regulatory action. So it is also a particular area where there is enough and more volatility. To assume pharma is a defensive, I think, is not really appropriate. Under today's circumstances, as I was mentioning, that we believe that domestic pharma will continue to do well, and that's a pretty safe and secure space. So companies having significant focus on domestic business will continue to outperform, and with less volatility. So, let's say a company like a Mankind Pharma, they have 95% plus business coming from domestic market. Recently, they acquired BSV. And it was being talked that the price they paid was a little too high. But even the acquisition, I think, is a very, very appropriate acquisition for a medium to long-term perspective. So a company like Mankind definitely can be acquired by investors for long-term. You can look at other companies having significant domestic exposures and start accumulating in pharma. Domestic pharma is a space to be in if you don't want volatility and steady growth. That's our belief.
The kind of idea of pharma as a defensive space, like consumption or like FMCG, is because of the philosophy that no matter what happens in the economy, the demand for it is inelastic, right? If you're sick, you will need medication, and someone will have to provide and pay for it. Which is why these are looked at as defensive plays. Even in the worst economic situation, demand is not going to drop beyond a point for drugs or for life-saving drugs, and that's the reason why pharma is in focus. But having said that, Ruchit, in terms of on the charts, what are the kind of interesting plays that you see, and specifically any view on Lupin?
Look, the broader trend for Lupin is quite positive. We have seen a good amount of consolidation in the stock from April till start of July. But a month ago, the stock gave a breakout from that consolidation, and it is just continuing its uptrend. So I think if any existing long positions are there, then they should continue to ride this trend. And apart from Lupin, if I look at the entire pharma basket, then another two names, Sun Pharma and Alkem Laboratories, these two are also looking quite good. So I think fresh positions has to be built, then Alkem would be preferred, where fresh positions can be built even at current levels.
Alkem over Lupin. Sudeep, any comment on Lupin specifically?
I think Lupin has started doing well after a very, very long period of underperformance. The US market has been rewarding them in the recent past, and that's getting pretty much reflected in their numbers and the performance in the market even. So yes, if you are a little aggressive investor with appetite for risk and volatility, you can go for a Lupin or even a Sun Pharma.
Lupin has been having a pretty good day. Look at that intraday chart. It's up about 23.5% in the last 3 months. And the reason is because of its numbers. Its Q1, April to June, has been pretty good. 78% up in profits. Margins have expanded. A strong June quarter, beating street estimates moreover. So we spoke with the executive director of the company on the quarter gone by and the road ahead. Let's listen into a slice of that conversation for a company that is definitely in focus today.
We are very pleased with our results. And as you can imagine, it is actually because of buoyancy on the top line, across all the geographies. We have done very well in North America, where we serviced the previous year. We had a growth of about 28%. India also saw a growth of about 17.5%. We serviced the previous year. Likewise, you would see the emerging markets, the other developed markets, Latin America, and of course the API segment also have done extremely well. So the introduction of newer products, pivoting to more complex generics has really paid off very well for us. If you look at America, the respiratory products, Albuterol and Spiriva continue to do very well. But this quarter, of course, we had the benefit of Mirabegron also. So essentially good results coming in from the top line buoyancy, but equally there has been a lot of focus on controlling the costs across various lines. So we have been focusing on, in fact, looking at gross margins expansion, looking at alternate vendor development, looking at routes to synthesis, and very much productivity across all lines, be it on the sales force, be it at the R&D level and the like. So all of this has resulted in a very good EBITDA margin for us.
Just give us a sense of you've provided 75 crores for Glumedza. Is the entire settlement amount been provided in this quarter, or are you going to spread it out over the next few quarters?
No, with this, hopefully the entire Glumedza story is over. So this is another class suit in America that we settled, and with that we are fully done.
Hi, Mr. Ramesh. This is Varsha here. Good to have you. I just wanted to ask you on US business outlook. So we have seen the US has reported almost $27 million in Q1, and in FY24 we did see the annual revenue of around $815 million. Now, do you foresee this reaching to $1 billion in the medium to long term? And if yes, what are the drivers for this growth?
Yes, we do believe that we have a very strong pipeline actually to address the American market. So as we've been saying, we are kind of pivoting to more complex products. And given the nature of, in fact, the complexity associated with it, it's not going to erode very fast. And from that perspective, it will continue to have a good run. Besides that, we expect, in fact, a lot more products to be introduced. Even during the course of this quarter, we have Mirabegron, which will continue. We also have Prednisolone, ophthalmics products. We also have Slind and all of this, which should come up. And going forward, given the emphasis on the respiratory products, looking at in fact the injectables, glucagon, Risperdal Consta, and others which could get introduced in the medium term, I would say that certainly $1 billion mark is certainly within our reach and more.
Also, coming to your margins, so you had guided 20% sort of margins in FY25, potentially increasing to 23% in next 2 years, but we have already seen that 22-23% mark this time. So is this sustainable, and can we grow more from here?
So two things that I'd like to flag off. So there is of course the one-time Blumenthal settlement that impacted us about 75 crores. But you also recognize that our R&D expenditure is on the lower side this quarter, vis-a-vis what we kind of guided the market. I do expect that to step up. So if you were to look at R&D of 350 crores and stepping it up, in fact, the last quarter is about 430 odd crores. So there has been a step down in that regard, but we do expect things to go up. The R&D spendings to go up, and if that were to be the case, I would rather guide prudently, conservative, and I would say whilst we did guide for about 20 odd percent, I would say about 21% would be fair at this stage. There are headwinds, one should not deny that. There are headwinds possibly because of geopolitical tensions across the globe, the Red Sea situation and the like as well. So we need to take cognizance of all of this whilst we guide.
No, why I was asking this, because 80% of the new products that you are going into is non-oral, which is a kind of, high margin product. So that's the reason I'm asking you that can we see an uptick in margins?
The fact of the matter is that we have also been, we have got into adjacencies in the recent past. So the core business, if you were to knock off, in fact, the impact of adjacencies is already above the 23% mark. And that was, in fact, it's been the case for about a year. And we are trying to, grow those businesses as well. From our perspective, if you were to take an all-inclusive EBITDA margin, taking into account the non-core businesses also, I think it would be fair to state that it will certainly increase, but I would still guide for about 21% for the current year.
Ramesh, where do you see R&D as percentage of sales for FY25? And when you say that R&D may go up in FY25, what is the kind of pipeline that you're working on?
R&D, you'd all recognize, is actually the bloodline for the future. From that perspective, it's important for us to invest. And we are pivoting to more complex ones. I've been doing this for some time. So the spend on respiratory products, the complex injectables, biosimilars, that emphasis will certainly continue. As a percentage of sales, between 7.5% to 8% would be the norm.
Mm-hmm. Give me a sense of the Indian business, because we've seen good growth happening there as well. What's driving growth here in the domestic market?
I would say that it's actually traditionally we've done very well in cardiovascular, diabetes, respiratory, and of course, the women's health, gynecology products, on multivitamins, and GI space. So that focus will certainly continue. We added about 1,000 odd people last year to our sales force, and that's paying off right now with an increase in productivity and the like. With newer products being brought in, so we guided for a growth of over 25% vis-a-vis the market, and we've been able to sustain this quarter as well.
You're sitting on a net cash of nearly 20 crores at the end of the quarter, compared to a net debt position in the previous quarters. Do you see now you are in a phase of constant cash generation, and will that be also be shared with the shareholders going forward?
Yeah, you're right. So we did turn to be a debt-free company at the end of last quarter. It's a very small surplus that you're speaking about. But you would also recognize that we are an acquisitive company. And from that perspective, we would be looking at, in fact, M&A opportunities that would come to us, both in India and other parts of the globe as well. So, of course, we also believe in the philosophy of trade. It's important to actually have debt to kind of increase the ROE for shareholders. So we are not, shying away from that. So whilst we do have a surplus at this stage, it might turn to be, to be a debt. We'll have debt soon enough on the balance sheet.
Mm-hmm. So which are the areas that you're looking for if you're looking for inorganic growth?
we have made our intentions fairly clear. We'll be looking at anything which is strategically important for us from an India perspective. We're looking at small bolt-ons in areas that we think is necessary in other parts of the globe as well. But equally, we have set our eyes on specialty, and that we think would be the way forward for us.
Right, that conversation with the Lupin management, Mr. Ramesh Swaminathan of Lupin. Time to slip into a very short break. On the other side, we'll discuss the realty sector on the back of indexation amendments, of course, as well as more developments, as well as certain specific sectors. We'll focus in on some of those. Stay tuned to NDTV Profit.
One of the big stories through the day and actually for the real estate sector stocks in the last couple of trading sessions has been whether there will be some kind of softening in the indexation rule. Now, the government has decided to restore indexation benefits. In fact, that is an amendment proposed in the finance bill that the finance minister will place before Parliament, those amendments before Parliament anytime now actually. The reason this was important is because removing the indexation benefit from the way you calculate the property price for attraction of tax was seen as a big negative for the sector. But we spoke today with Ghulam Zia of Knight Frank India to understand the potential impact on the softening of this rule. He says it's a welcome change.
From here onwards, the cases are different, and today when you're buying a property, you are taking into account whatever is the new rule for LTCG calculation. It was only the cases which have happened earlier is where the problem was. So in any case, the industry or the sales number were not impacted because of the new changes, and neither would it have any material gain or impact on the situation going forward.
All right, we'll get a quick take from Sudeep and Ruchit on real estate, and then we'll come to those Dr. Lal Path numbers. The numbers at the first cut of it looking pretty decent. But just Sudeep on real estate, I mean, does it really change anything for listed real estate players now that this relief has been given?
Well, Tamanna, I think it's a significant sentiment booster. Somebody buying a property today will not have bothered about indexation because he knows that he has to pay 12.5% without indexation. So future purchases theoretically was not affected, but there is a major sentimental impact because post-COVID we know a lot of people were upgrading. Now that upgrading had built-in calculations of the benefit they get on capital gains tax through indexation. Now, if you had taken away that indexation benefit, I think some of these upgrades would have wouldn't have happened, and probably they would have recalculated. So sentiment boost definitely was required, and they got it. And I think it's only fair that people holding on to ancestral properties, old properties, do get the benefit of indexation, so that they can go and reinvest in a new property. So not directly, but indirectly, definitely positive for the industry. And I think that's what will get reflected in the market as well.
So another way of also looking at it, and this is an interesting point, Sudeep, that you have freed up money to purchase newer homes because people are not worried about how much they will lose if they sell their older homes. But does it effectively just remove realty as an attractive investment option completely, which was already there were a lot of questions over it, but anyone who's buying a property now and looking at it from a 25-year-old horizon will have to do it without any indexation benefit?
Well, I think people will get used to it, but the tax rate also has come down. And if you look at it this way, I think, with the tax rate coming down, it's a very attractive proposition. You make gain and you pay only 12.5%. As opposed to income from many other sources where the tax rate, or even normal income where you at a marginal level you're 34-35% tax you are paying including surcharge, whereas here you including surcharge you end up paying about close to 14.5-15%. So I think it's a good proposition. I don't think it does take the benefit away of investing in property. I think property investment does happen because of a possibility of a future appreciation, and I think that will continue to happen. The negativity around selling past old properties or already held properties because of indexation going, I think that is being removed, and that should help the cause of fresh buying of properties in future.
Harsh, you looked at the amendments pretty closely, and what's interesting is that it's not as straightforward as it seems. For anyone who has owned a property before July 23rd of this year, you have an either or option, but there are some exemptions among those as well, right? For NRIs, for example.
Yes, so for NRIs, for companies, partnership firms, you'll continue to be governed by the 12.5% tax rate.
So no indexation benefit.
So no benefit of indexation. And that's possibly a bit adverse. It also adds to complexity, right, Tamanna? Just from I know you spoke about it a bit in the morning, but I'm not sure if we've driven home the fact that most individuals and HUFs will likely not be consulting with a chartered accountant full time, most of them. Whereas when you look at a partnership firm or a company, likely they will be engaging with at least one consultant or chartered accountant, and therefore are more aware of how laws evolve. Whereas for individuals, HUF, where they've given this either or option, now those persons will have to consult with someone.
You are creating employment for CAs, is it?
So yes, I'm a chartered accountant, and yes, I'm pro that. But I mean, the intent of it was to reduce complexity. I'm not sure whether that is getting achieved.
I mean, you can't reduce complexity at the cost of effectively removing something, a benefit retrospectively, right? So it had become fairly complicated. But anyway, there are now two options if you have owned the property before July 23rd. From here on, well, of course, it's clean and simple. 12.5% is a long-term capital gains tax. Autos also in focus today, and let's talk about Tata Motors. Tata Motors added one more medium-range electric vehicle to its list, launched its very new Tata Curve with prices starting from 17 lakh rupees. While speaking at the event, Tata Motors MD Shailesh Chandra echoed bullish sentiment, saying the PV, that's the passenger vehicle segment, will see strong growth in the second half of the current financial year.
Festive period and all are going to be strong, and therefore in H2 you're going to see growth as far as PV industry is concerned. So I don't see a concern on the larger PV industry trend on this launch. The second also aspect that I want to cover is that, by the way, while the industry is seeing a flattish growth, but mid-size SUV is growing very strong. It is the strongest growing segment, above 20% growth that we have been seeing in this segment. So for Curve, it is absolutely the right time. We are here to win in the segment, and that's the whole aspiration. You have seen that whatever product we have in our portfolio, the idea is that we are in the top selling cars in those segment, and we want that in this fast growing, intensely fought segment. We are among the highest top selling cars. So that's the ambition. You'll have the numbers, you can peg a number, but I can only confirm from a production flexibility perspective, we have ability to ramp up to whatever extent the demand goes up.
Plus a new launch, can we expect a new car coming, Tamanna?
An asset which depreciates the moment you drive it out of the showroom. But on electric vehicles, I was seeing this report on a survey. I don't know to what extent it's true or not, saying a lot of people who have bought electric vehicles may consider going back to a ICE engine for their next vehicle. So the EV bet is the future. It's here to stay, but it's going to take some time. Nevertheless, I mean, Tata Motors has smashed it in the EV space with the Nexon. So more of the same, maybe from the Curve. Sudeep, you like Tata Motors?
Well, I do like Tata Motors. I think they're doing a fabulous job. But if you want, ask me that whether I want to buy at these levels, the answer is no. I think it's done very well. Even this quarter numbers are also pretty good as far as JLR is concerned. And JLR drives, the consolidated profitability of the company. But going forward, I think there are some headwinds as far as JLR is concerned. And as far as domestic business and the EV business, of course, as you rightly said, they have the market with Nexon and the new launches. But the reality is it's a minuscule segment of the overall market. And it'll take a long, long time before it becomes becomes of any real significance. So I'll wait and watch. I don't think I'll buy at these levels.
Okay, so Sudeep on wait and watch. Tamanna is not betting on EVs. Ruchit, if we can pull up just a 1 month chart on Tata Motors, maybe my question becomes slightly more relevant. This one has seen a bit of a fluctuation over the last month or so. We're off from those highs, 10% plus. Ruchit, what's the sense like on Tata Motors?
Well, I think the stock could trade in a broad range in the short to medium term, where 950, 920 would be a very strong support zone. Whereas on the higher side, we have seen a decent amount of selling pressure from that 1150 range. So I'm not expecting any significant trended move in the stock in the short to medium term. But yes, if you get the stock near that lower end of the range, in the range of 950, 920, anytime in the near future, then I think the risk reward ratio would become favorable to take some counter trades over there. So not any trade setup right now, but yes, a buy and dip candidate where around 950, 920 if there is some correction, then that would be a good opportunity to buy this.
Okay, and Ruchit, if you're around, I believe you are. Ruchit, last 10 minutes of trade, your picks.
I would recommend going long on IEX over here. So a relative outperformer in last 3 trading sessions when the markets have corrected, the stock has not seen any correction. And today when the broader markets have resumed momentum, we can see the stock forming a new high again from last few trading sessions. So I think IEX can be bought at current levels, go along with stop loss below 192 from a BTST perspective for potential targets of 208.
Okay, looking good. IEX in trade. We're currently sitting at around 198 or thereabouts.
GET&D also buzzing. They've got a 305 crore order from Power Grid Corp for construction of control center. Stock up about 5%. And, quite close to its day's highs actually of 1760 at 1757 right now. It had a decent set of numbers this quarter as well. Ruchit, is this something that you're tracking on the charts?
So there's a high top, high bottom structure. So overall trend still remains on the positive side. And we have seen that whatever dips in between that we are getting, we have not seen any kind of volume-based corrections. So when the prices are going up, volumes are good. When there's a correction, the volumes are not there on when the stock is getting sold off. So this is overall a positive sign. I think 1500 has now become a very strong support base. So till this 1500s are intact, 1500 levels is intact, we can see a continuation of this uptrend.
Yeah, okay. The other big story to keep an eye out on, and especially for tomorrow, is the RBI monetary policy announcement. The meeting of the MPC, that's the Monetary Policy Committee, is currently underway with the set of decisions to be announced tomorrow. What is expected out of the meeting? Pallavi joins us with the key takeaways. Pallavi, safe to say we're going to see another quarter of no rate change?
Absolutely, that's right. So, like you've mentioned, the India Monetary Policy Committee's meeting is currently underway, and this is the first time that they're meeting post the presentation of the Union budget for FY25. It's also the first time that they're meeting post the Fed having signaled greater chances of a rate cut when it meets in September. And interestingly, it's the last time that this MPC is meeting before its term ends and a new one is appointed. Now let's have a look at what are some of the factors that have changed from the last meet to this one. First up, of course, is inflation. We've seen inflation climb to a 4-month high of 5.08%. That's for the month of June, and that's on the back of rising vegetable prices. On that, we have seen some easing, and there's also comfort from the fact that the IMD has very recently, just last week, reaffirmed that they expect the remainder of the southwest monsoons also to be above normal. So that's something that the MPC is going to be deriving comfort from. What's also changed is that, of course, geopolitical factors will continue to need close monitoring. Currently, we're seeing some easing in crude prices, but that's something that we're going to be watching out for, as is the MPC. The rupee has, of course, been breaching fresh lows in every trading session the last few days. Liquidity, however, is significantly less tight than it was. So, all in all, while inflation has seen a little bit of an uptake, economic growth, at least on the domestic front, remains resilient, and that is what sets the stage for a likely status quo on the benchmark lending rate. But we'll, of course, be bringing more on that tomorrow.
Absolutely. So tune in. We're going to have coverage right from the start of the day on what you can expect from the MPC. And I suppose we know that it's very unlikely to see anything in the rates. But after the kind of week we've had where central bankers have driven the agenda for the entire world, we'll be keen to see what Governor Das says and what his commentary is. Especially another important story today on Bloomberg saying that the CPI could be tweaked. Does he have any view on that? So those are some of those things. Anyway, just less than 3 minutes left for the market close. I want to thank Sudeep and Ruchit for joining us today. Great to have you on the show. And, it's been a good day for the markets. Let's just pull up where we're looking like we're closing on. The intraday Nifty is a good place to start, considering that it has held off fairly well. No big complaints, frankly. Day's high was at 24,337. you aren't too far from the day's high. So that is definitely something to cheer about. Remember, it's been a brutal tumble from the 25,000 levels for the Nifty, and there were a lot of voices out there believing that it's going to be a long climb back up. I don't know if that's the case. Whether we sustain this momentum, or of course we'll see. We opened the show asking Ruchit whether he would create fresh longs right now. He said, I'll kind of wait and watch. Let's pull up the heat map as well and see what's happening there. ONGC and Coal India are the stars. Some positive brokerage reports possibly contributing to this, but overall you see a PSU flavor. So you're seeing a rebound in a sector which was completely beaten down. So when you see Coal India there, Power Grid, BPCL, some of those names really shining. The Adani pack is having a good day, and maybe we can pull up some of those stocks with standard disclosures. Of course, Adani and Adani Port are doing fairly well in trade today. Financials are not doing too badly either. All right, so that's Adani Enterprises. Let's see ports, let's see green, let's see energy. Let's see if this is a broader story as well that we are seeing. Yeah, so you're seeing all of these in the positive territory. Coming back to the financial space, and I just want to pull up the Bank Nifty before Harsh comes in and talks about the broader market. Bank Nifty also holding up fairly well. And Harsh, this is, I think, important because remember, banks were languishing. Even in the kind of recovery we saw yesterday, the banks really didn't hold up that well. And I'm not saying it's a runaway kind of a gain, but that mood seems to be changing. Your top gainer though, your top gainers though, of course, and we'll pull up the sectoral indices for a second. The sectoral indices for a second. Your top gainers though continue to be your public sector companies, followed by metals. Again, a rebound story, right? Metals were knocked down.
4% move on PSU, metals 3%. And banks also actually aiding the Nifty 50. We're closing very close to highs, actually, days highs, but very close to those highs. And that's a positive indication, at least, for hopefully what's in store for the rest of the week. We're looking at the high, I think, is 24,337 odd. Right. So you're very close to those highs. And we've closed, actually. So not a bad day at all, Tamanna.
Just to look at the broader markets before we
wrap up. Let's pull up the BSE 500. Let's look at a few names if we can. Of course, the Nifty mid-cap and small-cap trading 2+% higher. They've also closed very close to the highs. BASF on the back of very strong numbers, 20% higher. Tejas Networks, tomorrow there's going to be 65,000 crore BSNL order which opens up, and Tejas Networks likely a beneficiary, HFCL 2 likely a beneficiary. So those buzzing on the back of that. Oil India was up and away in trade along with ONGC. Some favorable notes as well coming. Good strong numbers from ONGC also aiding. EIH on the back of poor numbers. Gland Pharma also down 4% on the back of poor numbers. So those were some of the names which were buzzing.
Bata also on the back of poor numbers.
Bata also on the back of poor numbers. Yes, 3.5% lower Bata. But that's where we're closing. It's largely driven by earnings, of course, with some specific stories outside of earnings, which is keeping us.
So maybe back to sanity, brokerage notes, earnings, all of those are driving how stocks react. But that's all the time we have. Before we close the show, though, we want to just talk about a story that has dominated chatter all day and is really heartbreaking. And we're talking about Indian because she weighed over 50 kilos by just about 150 grams. I mean, this was completely heartbreaking. And the fact that between yesterday's win and today, there was an increase in weight of 2 kilos, then a reduction of 1.8 kilos. She had to work all night. No, what's sadder is that she's qualified for the finals, but now ranks at the bottom because she was disqualified.
Correct. Yes.
Doesn't even get a silver.
Exactly. Yeah. So near certain medal also going away. It's tough. It's a tough pill to swallow.
It's a tough pill to swallow, and I'm sure there'll be a lot of questions about this on India Market Close, but stay tuned. A lot more coming up on NDTV Profit.
Market ends higher to snap its 3-day losing streak, with mid and small cap indices outperforming the benchmarks. All sectors close in the green. A huge setback for India as wrestler Vinesh Phogat gets disqualified from the Paris Olympics after she weighed 100 grams over the desired limit. Due to this, she stands to lose even the silver that she won. The Indian Olympic Association files an appeal. Good news for homeowners. Government revises its decision on long-term capital gains tax from Budget 2024. Taxpayers can choose between 12.5% long-term capital gains tax without indexation or a 20% rate with indexation. The RBI monetary policy review is scheduled for tomorrow. The central bank is expected to keep the repo rate unchanged at 6.5%. Tata Motors launches the Curve EV, marks India's entry into the mass market SUV segment, plans to offer petrol and diesel variants in the car too. Political turmoil in Bangladesh is intensifying. Dead bodies of 20 leaders from the Awami League have been found across the country after Sheikh Hasina fled. The UK police brace for more potential riots across the country. Reports say that at least 30 far-right protests may be planned for Wednesday. 6,000 specialist officers have been mobilized. Good evening and welcome. You are watching Profit 360 on NDTV Profit. I'm Nupur Talwar Suri. Well, there is, of course, heartbreak for Indian fans as Phogat has failed to qualify and now loses the medal. Of course, there is a formal complaint that has been launched by the Indian side. We'll get you all of that and more in just a bit. But we begin now with a look at how the markets have fared today. Now, the Nifty and the Sensex have closed higher, snapping a 3-day losing streak. And Harsh Saita joins us with a quick check on what's happened.
Well, leaving the early week jitters behind, we've seen markets rebound and rebound sharply in trade today. And that rebound stayed put, unlike yesterday. We saw a bit of a cool off, but thereafter the rebound again was sharp. We've closed around 40 points from the day's high, as you can see. And you clocked around 24,337, 1.3% higher on the Nifty 50. Let's pull up the heat map. What was really buzzing? We had power doing well. We had the likes of a Coal India and ONGC, so oil and gas stocks were doing fairly well in trade. And the Adani twins, both 3% higher in trade. Those led the pack. But let's look at some of the heavyweights which did well, and let's pull up the contributors. 1.7% higher on HDFC Bank, contributing solidly to the Nifty 50's gains. But outside of that, we saw plenty of other gainers contributing to the gains today. Losers, far and few. IndusInd was one of the top ones, 2% plus lower in trade. Let's pull up the sectoral heat map, try and zoom in as to which ones did well. We had the likes of the PSUs doing very, very well in trade. Metals also contributed very well, and media stood out as another sector. PSUs, let's pull those up. Secular green across the board, and look at those chunky gains that some of the PSUs have made in trade today. ONGC, Coal India, BHEL, Oil India, all 6% plus higher. Let's pull up the metal counters as well. And outside of Hindustan Zinc, we saw good gains across the board, even in metals. Vedanta up 4+%, Hindustan Copper up 4.5+%, SAIL also up nearly 5.5%. Let's pull up the BSE 500, see what was working for the broader markets. Mind you, the mid cap and small cap both were up over 2% in trade. So the rebound is solid as well as secular. The advanced decline was also strongly in favor of the gainers. But some stocks buzzing on the back of news and some on the back of numbers. Let's talk numbers first. BASF was on the back of numbers. We also saw ONGC's numbers come through. But outside of that, let's look at HFCL and Tejas Networks. Both of those buzzing on the back of a BSNL contract set to go live tomorrow. You also had the likes of an EIH buzzing on the back of numbers. Gland Pharma, poor numbers. Bata, poor numbers. So some real buzzers in terms of numbers. But outside of that, it was quite a strong coat of green across indices, broader as well as the benchmark.
All right, Harsh, thank you very much for joining us and bringing us those details. Now, this year has not been about foreign participation. That is the word coming in from Sunil Thirumalai, the Chief Global Emerging Market Equity Strategist at UBS. Listen into his take on Indian corporates, growth and valuations.
Outperformance of India has primarily been, it's primarily been a function of valuations expansion. And as you know, this year, there hasn't been, very strong participation by foreign money. It's basically domestic money, right? So it's basically domestic equity flows that have been really strong and have supported the market. And, and taken through multiple, macro and political events all through this year. Going forward, for a foreign investor, this is something which is very clearly already visible in the numbers. Allocating money additionally to India in the portfolios is a bit of a challenge given where the valuations are. And as we see for an active investor, either an Asia investor or an EM investor, they're down to neutral on India from what was essentially a 4 to 5% overweight position 5 to 6 years ago. So they've consistently been reducing their active weight on India. And if the entire universe that we track is down to neutral, it's possible that many of them are become underweight too, right? So I think we completely sympathize with that view because for the kind of growth that we're getting from Indian corporates, the valuations appear fairly rich, right? But when we're looking at a domestic investor base and and retail flows. I think there is, momentum. I think, all the numbers that we see in terms of SIP inflows, those are really, helpful in supporting the markets.
Now, it's big relief that's coming in for property owners. The government has decided to roll back the controversial rule, removing indexation benefits from real estate transactions. Now, in an amendment made to the finance bill, the Finance Minister Nirmala Sitharaman has given two options to the home owners: pay long-term capital gains tax at 12.5% without indexation, or pay 20% tax on properties without indexation. Now, the cutoff date for properties is July 23, 2024. We spoke to the Finance Minister last month and she had refused to deny a question on whether there would be a rollback on indexation in real estate. This was an exclusive interview with our editor-in-chief, Sanjay Pugalia, 3 days after the budget. Listen in.
एक जनरल रिफ्रेन ये फीडबैक अब आपके पास भी आ रहे होंगे कि मिडिल क्लास को थोड़ी सी ज़्यादा उम्मीद थी कि टैक्स में और ज़्यादा छूट मिलेगी। मेरा मानना है कि सरकार ने प्रैग्मेटिक तरीके से इस पर मूव किया है, लेकिन उनकी एक्सपेक्टेशन अभी भी है कि उनको थोड़ी और राहत मिले। और उसमें एक जो सबसे ज़्यादा हाईलाइट हो गया है इशू, वो है ये रियल एस्टेट में इंडेक्सेशन वाला। LTCG प्रिंसिपली बिल्कुल सही है कि कोई एक एसेट क्लास कम टैक्स क्यों दे, इसको एट पार लाना चाहिए, लेकिन एक जर्नी है, उसमें इंडेक्सेशन पर कोई रीथिंक?
मैं कोई कुछ कमेंट कर नहीं सकती हूँ उसमें, क्योंकि बजट और फिनांस बिल पार्लियामेंट में टेबल हो चुका है, पार्लियामेंट चालू है, सेशन चल रही है। मैं कोई बाहर मीडिया के द्वारा कुछ कहूँ तो पार्लियामेंट्री प्रिविलेज को मैं क्रॉस कर रही हूँ। इसीलिए वो पार्लियामेंट का जब तक असेट है और उधर प्रॉपर्टी है और मैं जाकर कोई भी बोलूँ तो पार्लियामेंट में बोलना चाहिए, ना कि बाहर।
And we spoke to Baman Rastam Irani, the CMD of Keystone Realtors, and Ghulam Zia of Knight Frank India, to understand the potential impact of the sector. Listen in.
The last night's announcement is a celebration that the government does listen to the common man, and the voice of the common man is heard. What is going to happen is there's going to be a lot of comfort in those who have bought properties earlier. I don't think the impact going forward is going to be anything other than positive. Government has made this an investment ability, investment ready asset. When you're purchasing real estate, and I brought down the tax to 12.5%, I think that is a great move. And of course, grandfathering everything to 23rd of July really puts a lot of peace in the minds of the people who may have been getting unnecessarily, if I may add the word, riled only because something was being taken away from them.
From here onwards, the cases are different. And today, when you're buying a property, you are taking into account whatever is the new rule for LTCG calculation. It was only the cases which have happened earlier is where the problem was. So in any case, the industry or the sales number were not impacted because of the new changes, and neither would it have any material gain or impact on the situation going forward.
And in fact, let's now go across to Harsh again to understand what it actually means for home buyers.
Definitely good news for the taxpayer. Real estate capital gains tax law was changed in the July 2024 budget. And basically what it did was it completely removed any indexation benefit that a taxpayer can avail on sale of real estate. Of course, indexation is nothing but an adjustment for inflation. And that adjustment is built into the cost, and therefore your capital gains tax comes down to that extent. What they did as a result of that was they reduced the capital gains tax rate from 20% to 12.5%. But despite this reduction, there were certain cases where tax impact was far larger for the taxpayer, just given the fact that indexation was giving that much benefit to the taxpayer. That has now been left at the option of the taxpayer. What they are essentially suggesting is that you can either take 12.5% tax rate without indexation benefit, or you can take a 20% tax rate with indexation benefit, whichever is more favorable to the taxpayer. Therefore, all of the appeals with regard to a higher tax as a result of this indexation benefit being removed has now been put to rest. That's one. But at the same time, what it does add is it adds a bit of complexity to the tax law. So that's on the other hand. That's the flip side of it. The entire intent was to make the tax law less complex, but this will actually add to the complexity in the tax law.
All right, Harsh, thank you very much for that. Now, moving on, Tata Motors has added one more medium-range EV to its bucket. It has launched its very own new Tata Curve. Now, this has prices that range from over 17 lakh rupees, and Tushar is joining us from the launch event with more details. Tushar, take us through what's happening over there, and also, of course, this I think is the first time that Tata has launched an EV before launching the petrol and diesel variants.
Yeah, that's actually quite a symbolic gesture by Tata, so to speak. So essentially, Tata has entered the mid-sized SUV segment for the first time and is looking to break the clutter with the design as well as the strategy. The company has gone ahead and launched an EV first because it's what it sees as a symbolic gesture to indicate the transition that is afoot in the mobility space. Very quickly, the car is priced at about 17.49 lakh rupees to about 21.99 lakh rupees. Remember, that is the space where the mid-size SUV segment operates. The fastest growing segment, about 7 lakh units sold every year. The power is rated at about 167 bhp, 2,500 Newton meters of torque is sent to the wheels. The car comes in two battery options, 45 kilowatt hour and 55 kilowatt hour, which is good enough for a real world range of 400 to 425 kilometers. So essentially negating the range anxiety that one may have with electric vehicles. It's packed to the gills with features, including several segment firsts. So it's a very unique stab, so to speak, that Tata has taken in the mid-size SUV space. The ICE version will follow on September 12th, on the September 12th, I think. So again, the car is Tata's first entrance into the mid-size SUV space.
All right, Tushar, thank you very much for bringing us all those details. And Shailesh Chandra of Tata Motors also spoke to us on the advent of EVs and emphasized that no manufacturing company across the globe can escape the space going forward. Listen in.
I don't think any manufacturer has the liberty of rethinking any strategy on electric vehicle, because everybody has to move to electric vehicle. The regulations will also drive. So it is about
readjusting their strategy in terms of what product portfolio they need to bring, because some products might not have done good for certain manufacturers. So they will come with a recalibrated strategy or a revised strategy of electric vehicle. But there is no global company who can stay away from electric.
Well, it is the second day of India's Monetary Policy Committee that's meeting. The committee is set to announce its decision on Thursday, that's tomorrow. This is the first meeting of the committee after the union budget and the Fed signalling chances of a rate cut in September. It is also the current MPC's last meet before its term ends and new members are appointed. Pallavi joins in with a preview. Pallavi, take us through what's expected.
Right, like you've said, it's the first meet post the full budget's presentation and also the first meet post the Fed signaling chances of a Fed rate cut in September. Now, essentially, let's look at what's changed from the last policy to this one. Inflation has risen to a 4-month high of 5.08%. That's for the month of June, and that's compared to 4.75% that we'd seen in the month before that. Meanwhile, what's been a source of comfort is that the IMD continues to forecast above normal monsoons. The southwest monsoons are expected to be above normal for the remainder. That's for the months of August and September. Already we are seeing vegetable prices also showing some some easing after having remained elevated and after having risen the past 2 months. So that provides some comfort, but broadly inflation remains higher while growth remains resilient, and that sets the tone for a status quo at the policy tomorrow. So that's what we're expecting.
All right, Pallavi, thank you very much for joining us and getting us all those details. All right, it's time for a very short break. On the other side, we bring you the latest on Vinesh Fogart having been disqualified for the Paris Olympics. Welcome back. And now, in the light of the continuing political turmoil in Bangladesh, the BSF has reassessed and updated security protocols along the Indo-Bangla border. Non-essential staffers at the Indian High Commission in Dhaka and their family members are returning to India on a voluntary basis through commercial flights. Bangladesh has been witnessing rapid political developments in the last few days. The Bangladesh president has dissolved parliament and appointed the Nobel laureate Muhammad Yunus as the head of the interim government. The remaining members of this interim government will be decided after consultations with various political parties. Also, Air India and Indigo operated special flights to Dhaka, bringing more than 400 people. A special Air India flight brought about 205 people, including 6 infants, from Dhaka to New Delhi Wednesday morning. All right, so the latest that we are hearing at this point in time is that Muhammad Yunus has been appointed as the head of an interim government. The members of this the other members rather of this government will perhaps be decided in a consensus with political parties. Yunus, of course, was in Paris and is now back. Is going to be back tomorrow, is what we heard in the morning. But we'll get a confirmation from that from Ibrahim, who's joining us. Ibrahim, good evening. To begin with, tell us more about the situation over there. Now, there were certain reports that violence was continuing in some pockets at least, and also about the interim government formation. We were hearing that Muhammad Yunus will be back soon in Dhaka.
Yes, in fact, Muhammad Yunus will be back tomorrow on Dhaka. As you can see, I am in front of Bangladesh's National Parliament right now. The police is not still there, but we have got a new IGP of police. The police is expected to resume their service soon. So the street of Dhaka, in fact, including the National Parliament, which was vandalized by the mob when the Hasina government resigned, now is being controlled by the students over here. And yes, there was some violence. I have heard about attack on minorities, but it's outside of Dhaka. One of the leaders, Hindu leaders, they have confirmed me that the minorities in Dhaka are safe. In fact, that I visited 3 key temples in Dhaka: Ramna Kali Mandir, the National Dhakeshwari Temple, and ISKCON Shamibag Temple. So they have said that they are guarding the temples, but I question them, why does it need to be guarded? Temple needs to be guarded, and they replied that these are not. We cannot frame them in any race, religion, or any caste. They're saying that they are